software for professional traders. And then about 5 years ago, when I actually got into trading myself, I kind of felt I had the edge because I had a huge amount of background. I had done all of the right training and courses. I built my spreadsheets, and I was all ready to get started, opened my demo account, you know, traded profitably for 3 months on my demo account. And then I went to the markets with high expectations. And actually, what happened to me, if I can get my slides to work, what happened to me is what happens to everybody when you go to a live trading account. And I like to draw this chart because it looks like a price action chart, and it shows the kind of highs and lows. This could be a 5-minute plan, and this could be a 5-year plan, and this is what happens to us all as traders. And so I wasn't any different from anybody else, and I made some money, and I gave it all back, and I made it again, and I gave it all back. And what I decided to do was take a step back, and as a statistician and as a computer scientist, I really wanted to try and help myself in my own trading. And I did some research around what were the best ways for me to measure my own behavior so that I could try and address this problem in the market. Okay, so I suppose I had 2 key problems when I traded. The first was, you know, I always, when I had a bad day, I always kind of even put more guilt on myself by saying, well, I didn't do my analysis properly and maybe my trade log's not perfect. And so I spent half my life building spreadsheets. So the first thing I wanted to solve with chasing returns was what I like to call guilt-free trading. Okay, so what we do is we can automatically load up all your trade history, and then the job of trading, doing all of the analysis of what happened, what went right and what went wrong, becomes a much easier job. Okay, so we do all the record keeping, and then we provide charts, so we make it easy to see where the strengths and weaknesses might be in your trading. So there you can just give a tiny example, and as I said, I'm going to show the platform later, but we have very simple KPIs or performance management, so things like risk reward and batting average that everybody should know, and we make it really accessible and visible to you in lots of different ways. And then something new that came out of talking to our traders was, well, different people like to measure different things. So we now have a feature that lets you define what we call define your own success. So you can decide what kind of measurements you want to keep, like maybe your confidence levels, or in this case, you can see a couple of examples here. I'd like to track when I'm tired trading or revenge trading, and then be able to see of your own measures how they impact your performance. Okay, so we're going to look at all 3 of those things through the Chasing Returns dashboard in a while. So let me go into a little bit of the background of kind of how we think at Chasing Returns. So we look at success in trading the same way that, you know, many of the experts do, and we're big fans of the hedge fund wizards. So I'm going to quote Ed Sequoia here. He said trading strategy accounts for about 10% of success. Okay, and we all spend probably 90% of the time trying to figure out what we should be trading and how we should be trading it. And really, that is important, but it's not the be-all and end-all. Your management is 30% of your success, and the biggest component of success is actually your own personal psychology. Okay, and I want to go into a little example of this to make sure everybody really understands how important it is. So I'm going to explain the Ralph Vince experiment. Okay, Ralph did a very famous trading experiment where he took $1,000, right, and he did the equivalent of 100 trades where you were likely to win 60% of the time. Okay, and a win returned you your money, and a loss, you lost your money. So effectively, the risk reward was 1. There was no fees associated with it. And what he did is he took 40 PhD qualified people. So people who were really smart, and they were smart enough to understand the odds that they were given. Okay, so this, anybody would say if they got this as a trading strategy, they'd be happy to take it, because clearly it's a winning strategy. You're going to win 60% of the time, and your winners are going to be the same size as your losers. Okay, now what is not as part of the strategy is you have no market volatility, so that makes it even easier than your regular trading day. Okay, there's no conflicting news. It's a very, very simple plan where either 60% of the time you're going to get a winner and 40% you're going to get a loser. Okay, you've no distractions. So these 40 people were in a room by themselves for a couple of hours running this experiment, and then finally they were given the actual money to trade. So this is the equivalent of a demo account with no news on a quiet day with with a 60% chance of winning. Okay? And this is what happened. 95% of those people actually lost money. Okay? So this is a really classic example of your trading strategy, while it's important, does not in any way guarantee success. And we can see from here, only 2 of those 40 PhD students were able to make money off a winning strategy. Okay? So the real reason we need to, the real thing we need to do to improve our trading is to focus on the other 2 components, which is the money management and the psychology. Okay? Now I'm going to go into how we break down how we make and lose money. So we look at it as 2 very simple reasons, right? We lose too often, which is your batting average, or we lose too much. So we can all come up with 5,000 excuses why we had a bad day, but really it boils down to KPIs, the batting average, and the risk reward. Okay, so let's delve a little bit into each one of these. First of all, the batting average. So we see 3 different behaviors that are impacted by your batting average. First of all, clearly, if your batting average isn't high enough, you're going to start draining capital and you're going to enter a drawdown. Okay, that is only the beginning of the problem though, because as soon as you start to lose more than you're comfortable with, right, you start to suffer from what's now known as loss aversion. Okay, and what we know about loss aversion is that we feel a loss twice as much as we feel a profit. Okay, so how that translates in trading is if you have a batting average over a period of time of 50%, so you're winning half the time, emotionally you feel like you're losing 67% of the time. So even a 50% batting average is a net negative on our emotional well-being. Okay, so it is something we have to learn to handle really carefully. And if we wanted to get to a loss aversion that was positive, as in more than half of the time we feel like we're trading well, sorry, I'm going backwards there, we actually need a batting average of 70%, okay, which I think everybody will agree is quite a high target. And so rather than trying to have really high batting averages, what we really need to achieve is learn to live with the loss aversion that comes with trading. And then the third point I want to talk about in terms of batting average is your batting average dictates how often and how long your losing streaks are going to be, because it's a statistics game. It's like tossing a coin, right? It is possible to have heads and tails and to get heads 10 times in a row. It doesn't happen that often, but through your trading life, you're going to have winning streaks and losing streaks. And your statistical batting average helps you understand how likely that's going to be. Right? So a couple of quick examples. If we look at the chance of 10 consecutive losers in any 100 trades, if your batting average is 50%, that's only going to happen 5% of the time, right? So let's say you trade 100 trades a week. That means every 1 week in 20. So roughly twice in a year, you're going to have 10 losses in a row, right? So it's important that you understand it's going to happen to you. If you know your batting average, you can help manage your psychology around the fact that it's just one of those events that's happening. It's not suddenly my trading strategy doesn't work anymore. Now, if your batting average goes to 40%, you're actually going to have these 10 consecutive losers about 20% of the time, right? So if you're an active trader trading 100 trades a day, this is going to happen to you once per week, okay? Really important to know how likely your losing streaks are, because you need to adjust your money management if you've got low batting averages. Let's go to 30%. If your batting average is 30%, which can be quite successful for traders if they have the right risk reward, but look at this, you're going to have 10 losers 58% of the time. So more than half of the time, you're going to get those 10 losers in a row. And then when you get to lower batting averages, you really need to be really careful, because these losing streaks can completely burn you out unless you're really, really careful with your money. So that's kind of an understanding of batting average. If we go to the second KPI that I want to talk about, which is your risk-reward ratio, right? The issue here is that the size of your winners are not as large as the size of your losers, potentially. Okay, so what we look at is we compare that ratio and we understand if our winners are actually at least as big, if not bigger, than our losers, which is what we want them to be. Now let's look at some examples here, right? To break even in trading, if your batting average is 50%, your risk reward only has to be 1. Okay, so it means your average winner and your average loser can be the same. If you've got a risk reward ratio of 2, which means if you can make your winners twice as large as your losers, you actually only need a batting average of 33%. Okay, so you can see that targeting a better risk reward gives you huge opportunities in the market because you don't have to hit the higher batting averages. And just going to the extreme, if you can get a risk reward ratio of 4, you actually only need to win 1 trade in every 5. Okay. So these KPIs are absolutely critical to understand. Now let me go in the opposite direction. Okay. If your risk reward starts to drop and your winning trades are smaller than your losing trades, you suddenly need to start winning a huge amount. So if the risk reward is 0.67, you have to be hitting 60% of your trades. And if it goes down to 0.5, you need to be hitting 2/3. So everybody needs to understand these numbers because it's how these two interplay with each other that dictates your success in trading. Now, we've talked to a lot of traders over the last year, right? And almost every trader has some idea of what their target risk-reward ratio is, right? A lot of people would say, well, it's 3 to 1, you know, most of the time, and occasionally I might take a trade that's 2 to 1. Okay, but actually, less than 20% of traders know what they're actually getting when they look at their results after the fact. Because what you do is you set up a trade with the best will in the world with a small stop and a larger target, but you don't always wait for your stops and you don't always wait for your targets. And so the actual results you're getting in terms of the risk-reward ratio is usually very, very different to what your target is. Okay, and that's one of the things I'm going to show you on the platform. Even more critically, your risk-reward ratio is not necessarily consistent. And this is where we're going to start looking at your psychology. Sometimes you're going to be hitting higher risk rewards and sometimes you're going to be hitting lower. And it's really important to see where your inconsistencies are. And of those traders who know what their actual risk-reward is, many of them do not know where they're inconsistent. Okay. In fact, we found that less than 5% of our traders, before they started using the platform, could tell what their risk-reward was. Okay, so this is the Chasing Returns dashboard. So what I'm going to do is I'm just going to switch over and show you a live Chasing Returns account. So you can see, first of all, from our free dashboard tool, how you can measure these KPIs. Okay, so just bear with me 1 second. Okay. So what I've done here is we're looking at an account that has about 2,000 trades. Okay, it's about a year's worth actually of data, and we can see that this trader is just about profitable. The P&L number, which is sitting here in this chart, is running over 5 quarters, and he's profitable to the tune of £500. Okay, so a couple of things. I'm just going to go into his P&L chart and see that you can see a cumulative chart here to see what your P&L looks like. And over here, what we do is we show you all of the trades in your portfolio. Now this account actually, I'm just going to remove the last month because there was very little traded. It'll make it a little bit easier to see. Okay, so here you can decide with Chasing Returns, you may want to look at the life of your trading, you may look at today, this week, this month, etc. Okay, so right now I'm looking at about 10 or 12 months worth of data. Okay, so this visual screen lets you look at your risk reward. Red buttons mean they're losing trades and green means they're winning trades. So we can see a nice period here where there was quite a lot of big winners taken and a lot of smaller losses, which is good. I'm going to show you some of the filters though, because clearly the top 5 and bottom 5% of trades are making an impact. So I'm just going to filter. So what you might want to do is stop looking at the outlier trades and look at just your middle 90%, because again, you get a better feel for how is my average trading doing. So we can go back and see, and you can see actually this trader for his middle 90% of trades is overall losing money, right? But his outliers are what's making him profitable. So again, a really important thing to understand is, am I making my money day to day in my 90% of trades, or are a couple of outliers the reason that actually I'm being profitable? Because both require different types of behavior. Okay, so I'm going to move on to the KPIs, and they're sitting over here on the right of the screen. So here we can see the risk-reward ratio. Overall, this trader, I'm actually just going to switch back to all because it's a little less confusing. This trader has a risk-reward ratio of just below 1. It's sitting at 0.92. Okay, and his batting average is 52%. So he's winning slightly more than he's losing, but actually his winners are slightly smaller than his losses. Okay, and we'll get into a little bit more of that later on. We have a metric down here called discipline ratio. Okay, it kind of mirrors risk reward, except what we're looking at is how much time are you spending in winners compared to losers. And this is a really good indicator of some psychology if you're the type of trader that is cutting your winners too quickly, and maybe ignoring your losers in the hopes that they come back. So what you want to do is you want to look for a discipline ratio that's well above 1, which means you're spending longer in your winners. And if it's less than that, there's a big area that you can start to work on right away. And finally, this last metric over here is really simply showing you the average P&L per trade, because KPIs are all fine, but what you really want to know is how much money am I making on my trades. Okay, so I'm going to move on. Sorry, there's some alarms out here. The second thing I'm going to show you is that you can filter by any set of products. Okay, so this trader happens to trade quite a lot of products here, but what you might want to do is you might want to just look at one or some set of your products and compare the KPIs. Okay, because some people are better trading some products than others, and it's, again, you can delve into this level of detail if you want to analyze one product at a time. Okay, and then the final feature I'm going to show you, we call this tagging. This is where you define your own KPIs. Okay, so for any trade, right, you can, I'm just going to do one here, right, you can tag a trade. Okay, so I'm going to call this round the clock trader demo. Okay, because just to give you an example, right, if there's something you want to track about your trades, if you use the tagging feature, I'm just going to save it here. You can see down here, you now have this whole other way to filter your trades. Okay, so I'm going to just put a second one in. Here we go. Save that one. And now I might just want to look at those two trades. So you can see it's two trades, and you can see what are your metrics doing for this particular KPI that you want to measure about yourself. Okay, and this has been a really successful feature, and it's a really powerful tool for you to figure out whatever it is you want to analyze about your own trades. Okay, so that is the dashboard. I'm just going to really quickly show you how to get data into the platform. Okay, so we are currently working and supporting all of these brokers, IG, ETX, FXCM. We now have some professional traders on. If there's any professional traders, we have a TT interface. Infinity Futures, CMC. Custom allows you to put in your own spreadsheets, should you want to. And I'm just going to show you MT4 very briefly, because interface is actually a live EA. So literally you need to come in here, download your EA. Okay, the instructions are sitting nicely on the platform here, and you install it on your MT4 dashboard. Okay, and then what happens is your trades will actually instantly pop up in the dashboard. Okay, and this is really powerful. It means you don't have to import and export your trades on a daily basis anymore. And if we have time later on, I can do some trades on a mobile phone here, and you'll see them actually pop into the dashboard. Okay, so for now, I'm going to go back to the deck and talk a little bit about our trading psychology product. Simon, I'm just going to do a quick check for questions. I haven't had the window open. Are we doing okay?
And we're fine. There's no questions yet. We're just watching. Thank you.
Okay.
Looking at it. Yeah.
Okay. Okay. So I'm going to move on. to the next phase of the talk, which is, okay, how do I turn all this knowledge into profit? Because it's all great to go down the pub and know all of your KPIs, but what we really want to do is we want to harness the power within those KPIs to turn it into larger and larger profits. Okay, so the solution that Chasing Returns has come up with for that is called the game plan. And what the game plan is we want to improve your trading success. And what we want to do is we want to help you decide how to move forward, because the problem with the trading world is you have 5 million ideas and it's where do you start, okay? So what the game plan tries to do is it's mapping out your own personal habits. And there's a tiny little sample there that says, you know, you're better on a Monday than a Tuesday, but we really are trying to bring it back to basics so that you can figure out which habits you relate to the most and which ones are therefore going to, you're going to be able to improve quicker. Okay, so the game plan is all about discovering your habits, like what time of day do you trade best, okay, and then it's about taking advantage of that. All right, how much money should you be putting on trades that are consistently losing versus consistently winning? And we'll talk a little bit about money management as we go through that. So I have a series of charts here, and they are samples from the product, but I want to put them up as slides first because I want to make sure everybody understands how to read them. Okay, so we had been looking at this trader on the dashboard who had lost about £1,500 here, and I believe the batting average for that trader was about 50%, okay? So this first metric that we measure is called velocity. And what we do is we take the entire set of trades we were looking at, and we figure out how long did you wait before you put on that trade after closing out a previous one, right? And we can see here, can I see my mouse? This particular trader traded 1/4 of his trades by entering them less than 2 minutes after closing out a previous trade. And then there was another quarter between 2 and 6 minutes. And then you can see between 6 and 23, and then longer term, right? And what we can see from this trader is that he has a massive weakness when he jumps back into the market too quickly. And in this case, 25% of his trades, right, were actually losing him nearly £4,000, which is way, you know, it's nearly 3 times his total P&L. Okay, so there's a massive edge for that trader immediately to understand. The other interesting thing about this chart is you can see that 75% of his trades, when looked at this way, are actual winners. Okay, so he has better batting average when he's not trading too quickly. Right, this second example is just looking at how long you're spending in trades. And again, now this is the very same trade data, it's the same total P&L, but here we can see that 75% of the trades are losing money, right, when they're of really short duration, so up to 59 seconds, up to 1.3 minutes, etc. And when he gets into the trades that are lasting more than 8 minutes, you can see that he's making a lot of money. Right, in this case, he made almost £4,000 on those 25% of trades. Now, trade duration is often not something you can control unless you have different strategies. I think this guy was trading a lot of binaries, which is these very short-term trades, and he wasn't doing it very successfully. When he had longer positions on, he was doing much better. Here's a really simple one, which is to understand how your different products behave, right? Because depending on the volatility, it could be the time of day, but we all are better at some products than others, and quite often we don't really know until we actually sit down and measure it. So one of the things that we do, and we highly recommend everybody does, is to know what kind of metrics they have on a product-by-product basis. Here we can see, you know, 2 products were very successfully making him money, but some of his other products were just, you know, natural losers, and he needed to address how he was trading those products. Here's another interesting one which looks at the number of parallel open trades. And I know everybody has different styles of trading, but sometimes we have a tipping point and we can run 2 or 3 positions at a time, but maybe when we get into higher numbers that we're not so successful. So it's important to understand if we have a number of trades that works for us. Now, this example, I put up because it's really interesting, because it shows when this trader only has one position on, he's losing money. And actually when he's running 2 or 3 or more at a time, right, he's actually being very successful. Right? Now, everybody's got a different story, but the story here is quite interesting. First of all, he really does get into a zone, right? And when he's trading well, and he's able to put on lots of positions and they work out for him, right? But the story behind this number, right? 43% of his trades, right? So nearly half his trades are losing him £5,000, which relative to his overall account is pretty massive, right? And the explanation for this is when this guy has no position on, he's bored. And he literally was going in, taking positions because he wanted to be in the market. And those board trades were losing him a fortune. And when he cut out that behavior, he really started to perform. So again, each of these graphs is telling a completely different story based on exactly the same trade history. I just have a couple of more and then I'm going to go into the demo. So consecutive winners. So again, emotions really start to come into play, and we are trying with some of our psychological metrics to understand when you're in the zone, but also when you're kind of at tilt and you're trading emotionally, right? So here we can see after consecutive winners, right? These are trades entered over here when you've just closed 3 or 4 or 5 or up to 22 in this guy's case consecutive winners. And we can see he actually performs really well when he's in a zone. Okay, he doesn't get cocky, he doesn't start giving it back, he actually starts to make good returns on his trades. And in this case, it's a small percentage of trades, it's only 20% overall in this bucket, but they're hugely profitable for him. On the other hand, looking at consecutive losers, here we see what's happening to this particular trader. When he's already closed a loss, these next trades are losing him money, right? When he's closed 2 losses in a row, he really starts to suffer from a lack of confidence. On the platform, I'll show you a little more what's happening to his underlying metrics, but you can see that a small number of trades, 17% of trades, that accounts for his entire loss, okay? So I've shown you lots of charts here, but if you could even just eliminate that one habit, okay, you can suddenly turn your trading around. Okay, so I'm going to switch again just back into the platform because there's a huge amount more depth on the platform, but I just wanted to explain very briefly what some of the metrics were all about before I delved into it. Okay, so what we're going to do from the main dashboard of the platform, we're just going to select game plan. Right. Okay. So some of these charts you saw previously on the screen, but I'm just going to go into a little bit more depth. Right. So first of all, on the right-hand side, these are all the habits we measure. Right. And I'll run through them all in detail in a second. They're in a priority order. You can see this percentage on the side. Right. So we have a lot of smart mathematicians working with chasing returns. And what we do is we tell you how reliable the edge is related to particular habit. Okay, so what we're doing here is, in this particular case, trade duration is saying 100% reliable. So you know, if you were trialing drugs, anything above 95% is considered to be statistically very safe. And this is saying there is truly something statistically different about the performance of these trades at 100% reliability. Right now, duration, let me just explain quickly. We've got our 25% of trades in each of 4 bars. So what we do is we'll take your entire trading portfolio and we will tell you where your 25% number is. Okay, and here we're showing the total P&L. So we can see these 3 are losses and here's where you make money. But sometimes you might want to delve in a little bit more. So you might want to look at the average P&L per trade, right? And then you can get into what the batting average is doing and what the risk reward is doing. Okay, so again, if anybody wants to come on, join the service, you get a 30-minute free coaching session to go through this in detail because I don't have enough time to cover it today. But let me just tell you what the color coding is. So what we do is we show you some red and some green. Okay, so I'm just going to stop here on average P&L. Okay, so a green bar means that you are outperforming your own behavior. Okay, so in this case, the average P&L for this trader is rounded, unfortunately, to 0 because he's roughly a break-even trader. But here, the average P&L is actually 10. Okay, so green means that is an area where you are stronger. Either you're displaying better discipline or you're making better trading decisions. But either way, it's a strong place for you. Whereas a red bar shows weakness. Okay, if the bar is gray, it means this, it's not statistically reliable, so we would not recommend making trading decisions on it. Okay, and you can mouse over any of these bars, and you can see what the average is, what the total is, what the reliability is. Okay, if you get more curious and you want to know what's going on behind it, you just click on the bar. Okay, and here we can have 3 different views. So I'm going to start on the right, show tags. So this is your own personal KPIs, right? So you might want to see which of my KPIs are most impactful for a particular habit. Okay. The second one is which products am I trading? So again, you just want to see what percentage of my trades are sitting in different bars, because what you might find is the one where a product is particularly active may be one that's causing a problem. And then the third one, I don't know why I did that backwards, is your actual trade log. Okay, which I showed you earlier. You can go in and look at just the trades, right? Because you might want to tag them when you're doing your analysis, or you may want to look at your biggest winners or your biggest losses, or the time or the date or the product, right? And all of these fields are sortable. Okay, so that's how to interpret the charts. And I'm just going to run through the different habits that we have. I'm doing okay for time. Okay, so the second one here is tagging. Right? For this particular trader, there's a whole bunch of his trades that he hasn't tagged, right? We can see his high confidence, when he followed his plan, both of those are outperforming. He called this fear of missing out. This was his scalping trades when he had nothing else to do, or when he's tired. Okay, so again, you can imagine whatever habits you want to measure, and this chart will show you whether or not you have particular trading edge. So I'm going to show you so you can see how total P&L works. But here you might have a small number of trades in one bar and a large somewhere else, in which case if you look to average P&L, it'll give you some idea of what's going on. Again, you might want to see what's happening to your batting average and your risk reward. Okay, parallel open trades. We had a quick look at that, so I'm not going to go over it again. That was on the chart. Day of the week, right? We all have our good days and bad days. And this particular trader, I actually went in here and went month by month by month, and his pattern did not change any month. So he had a particular habit that if he was, if he was a sloppy trader one day, he was really disciplined the next. And then he would go in after a really disciplined day and he would give it all back. And you can see it happening really clearly on his day of the week. I'm just going to show you one other feature while I'm on the screen, show outliers. So one of the things is sometimes your top 5, bottom 5% can be skewing your numbers, and you might want to look at it. So if you say show outliers, you literally, the green bar are your top 5%. So you can see his best trades are done on Wednesdays and Thursdays. But from his worst trades perspective, a huge number of them happened on Wednesdays. Okay, so sometimes you can get a little bit of insight by just looking at your outliers. Okay, so I'm going to keep going. This is just looking at months. Hey, Simon.
Sorry, hi, just a couple of questions that are now waiting. George is saying, how do you define fear of missing out, revenge, and tired? Is that definitions that the trader?
The critical thing is chasing returns does not define them. You define your own. And so what we tend to find is if you're using a coach or an education provider, they will often specify. So we've got coaches using our platform, and so they may put 20 students on, and let's say they're running a course. They will often define a set of KPIs they want the entire class to use, right? But it's very much a personalized thing. So some people use it for tracking their feelings. Am I feeling confident? Am I feeling, happy? Am I nervous about the markets? Whatever. Some people use it for strategies, and they may be testing 3 or 4 strategies, and they tag all the different trades so they can see which strategy is doing best. But it's completely up to you to define. That's the power of it.
Uh, David says, fascinating stuff. Presumably the stats are only really meaningful after a significant number of trades are logged.
So, yes and no. If you have a habit that's really severe, you can see statistical reliability in about 100 trades. But then in some cases, you might need to go to like 500 trades. So everybody is different, right? And it depends on, I suppose, how much the habit is part of your life. So if if you're always really weak on a Friday afternoon, you probably only need, 2 weeks worth of data and maybe even 100 trades to show you that. But the beauty of using the red and green is if there isn't enough, if we don't believe it's statistically correct, we'll show you the numbers, but we won't color it red or green. But often, even if it's gray, you can see a pattern emerging quite early. So some of our beginner traders will have lots of gray, but you'll see the day and the time and stuff starting to show a pattern really quickly.
And presumably it's the day the trade was opened, the day the position was opened, regardless of whether it was closed in the same day or 2 days later or a week later.
Yes, all of these psychological metrics are looking at your entry. Absolutely. It's the one thing you have control over is when you're entering the trade.
That's fascinating.
Yes.
Fascinating.
So, yeah, if I look at a time of day one here, so we have a few different time of days. This trader is not particularly normal in his behavior because he trades really well at night. I've got a 1 hour one. Can't find it now. Where's my hour of entry? Sorry. So yeah, it may be the time you enter the trade. It may be the day. Everybody's different, but it is related to entering the trade, not exiting the trade, because typically we've no control over our exits or very little control over our exits.
Is there anything, some next steps or plans, or is it fanciful thinking that you could use some or all of this information for traders to begin to make suggestions of products, as you say, to trade, or products which are behaving in a certain way, volatility-wise, that might suit a particular trader with the track record that this is what he or she looks for in a trade. Is that something that?
And that's exactly where we're going. And actually, you can see a slight hint at it here. When we look at these habits, you can see mostly they're grey. But there's a couple of green ones down here, right? And there's a red one, actually, okay? So we are going to, in one of our new products, we're actually going to convert all of this information into alerts, okay? I'm just going to click on this red one, right? First of all, I'm going to explain the metric, which is the intraday trade frequency. So this looks at your first trade of the day, and then we look at all of the trades. So this guy, one day, traded 110 trades, okay? He's quite a busy trader. And so we can see that his first trade of the day has certain behavior, and then he seems to degrade during the day. And then on the days that he goes in and does this crazy scalping, he literally throws money at it until he makes his money back, which I wouldn't recommend, but that's this guy's pattern of behavior, right? But you can see when we look at the average P&L, he's obviously very good on the first trade of the day, which doesn't happen that much. So you see a total P&L number of about £1,000, but his average is £12 per trade, which, considering he's just a break-even trader, I mean, that's a huge edge to know about, okay? And clearly, I can't remember how many trades were done today on this account, but clearly he's now in a red zone, so he must be sitting in here, right? And we're saying be careful, right? So we're going to turn these little icons into an alerting platform, basically, so that you don't have to remember where you're good and bad. We'll actually have a series of icons for you, and we'll be able to show you when you're, on a losing streak or a winning streak, or you've traded a lot today and maybe you're getting tired or it's the wrong time, etc. That's exactly where we're going with it.
Fantastic. Joaquim says, will a report explaining all of this be created at regular intervals, monthly, for example? So would you actually receive some sort of monthly report on all these KPIs, or is this just
It's
something
on
you
our
get?
it's on our roadmap. It's not actually available yet, but it is on our roadmap. But what we do today is every time you import more data, you get a little summary of what's going on. But what we want to do is we want to actually get an email out to you at the end of every trading, well, ultimately every trading day, as well as a weekly and monthly report. Because what you want to do is you want to, I might actually nip back to the slides
Hmm.
and talk a little bit about how you make use of this. It'll cover that question a little bit better. So apologies, I didn't get a chance to go through all of these habits, but I just think I'd like to go through some of the kind of next steps in terms of how you behave. And then if anybody has any questions, my email is at the end here. You can get in touch. Okay, so the big thing that we like to talk about when it comes to knowing some edge is how do you change your bet size appropriately. And I just like to use this very simple analogy is that any poker player knows that you don't put the same bet size on a pair of aces as you do pretty much any other hand. But yet most traders tend to put the same position size and take the same risk on every trade. Okay, so the first thing we say is don't take the same risk if you don't get the same return. And so what you learn from chasing returns is you learn where your strengths and weaknesses are. Okay, and sometimes fixing your weaknesses can take a long time, right? But changing your money management can really adjust the impact of your negative habits really quickly, right? And I did a little example and I want to show you, right? So I'm going to go back to this velocity metric where this trader, a quarter of his trades were losing a lot of money. Okay, so I just did a really simple model here for people to try and understand the power of this, right? So here we have his 4 different habits, right? 25% of his trades are under 2 minutes, 25% are under 6 minutes, 25% under 23, and then the rest, okay? And then we looked at the historical P&L. So he was losing about 3,000 on those first 25% of trades, and then he was making money on the others, okay? So overall, he was losing, right? Now, let me compare 2 different things, right? If he's putting the same bet size and he continues to put the same bet size on all of these trades, right? And I just took a simple example. Let's put 100 euros on each of the trades, okay? So his total risk if he trades in each of those 4 windows is going to be 400 euros, okay? And using the statistical odds that we know, his results, we know from his past results, that he's going to lose $140, okay? So what we like to do is we want you to look differently at how much you gamble. So in this particular case, he's losing money here, right? I just made a simple assumption that he's just going to half the size of those trades until he learns to fix that behavior. So instead of putting this 100 euros on, he's actually only going to put 50 as the risk on those trades, okay? And so now he's got 350 euro to play with to end up taking the same risk over the course of a trading spell. Okay, and what we do is we take that 150 and we actually allocate it based on the odds here. So we know he's better in the 6-minute window and he's slightly worse greater than 23 minutes. Okay, so if we literally allocate the trading risk differently, right, we're still going to risk 400 euros, right, but using the stats we can see that those exact same trades will now return him a positive 275 or 69%. Now, it's a little bit of a contrived example, but it's just to show people the power of management, right? You can't necessarily fix your psychology overnight, but you can certainly be much smarter about how much money you're throwing away if you're on tilt or if you're desperate to get back in the market and you're being a little bit careless with your trading. So does that help answer that question? Okay, I'm going to continue on. So what we say is target 1 or 2 improvements. So one of the things you see in the platform is, there's probably 20 ideas in there for everybody to do something different with their trading. But we're human and we can't change everything, and we certainly can't change it all at one time. So have a look at your metrics and try and understand which ones you could have more power over and which ones you relate to the most, and pick the things that you believe will help you to adjust more quickly. Right? And then make a list of what are you going to change about your trading. So it may be increase size or reduce size. It may be to stop trading in certain periods of time, right? But make a concrete list and add it to your to-do list every day. Okay, stick it on your screen and work towards a new plan to take advantage of your strengths and to lose less money when you're trading weaker. And then give it a chance to work. It's a statistical game, so you're not going to suddenly on 1 or 2 trades start seeing a difference. So you need to give it some time, and we recommend a minimum of 100 trades or 3 weeks to start seeing results. And that's where we're at. So this platform that I showed you is available on a 14-day free trial. The actual dashboard remains free, so you can continue to use that if you're not interested in the psychological habits. And the monthly subscription, if you want to use the psychological habits, is €49 per month. Okay, there's my email address. Very happy to answer any more questions offline. And also, if you upload your trade history and you want to have a free 30-minute review, we'd be delighted to do that for you. So there we go, Simon.
Thank you very much for that. You said you recommend a 3-week period, but the 14-day trial, can that be extended at all to the 3 weeks to see if...
Simon, I will send you a coupon code for your users.
Oh, that would be great, because there we are. That just gives you that little bit longer to...
And that's a very valid point, which I'd never thought about before.
Oh,
yes,
sorry.
I'll send you a coupon code.
Thank you. I'm putting your email address into the chat box just now for everybody to see, and I'll also put the website. But it's great, and I can see that you've made a lot of developments to the software just in the last 12 months. Is it 12 months? I think it was even just the beginning of this year that we first met. So
oh yes, yeah.
Definitely taking a trick, and you must be getting more feedback all the time from people, the more people that you have using the service. And,
yes, absolutely, and we've made a lot of the charts are a lot simpler to understand now compared to some of the earlier versions. So we're streamlining all the time, and we're trying to put out, you know, minor features on a weekly basis and then some major features every couple of months.
Fantastic. I really like it. I think it's great, and I can see how people can use it and to start to iron out their idiosyncrasies and realize when they're tired. I like the idea that you get alerts saying, go and have a cup of tea, take a day off, go and play golf, do something else if you're in your traditional risky zone, which I think can be very helpful to everybody. So thank you very much. And there's the website going into the chat box. So if everybody would like to go ahead and get signed up, and hopefully we'll be able to get a coupon for you as well, which will give you a little bit extra trial time. So go ahead.
So I just put a code up there. It'll take about 30 minutes for it to be active. So I've sent it to you, and after the 14 days, anybody can use that to get an extra week.
There we are. That is, and I've reposted that out to everybody. RTCT September 2016.
Oh, it's not September, it's October. Oh well.
It doesn't matter. We'll take a note of that. If that's the one that's set up, I'm sure we can. Everybody can adapt to that. That gives you the extra week.
We'll leave it at that.
So it's kind of a nice time because we're at the beginning of October, so that would take us right up to 25th, 26th of October. So it's a good time and a good month to analyze your trading in a busy month of October. So thank you very much indeed for coming along and joining us again. It's always good to keep in touch. Really appreciate it. So hopefully we'll hear from you again, and hopefully we'll be able to put some people through, and everybody will benefit from that. So I'll take the presenter role back from you.
Simon, it's a pleasure, and thank you very much.
My pleasure. Thank you very much, Anne.
Bye.
So there we are. Thank you very much, Anne Hunt from Chasing Returns. And well, that was very fast to provide us with an extra week for the trial of the software. So I hope you can make use of that, a full 3-week trial to see why your trading, or where your strong points are, where your weak points are. I'm sure you'll enjoy that. We're just another few minutes away from our second speaker. Late entry, but I'm delighted he's here. Zaheer Anwari is going to be joining us in just 5 to 7 minutes time. He'll be starting at 12 o'clock. So we have a short break for 5 to 7 minutes, and then we'll be back with Zaheer, who will be taking us on throughout this first day of the London Investment Week live event. Thank you to everybody that's joining us, and my name is Simon Campbell. If you haven't been on one of our webinar events before, welcome. We hope you're enjoying the content. We're here to teach you how to trade and invest better than you might be at the moment, and of course all the sessions that we have are completely live, so please do use the chat box to ask questions. Even if it doesn't pertain to the immediate presentation taking part, we can always put questions to these experienced traders and professionals that we have speaking at the event to try and answer your questions, whether they be on the live markets, what's going on in the global markets today, or something of a more technical nature. We are here to help you. So another 5 minutes, and we're welcoming Zaheer Anwari, our second speaker of the day. Following Zaheer at 1 p.m, we will be having a live market analysis with Steve Ruffley at TraderMaker. IntoTrader.com. He is the chief market strategist there. Followed at 2 o'clock by David Paul at VectorVest, how to build a worry-free investment portfolio. And then at 3 o'clock we go back to trading and look at how trader Lars makes his 200% gains in 18 months. Lars is a trader with an account at DarwinX, where you can actually place money into a portfolio which he trades, and you can analyze the results that he's been achieving over time. And he's going to be joining us live to tell us how he does that. Then at 5 o'clock, Charlie Burton from Easy Trader. Again, we've had Charlie on numerous times with us to talk about his day trading, his habits and psychology towards the markets. And again, finally at 7 p.m, Corvin Codirla, ex-hedge fund manager and now FX trader and coach, will be joining us at 7 to round us off at 8 p.m. this evening. Just more questions coming in on the recording. We do always get asked, but we do always record these events as much as we can. And as a registered attendee, if you're in the webinar now, you're registered, of course. So if you do have to leave for a session or two, you can catch up on the recordings that we will be able to send out to you. It'll probably be tomorrow before you get the access to the recording from the previous day. The nature of these events is that it does take quite a lot of crunching to process the longer recordings. It's more than just an hour's video, so if you can be patient for that, but they will be coming. So we'll just have a look for Zaheer to see if he is in the room, and I'm delighted to say that he is. So I will take the microphone off and say, with 3 to 4 minutes to go, Zaheer Anwari, good morning.
Hi Simon, how are you? Can you hear me okay?
I can hear you fine. I can hear you fine. Thank you for joining us this morning.
Thanks for having me.
We did have a gap, and I'd say we've had a couple of call-offs already yesterday with people falling ill. And it's just not the sort of emails you want to get on a Sunday night before a live week of webinars. So I'm very grateful to be in touch with you this morning, and for you agreeing to stand in at relatively short notice. It's always good to hear from you. It's been, I think, a few months since we last had you on the Round the Clock Trader Show.
Yes, correct, exactly. It was just before summer, I believe.
It was. And for those of you that haven't heard Zaheer, how do I introduce you? The Dynamic Trader, you are a trading mentor
Yep.
with a specific strategy. You look at the longer term trends. That's your
Yeah, yeah, correct, exactly. I believe as traders, first of all, most of the people coming into this, into your fantastic seminars and webinars, they're all private traders, I'm assuming. So as private traders, we've got to have a particular approach which will differ to how institutions trade. So I think that's the first thing that people need to be aware of, that as private traders, it's very much a different world compared to hedge funds and institutions and banks, etc. Then further on from there, the next thing that people need to understand is what kind of market conditions we're in. A lot of the times people just focus on one particular approach, and usually it's a shorter time frame approach, day trading or scalping of sorts. Whereas what I teach people to do is, first of all, understand what kind of market condition you're in. Once you can understand what kind of market condition you're in, you can then use the appropriate strategy. So sometimes long-term strategies are more relevant. Sometimes shorter-term strategies are more relevant. So hence where the name comes in, dynamic trader. It really is about being dynamic and adapting to the market, as opposed to trying to get the market to adapt to you, which is where a lot of people go wrong.
yes, indeed. And you came from a non-city background. I'm
Correct.
right in saying you've been a photographer and you've travelled, but you're a good example of someone that's taken a mentor yourself. And you
Correct.
have mentors the dynamic trader is not just yourself. There's one or two others as well who in
Correct.
turn taught you.
Yeah, exactly. As you've already mentioned, I've got a degree in software engineering. I then became an English teacher, and then a photographer, and then a trader. So it was an evolution to actually start trading. And the reason why I started trading was because I'd saved up quite a bit of money and I wanted to grow that money. I didn't want to just put it into a deposit for a property or give it to someone else to invest on my behalf. And that is when I came across my mentors, purely by luck, actually. I was in the right place at the right time. And I wasn't aware of what technical analysis was. I was aware of what trading, what investing was, and and that
Hmm.
was the kind of route that I was going down, looking at value investing and understanding Warren Buffett's approach. But I just found that quite a lot of hard work, especially for someone myself who, at the time, I was a photographer and I was working long hours, sometimes 15, 16 hours a day, and then to have to read up on all the fundamentals of a company and do the research. It was a lot of work. And so that's why long-term trading and doing that from a technical analysis perspective really resonated with me, because it could fit very nicely around the lifestyle I had at the time.
What do you see? Just everybody's got different horizons. What is long term in your world? What would you
Yeah,
consider a long term
yeah, it's a good
position?
question. For me, I look for the medium to long-term trend. So foreign exchange, I would say a good trend is 8 to 9 months, and in stocks, I've held positions for 12 to 13 months. Commodities as well, yeah, around that same time as well. So I focus on all the markets, not just foreign exchange, stocks, commodities, and within each market, there is a definition to what I would call a good trend. So I know a lot of these presentations are based around foreign exchange. So for me, I would
Mm.
say 8 to 9 months.
Yeah, I mean that's interesting because it's unusual to hear people using the word longer term and forex in the same sentence.
Yeah.
It's synonymous with much more shorter term trading. But clearly,
Yes.
you take into account the technicals. Do you look at the fundamentals? Do you look at these news events and the economics as well?
I do look at them, but I don't trade on them. So let's take, for example, Brexit. I was short on, the pound Japanese yen, for example, and I had been short on the pound Japanese yen from I think it was December or January, so at the start of the year. So I'd been short on it. I had several positions running from 180 all the way down to 150. I'll give an example when I get into the chart. But
Mm.
the week of Brexit being released, I believe it was the Thursday, if I remember correctly, I closed all my positions off on the Wednesday before. So I didn't have any currency positions open, just purely because I didn't know how the market was going to react to Brexit. Of course, now in hindsight, I wish I kept my positions open because, there was that massive drop on the pound currencies. But, you know, everything is beautiful in hindsight. I did what was right to me at the time, which was I focus on protecting my money. I want to make sure that I'm here for another day. So I closed my positions, and then based on the technicals, I got back in again. When it comes to stocks, I use some fundamentals. So I look at what the indices are doing. I may look at earnings, volume, gapping. So there is a certain amount of fundamentals involved with a sector's example as well. So,
Yeah,
but with currencies, it's purely technical.
purely technical. There we are. Well, so here it's already a few minutes after 11 o'clock. We'll do the screen share and make you
Yeah.
the presenter, so people go from seeing my screen to your screen, and we'll allow you to actually get started. Sorry, I'm uh, asking you these questions, which are probably a lot of the content that you're about to share with us anyway. Okay, I can
Okay.
see your
Lovely.
screen. I'm looking at three charts in the list of the currencies.
Fantastic. And you can see my mouse jumping around.
I can see the mouse jumping around. Could we ask
Fantastic.
those of you at home as well, just to confirm, using the chat box, that you can hear Zaheer and see the screen as well? And then once we know that, we can get started. Great, David, Catherine, Joaquin, thank you very much indeed. Wonderful. Zaheer Anwari, dynamic trader, I'll hand over to you and let you get started.
Brilliant. Thank you, Simon. Hi, guys. Thank you all very much for tuning in. Thank you, Simon, again for inviting me, and it's always a pleasure to have the opportunity to present. So yeah, let's just get straight into this. You heard a bit about my background, so I don't come from a city background or an institutional background. I just purely came from a background where I went from one career to another. The reason why I always changed was because I was very unhappy with having to always compromise. So, I worked in IT for a year. I didn't enjoy it. I then became an English teacher. Loved it. Got to travel. I lived in Japan and Taiwan, so I was teaching English out there. And um, great people I met, traveling, etc. It was all very good, but there's no money in it. I then came UK. I'm from London originally, and that's when I became a photographer, which was my original passion. So the question is, why didn't I chase that in the first place? Why did I go down the route of IT? But that's what happens when you grow up. You're sort of directed down a route, either by your parents or the school system or the education system. But photography was always my passion. So came back. I decided I was going to follow that, and again, ended up doing a lot of good work. Barcelona Football Club, Vogue, Tatler. We had amazing clients and a lot of good work, but the hours were horrendous, and I just got fed up with having to give up my evenings and my weekends for work that I could be doing something more enjoyable with regarding my time. So that's when I started looking into branching out, doing more with my money, and that's how I then came across my mentors who taught me how to trade. Now, as already mentioned, what I needed, and this was really important, and I think a lot of people can resonate with this, is that I needed a style of investing or trading that wasn't another 9 to 5. I needed something that adapted around my lifestyle. So I didn't want to be looking at my charts all day or having to read the Financial Times or, keep up to date with what was going on Bloomberg. Not because I didn't have an interest in it, but more because I just did not have the time. And that was crucial to me. So I needed a style of trading that could be adapted around my lifestyle. And this is where long-term trend trading came in. It just resonated with me at the time. And as I got more into it, I realized that trend trading is not just about money. It's not just about growth. It's about time, and ultimately that's what people want more of. See, if you want more time, if you want more money from your job, from your career, generally what you need to do is put in more hours. That's the way it works. If you want to cut back on your, if you want more time rather, then what that means is you're going to have to cut back on the hours you do. So you're always compromising. There's never a point in time where you have complete control of your time and complete control of your money. We're always compensating one for the other. This is where trend trading comes in, and I didn't initially fully appreciate this, but as I went on through my trading, I realized that this was the way forward regarding control of my time and control of my money. And so I hope that I'll be able to get this message across through the presentation that I'm going to do today. Okay, so let's start getting into the charts. Let's have a look at how I do this. So we're going to focus on the foreign exchange market, and we will then branch out and look at a few stocks that I'm in as well, just so that you guys can see that this information is transferable across all the markets. I trade foreign exchange, I trade stocks, UK and US, and I trade commodities. And it's essential that you guys expand your portfolio. Don't just focus on the foreign exchange market, because the foreign exchange market is not always liquid. There aren't always trends. So you want to go to where the money is. If the trends are in stocks, go to stocks. If the trends are in commodities, go to commodities. Don't always focus on foreign exchange. Okay, so what you can see in front of you is a typical chart setup of mine. So I've got 4 screens, if you like. The one on the top left, this is my watch list. So if you notice, it's the Aussie dollar, US dollar at the top, and it goes all the way down to the South African rand, Japanese yen at the bottom. So it's an extensive watch list. I don't just have the euro dollar or gold or just the majors or something that I am comfortable with or I have an attachment to, like, you know, I like the US dollar, Japanese yen. That's not the way you want to approach trading. You don't want to use words like and love and no. You know, you don't want to bring attachments to trading. Your attachment to trading or to any instrument should only be for as long as it's paying you. As soon as it stops paying you, you have to move on. Find another instrument that will pay you. What tends to happen is that a lot of the times people go on the internet, and I've seen a lot of misleading information on the internet. Sometimes I've read things like, in fact, a lot of the times I've read things such as traders, focus on 1 or 2 currencies and really get to know them very deeply, get to understand how they move. And by understanding how they move, that's how you'll then be able to extract money. That's a complete fallacy. That's very incorrect. Ultimately, the market does 3 things. It moves up, it moves down, it moves sideways. If it moves up, it's a bull market. If it moves down, it's a bear market. If it moves sideways, it's a consolidating market. When one currency is moving up, another currency may be moving down or moving sideways. What we want to know is where are the most lucrative opportunities, and that is when either the markets are moving up or down. When the market is moving sideways, you want to be standing aside. If you have an attachment to just a single instrument, you may be trading it at times where it's lucrative, i.e. moving up or moving down, but there's a lot of the times where that one instrument may be moving sideways. So if that one instrument's moving sideways, let's say the euro dollar, then you want to move to something that is moving up or down, let's say the pound Japanese yen. So it's essential to have a big watch list, because you need to know where the movements and the trends are at any moment in time. Now, usually people get freaked out by such a big watch list because they're very used to having 1 or 2 instruments or a handful of instruments. But handling a watch list is actually very, very simple, and I'm going to explain how this is done. First and foremost, the thing to note is that currencies move in groups. So what I mean by that is, let's say all the pound currencies may be trending. Pound dollar, pound Aussie, pound CAD, pound yen, pound Swissy, anything that's paired to the pound, that would be in trend for many months. When the trends dry up, then the trends tend to move to another group. It could be all the yen currencies, Aussie yen, CAD yen, Swiss franc yen, dollar yen, pound yen, etc., etc. Then the yen currencies stop moving, and then another set of currencies may start moving. So by understanding which group is in trend, we can then narrow it down further to the best 2 or 3 that are worth trading. So you can see how the watch list is managed. You go from a macro picture, so I've got everything on my watch list. I then narrow it down to the group that is in trend, let's say all the pound currencies, which may give me, I don't know, 8, 9, 10 options. I then narrow that down further to the best 2 or 3 that are worth trading. And what I then do is I hold those positions and repeatedly scale in and compound as the trends develop. Okay, so that's a bit on the watch list. Okay, guys, I hope whatever I'm saying is clear and it's easy to understand. Of course, if at any point you have any questions, I'm sure Simon will stop me and I can answer them. I'm happy to answer any questions that you have. Okay, now let's move on to the monthly time frame. Just so that you're aware, in the top right corner, I have the monthly time frame. In the bottom left corner, excuse me, I have the weekly time frame. And in the bottom right corner, I have the daily time frame. Monthly, weekly, and daily. So if I'm looking at long-term opportunities, I want the time frames to allow me to trade in that way. So if I'm trading on the daily chart, I only need to know what's happening at the beginning of the day and at the end of the day. Whatever is happening intraday, I don't need to get caught up with. And so that's why I found trading long term and using technical analysis very, very powerful for me, because I could adapt this around my job as a photographer back when I started, guys, which was in 2007. So I've actually been trading now for almost 10 years. It took me 4 years to become a full-time trader. So 2007 to 2011, it took me 4 years. It's a bit of a journey. I know a lot of people want to quit their jobs and get out of the system. I get that. We all want to, we all want out. Not many people enjoy what they're doing, and trading, they understand, is their way out of it. But don't be in a rush to quit your job, especially if you're earning a good salary, because the strength of trading is to leverage a salary. If you don't have money, you don't have anything to leverage. And I know there's a lot of claims out there that you can start a broker account with £50 or £100 and you can double it every week or every month. But the reality is that it's very unlikely to happen. So by having a job and a salary coming through and then trading your money in the background, you can then leverage your salary to huge sums of money that no bank will ever give you. And if you give yourself a time plan, let's say 2 to 5 years, you can quit the system, you can walk away from your job. It's more than possible, but you've just got to allow yourself the time to get to that stage. Don't fall into the hype of thinking this is a get-rich-quick scheme. It isn't. Okay, so let's focus on the monthly chart. Now, why is the monthly chart so important? The monthly chart is important because it gives me a very clear picture of the overall price, the overall structure of the market. It gives me a very clear picture of support and resistance levels. So I'm going to load these up. The first support and resistance level. So I draw my support and resistance levels on the monthly time frame, not on the weekly, not on the daily, not on the 4 hour, 1 hour. Monthly is drawn on the support and resistance is drawn on the monthly time frame. So the first thing that I'm going to bring up are these pink lines. That is the high and the low and the close of the previous calendar year. So January to December 2015. As we're in 2016, this is the high and the low and the closing price of the previous calendar year. Don't mistake these for Donchian channels and Donchian 52. These aren't rolling support and resistance. These are static support and resistance based on the high and the low of the previous calendar year. Now, why are these levels so important? For me, these levels are significant because it helps to start creating a bias in price. And this is something that people really need to start understanding, because in trading, nothing is guaranteed. It's only ego that will say, I know that this is going to reach this level, or it's going to reach this high, or it's going to hit my target. That's ego. There's no guarantee. The one thing that we know about trading is that the future is uncertain. However, by understanding price action and understanding probabilities, you can then understand environments where you have more chance of making money than losing money. This is what trading is about. It's about developing high probability environments. What you want to think of is what you want to think like, rather, is the casino. You don't want to think like the punter that goes into the casino. You want to be the casino. The casino always has the advantage, the edge. A casino may lose money every single day, but at the end of the year, the casino is always in profit, and massively in profit. So you want to think like the casino. And how does the casino operate? The casino operates by having an edge, a 55%, 45% ratio, if you like, in their favor. Now, it could even be 51-49. It doesn't matter. The point is that there is an edge that's in their favor, and it's that edge that then makes them vast sums of money on a regular basis. So how do we, as private traders, start developing this edge? And this is important, guys. The edge is all important. If you can't define your edge, you don't have one. This is a very, very important point. If you can't define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does, because ultimately this is a win-lose game. So you must be able to define your edge. And not only that, you must be able to apply patience to allow that edge to develop. And this is another trait where traders struggle with: patience. Why do we struggle with patience? Why do traders struggle with patience? Because we are taught to make money in a particular way. The way we are taught to make money is a salary. It could be an hourly salary, it could be a weekly salary, a monthly, I don't know. You know, there's various ways that people can get paid a salary. But ultimately, you go to work, you do a certain amount of hours, you get rewarded for it. That's the way we are programmed to make money. In trading, and so what happens is then people then transfer that mindset into the markets, and they then look at trading as a 9 to 5, and they try to extract money like a 9 to 5. So they have in their idea that all I need to do is make 20 pips a day, or 10% a week, or I'm happy with 100% a month. People have a fixed idea of the amount of money or pips or percentages that they want to make. And then what happens is that you will overtrade till you start hitting your targets. And it's through overtrading that people then end up blowing accounts. And this could be through taking bad trades, through over-risking, breaking your own rules, not having rules. There's just so many reasons why people end up blowing accounts. And one of the main reasons is because traders don't have an edge, and they don't know how to apply patience. And it's through chasing money. Let the money come to you. This is what trading is all about. So, how do I use these pink lines? First and foremost, I want to see price. So what we can see is current price action. We can see that price is inside these pink lines. If price is inside these pink lines, for me, price does not have an edge. And you can see very clearly, if I take price back, here is a nice trend. This was the recent trend, several months of trend. Since then, the market's just been going sideways. This is what is known as a consolidation. And it's inside these pink lines. That for me is enough reason not to be trading the Aussie dollar, US dollar. What I want to see is price above the pink line high, telling us that we have a bullish bias, or I want to see price trading below the low, telling us we have a bearish bias. So, looking at my watch list, you can see how quickly I can dismiss currencies. So Aussie dollar, US dollar is inside the pink lines. I'm not interested. Next one on my watch list is the Aussie dollar, Canadian dollar. You can see that the Aussie dollar, Canadian dollar is inside the pink lines. It's now pushing up. If it breaks above the high, I may start looking to trade this. But for now, it's inside the pink lines. I'm not interested. Aussie dollar, Swiss franc. Again, you can see it's inside the pink lines. I'm not interested. So you can see how quickly I can go through my watch list to then find the currencies which are either trading above or below the pink line. So let's take, for example, the Aussie dollar, Japanese yen. You can see the Aussie dollar, Japanese yen is trading below the pink line. So price has a bearish bias, and this is where I could take potential short opportunities. Let's go to the pound currencies. If you look at the euro pound is trading above the pink line, so it has a bullish bias, and this is where you want to be looking for long opportunities. If we go to the pound dollar below the pink lines, bearish bias. Pound Aussie dollar below the pink lines, bearish bias. So this is how I look for the group of currency that is in trend. So we went through a few Aussie currencies. They're all pretty much inside the pink lines. I'm not interested. If you look at the euro currencies, let's have a look at the euro dollar. Euro dollar, it's inside the pink lines. Look at the euro Aussie dollar, inside the pink lines. So all the euro currencies are trading within the pink lines. Let's go to some of the New Zealand dollar currencies. New Zealand dollar, US dollar, inside the pink lines. New Zealand dollar, Canadian dollar, inside the pink lines. Hi Simon, you coming in?
Yeah, Zaheer, Joaquim, it just says, how do we define the pink lines? It's not always the lowest or the highest as I can see. Is this a time, maybe a time frame thing?
No, the highest and the lowest will be unique to each chart. So this is the highest point of 2015 on the New Zealand dollar, Canadian dollar. This is the lowest point in 2015 on the New Zealand dollar, Canadian dollar. If I go to, let's say, the New Zealand dollar, Japanese yen, then of course the New Zealand dollar, Japanese yen will have its own high and its own low based on what's happened in 2015. So the high and the low is unique to each chart price action of last year.
And it's for the year. I think that's maybe the critical thing there is we're looking at the year to date.
Correct, exactly. So this is not January. This is not January. This could be, this could be May. Maybe it reached the highest point in May and the lowest point in April, for example, and then stayed within those points.
Yeah, fantastic. Thanks for clearing that up. Yeah.
Okay, no problem. Okay.
Oh, sorry, Zaheer.
Go ahead.
Just before we go, sorry, I missed. George, he says, how do you recognize if a tradable trend is surfacing?
Breakouts. Simple as that. Let the market break out. This is where patience comes in. So if you've got a level of support or a level of resistance, and I'm going to go through this actually, I'm going to answer this in a second, but ultimately what I'm looking for is a breakout. So I want price to break and close at the end of the day. If it hasn't broken at the end of the day, intraday reversal, I'm not interested. I want to break and close at the end of the day.
Right, okay.
All right, is that it? Shall I carry on? Or is there another question?
Just a follow-up to that question. It says, do you trade on a monthly chart? Then can it be used on H1 and M5?
H1 is what, 1 hour, and M5 is what, 5 minutes? Is that correct?
I'm guessing, George, that's what you're referring to, yes. Yes, he is,
okay.
Yes.
Okay, so, I mean, my answer to this is, if my grandmother had wheels, she'd be a bicycle.
Okay.
My point is, they're two different things. They're two different things, and I always get asked this question: can I take these principles and take them down to a lower time frame? And the answer is you can't, because a lower time frame you have a lot more candles, a lot more noise, a lot more intraday support and resistance levels. It's just, and in addition to that, and this is the most important point, when you move to a lower time frame, the price action starts to become unpredictable. When you trade on a larger time frame, price action becomes more predictable, because there are patterns that repeat, and these patterns are far easier to engage on the larger time frame than they are on the lower time frame. So it's very, very difficult to replicate what I'm showing you now on a 1 hour time frame, particularly a 5 minute time frame. I would get people away from looking at the 5 minute time frame unless you're looking to enter. If you want to enter into a trade, sure, 5 minute time frame, you can do that. I wouldn't recommend it, but you can do. But your stops should never be managed on a lower time frame. They should always be managed on the larger time frames.
Got you. Thank you. And just before you start again, Norman's asking just to reiterate what the pink lines are again.
Yeah. Okay. Let me bring up my tool. All right. So, guys, the pink lines represent the previous high, the previous low, and the previous close of the previous calendar year. So this is the highest point of 2015, the lowest point of 2015, the closing price of 2015. In fact, we don't even need the closing price. Let me just take that off. So we got the high and the low of the previous calendar year. When 2017 starts, my software will automatically change this to the high and the low of 2016. When 2018 starts, the software will highlight the high and the low of 2017. So this is the high and the low of the previous calendar year.
Okay, great. Thank you.
Okay, right. Thanks,
Super,
Simon.
thank you. Yeah.
Okay, brilliant. Okay, so let's move on, guys. Let's move on to the next point. The next point I want to mention is, let me stick to the Aussie dollar, US dollar. Okay, so the next point that I want to mention is what are the next major levels of support and resistance? I have a tool here which highlights what I consider major pivots. Now, remember guys, at the very beginning I mentioned that as private traders, we have a very different approach to institutional traders. Why is this? Well, ultimately, institutional traders have government laws and regulations that they have to follow. As private traders, we don't. In fact, if you're here in the UK, you even have the added advantage of using spread betting accounts, which are tax-free. So we are at a massive advantage. Now, where this goes wrong for a lot of private traders is that because we don't have laws and regulations that we need to follow, we're ultimately in a lawless environment. And what this means then is we have to create and define our own laws. And this is where people then struggle, because if you don't have your own laws and regulations in place and able to follow them, you then start trading in environments that you should not be trading, and this will then potentially lead to losses and blown accounts and frustration, etc., 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 etc. Okay, so what I have here is a tool which highlights major pivots. Now, for me, a major pivot is a pivot point that has a minimum of 10 bars on either side. So you can see that this red line, if you look to the left, it's highlighting this point right here. And this point, if you count to the left, has a minimum of 10 bars to the left and a minimum of 10 bars to the right. If we look at the lowest point right here, this is highlighting a major pivot support. So we've got 10 bars to the left and 10 bars to the right, minimum. Me is what is considered a major pivot, and these are significant. You can see for yourself how these pivots are actually causing reversals. So if one of these pivots is broken, then that's a significant move to the downside if it's a support level, or a significant move to the upside if it's a resistance level. So you can see right here that this major pivot is holding strong and price is not breaking through this major pivot. In addition to that, we have the low of 2015 and we have the round number 0.7. Round numbers are every 1,000 pips, guys. It's very, very important that you guys understand round numbers. Why is it important to understand round numbers? Because all too often, people set a fixed risk to reward ratio, 1-to-1, 1-to-2, but this goes against the fundamentals of trading and investing, which is the trend is your friend. If you start having take profit levels, you're actually minimizing the potential profit that you can make. And what is this based on? This is just based on fear. Set a profit level so that if price hits your target, take it. Whereas if you're in a negative position, hold on to it just in case it reverses in my favor. You want to reverse that whole logic. You want to cut your losing trade short and you want to allow your winning trades to run. A good way of knowing how to allow your winning trades to run is to use round numbers. So if you look at the highest point on this chart, it's 1.1. That's a round number. The next round number is the figure 1. So on currencies, round numbers are every 1,000 pips. So 1.1 to 1 to 0.9 to 0.8 to 0.7, and you can see that price has stalled at 0.7. Is it a surprise? No, because it's a round number. After every move, the market consolidates, and you can see it's consolidating between 0.8 acting as resistance approximately and 0.7 acting as support. Once you can understand your levels, you can then understand how price is going to move. And this is across the board. This is not just on foreign exchange, this is also on stocks. I'll explain it in stocks once we get a little bit more into this. Okay, so guys, these are my 3 points of support and resistance that I use. The pink lines, they act as support and resistance, but they also help to give me a bias. If price is inside the pink lines, I'm not interested. I want price either above or below, giving me a bullish or a bearish bias. I then have this proprietary tool which automatically highlights major pivots. A major pivot is a minimum of 10 bars on either side of the pivot. And the next point I look at are round numbers. Round numbers are like my levels that I want to see price move towards. So if it breaks one round number, I want to see price move to the next round number. And that's why the monthly chart is very, very useful. Okay, now when it comes to the weekly and the daily chart, the weekly and the daily is where I'm looking for trend alignment. This is where I want to see the weekly and the daily charts moving in the same direction. The way to look at it is that the weekly is big brother and the daily is little brother. If the weekly is moving up, I want the daily to also be moving up. If the weekly is moving down, I want the daily to be moving down. If the weekly is moving sideways, then the daily should be moving sideways. If the weekly is moving up and the daily is moving down, then we may have a correction in the market, that we could be seeing the end of trends. It's ultimately an environment where you want to apply caution because the weekly and the daily are not moving in the same direction. Okay, so how do I do this? Well, the first thing I like to use is the 200 simple moving average. Okay, price source close. This is on the weekly, and the 200 simple moving average on the daily. Now, why do I use the 200 moving average? Well, the logic to the 200 moving average comes from before the internet. And this is really important, guys. You want to learn to put into practice techniques that came from before the internet, because those are the techniques that work. Since the creation of the internet, we've been led astray. As private traders, we've been led astray to go down the route of quick moves, scalping, short-term trading. And it can work if you have the funds of a bank. Banks have billions of dollars and pounds to play with. As private traders, we don't have the funds of a bank, so we need to be different. We need to be smarter. We need to have a slower, more methodical approach. And that is why we need to start understanding some of the techniques that were used before the internet, used by people like Warren Buffett, George Soros, Turtle Traders, Jesse Livermore. These guys made vast sums of money using long-term techniques. Okay, now the 200 moving average was significant. Why? Because old school traders used to draw everything by hand. Charts were drawn by hand, moving averages were calculated and drawn by hand, and so they were very particular about the information they put on their charts. The 200 moving average was a proven indicator of the long-term trend. We still use that today. In fact, institutions use it today. Okay, and so that is a staple on my chart. Now, what I want to see is, in a bear market, I want to see price below the pink line on the monthly, below the weekly 200, and below the daily 200. If I have any other combination, I stand aside. Now, remember, guys, I mentioned that you must have an edge. I'm now starting to explain to you my edge, and you'll be able to notice that through this presentation, I'm very clear on the rules that make up my trading. Very, very clear. So, for bearish opportunities, I want to see price trading below the pink lines on the monthly chart, below the weekly 200 moving average, below the daily 200 moving average. In a bull market, I want to be above the weekly 200, above the daily 200, and I want to be above the pink line high. If I have any other combination, I stand aside. So if you look at the Aussie dollar, US dollar, we're inside the pink line, below the weekly 200, above the daily 200. We have no alignment. And we can see very clearly price is going sideways. Now, if I go to a currency that looks more interesting, let's have a look at the euro pound. Euro pound trading above the pink line. If I open up the monthly charts, you can see that price, just expand the chart, price is trading above the pink line. And it has been now for 1, 2, 3, 4, 5 months. So we have a bullish bias. Now, the reason why I won't take any long opportunities is because we have a major resistance level here. We have the round number 0.9 and we have another here. So we've got 1, 2, 3 resistance levels. So this is not a currency that I'm looking to go long on at the moment. But just to start giving you an idea of how to develop a bias, above the pink line on the monthly chart, above the weekly 200, above the daily 200 moving average. So I'm starting to tick the boxes, tick, tick, tick. The reason why I wouldn't take this trade is because I've got major resistance ahead. There's a cross, and that's why I won't take any long opportunities. And I definitely wouldn't take any shorts because this is going against the major trend. And this is where a lot of people go wrong. What they're looking for are reversals. People try and predict tops and bottoms. It's a very, very difficult way of trading. What you want is to allow a trend to establish itself and then go in that direction. Sometimes the market may be faced with support or resistance. This doesn't mean you go against the trend. It means you wait for the market to break through, then find an entry point. So let's have a look at the pound dollar. So the pound dollar is trading below the pink lines. You can see there's the pink line high, there's the pink line low. Price is trading below the pink lines. It's also trading below all these major levels. So if you look at, let me just bring up my crosshairs. Okay, so you can see with my crosshairs right there, you can see that that is the lowest major support level from this pivot here, which is now acting as a resistance because price is below it. Remember, resistance becomes support, support becomes resistance. So support here has become resistance. Now, why is price struggling? Well, it's been struggling because of the round number 1.3. Let me just move this out of the way. There's a round number there, 1.30. And you can see that price has been struggling. However, we're now starting to see weakness. If we go to the weekly, below the weekly 200, and below the daily 200. If I open up the daily chart, and this should answer one of the questions which was asked earlier, which is how do you know a trend is in play? For me, I look for breakouts. So we can see very clearly the market's been going sideways. But from this point here, which also happens to be the high of the range, the market is heading down. We've had a bit of a gap. It's been a bit of a strange start to the week, a tiny bit of a gap, and we've had a further decline. Excuse me, we had a further decline in price. This is the pound dollar. If I go to the pound Aussie dollar, you can see that the pound Aussie dollar has the exact same setup. Below the pink lines on the monthly, below the weekly 200, below the daily 200. If I open up the daily chart, we can see another bit of a gap, and we've had weakness to the downside. Now, a break and a close below this pivot support, and that will suggest a trend continuation. So I am already short on the pound dollar, I'm already short on the pound Aussie dollar, and I'm also short on the pound Japanese yen. Why? Because below the pink lines, you can see this was the move, guys. You see this move to the downside, which was from just below 180 all the way to around 150 before Brexit. That was a move of 2,500 pips. I was short all the way along this move for several months, but then closed my position off in the week of Brexit. But the point is now we are starting to see further weakness. Below the weekly 200, below the daily 200. If I open up the daily chart, so this is where I started taking short positions. If I just go back here, it was around just below 180. So around this level here, this is where I started taking short positions. And you can see that price went from 180 to 170. From 170 to 160, and then 160 to 150. And it was around this level here where I closed my position because the market started pulling back, and there's your Brexit. If I had stayed in this trade, then of course I'd be in further profit. What I'm now looking for, and I already have short positions, I've reopened my short positions, which are in good profit, a break and a close below this support level, and I'll start compounding. scaling in, adding more positions. I never close my positions based on price being near support or resistance, based on fundamentals, based on NFP. I have well-placed stop losses, and I compound strategically until my trailing stop losses are triggered. Okay, now this is let's take things further. Let's take things another step forward. In trading, the challenge to trading, and this is where a lot of traders will naturally, of course, struggle, especially in the beginning, is holding positions when the market is going against you. So if I go to the daily chart, I was short on the pound yen. So we're looking at the pound yen. This is a daily chart. I was short on this for several days, several weeks, and then there was this pullback. So you can see that it's quite a deep pullback. And this is where traders struggle, because the market's gone against them and they close off their positions, they're panicking. However, by me understanding levels and support and resistance and having well-placed stop losses, I held out, and the market then corrected. Market pulled back again, remained within an area of consolidation, broke out, went back in, and then broke out again. So it's these pullback periods where traders struggle. How can you make it easier to hold in these positions? And the answer is to use some kind of trend filter. So I have a proprietary trend filter. Excuse me, guys, I've got a bit of a dry throat. Okay, so I've got a proprietary trend filter, and you can see that if I go to the weekly chart, the trend filter highlights areas of bullish trend and areas of bearish trend. Instead of having your standard red and green candlesticks, I've got a trend filter which just gives me the overall direction of the market. And this removes the emotions that come with holding positions when the market goes against you, because my trend filter is saying to me, don't worry about the market going against you. The overall market is still bearish in this case, or bullish if looking at another instrument. On the daily chart, there will be little periods where the market turns green because there's a lot more candlesticks, but you can see that the overall market conditions have been red compared to little patches of green. So what I'm looking for is the weekly and the daily to not only be below the 200 moving averages, not only below the pink lines, but I'm also looking for my trend filter to tell me alignment. So I want both the weekly and the daily to be red, or both the weekly and the daily to be green. And this, guys, is my edge. This is what I'm waiting for to develop, so that I can then start looking to allocate risk to the market. Now, if I don't have a setup, in foreign exchange, then I could have a setup in stocks. And this is why it's very, very important to trade stocks or look at stocks. Now, a stock that I've been in for several months is Nvidia. I'm sure a lot of you guys are familiar with Nvidia. Nvidia is a company that deal with hardboards and motherboards when it comes to computers. Okay, so you can see that if I take back price action here, which is the start of the year, you can see it's 2016, and we can see that the market has continued to rise up. It broke through the all-time high, which was around $40, and this is when round numbers come in useful. I want price to go from $40 to $50, 50 to 60, 60 to 70. Ideally, I want to see price reach $100. So $80, $90, and $100, because $100 is a major figure. If it fails at any point, I have a trailing stop loss, which is following price, and my trailing stop loss would get triggered. I've got multiple positions running long across this trend. Now, if we go to the weekly, above the weekly 200, trend filter is very much green. Above the daily 200, trend filter is green. So you can see that this knowledge, which I started off in the foreign exchange market, is transferable to the stock market. A UK stock that I am in is Boohoo. All right, and you can see that Boohoo has just been rallying month after month after month. Weekly chart, there's not enough information to allow for the weekly 200 moving average to be displayed, but it's in a bull trend. The trend filter is green. If we go to the daily chart, above the daily 200 moving average, and the trend filter is green. Now, what's interesting about this is that price is now above 100, and we can see that there's been another move to the upside so far, a break and a close above this, and I can start looking to compound, add new positions, or if you're not in this will be an opportunity to start entering positions. Okay, so guys, that is as simple as I like to keep my charts, and as clean as I like to keep my charts, and as simple, if you like, that I like to do my analysis. A good chart should scream at you. A good chart should tell you, hey, trade me, or don't trade me. If you find yourself staring at a chart, then you're looking for something which is not there. Okay, Simon, if I...
Zaheer,
yeah?
Yeah, no, a few questions.
Sure, of course, brilliant.
George, I can see, is left, so let's go on to David. David says, aren't trading costs and spreads pretty horrendous for most of the FX pairs on the extensive watch list that you've shown?
No, it's a complete fallacy. I'm not sure where a lot of people, I mean, yeah, you know, it's important that you use the right broker and that you're aware of your spreads, etc. That's true. But so paying spreads are part and parcel of trading, and that's one of the reasons why people limit their portfolio, because they're so focused on getting the cheapest spreads, and they think that the cheapest spread is what's going to make them money. I'm happy to pay 10 pips or 20 pips in a spread because I know I'm going to walk away with thousands of pips when a market is in trend. So spreads, the way to look at it is that trading is a business, and that spreads are simply a cost of running a business. I typically trade, let's say, 50 to 100 trades a year. I hardly pay anything in spreads, in rollover charges. In some of my accounts, such as IG, I use future contracts. So I may have a more initial expensive spread compared to a daily funded bet, but I don't have any rollover charges. So my spreads are, you know, what I pay in spreads are minimal. Let's say I make a 40% return in any particular year. I may give away less than 1% in spreads and commissions. So it's tiny. Of course, if you're day trading and if you're taking 50 to 100 trades a day or whatever it may be, then I understand that that's important to you. But you then have to question whether that is the best approach.
Okay. What about taking profits? Asks Paul, do you take partial profits and move your stop loss to break even?
I don't take profits at all. I mean, yes, I'll manage, depending on how I'm compounding, I'll eliminate risk, but I won't take profit. My profit will only be taken at the end of trends. I want to maximize my profit. There's no point, I don't believe in having, okay, let's say, for example, you open up a position that allows you to open up 4 lots. So you split to 2 positions, have 2 lots each, and have one that you take profit on, and another one that's a runner that may return you more profit or cancel out your profit that you made on the first position. It's not how I do it. I allocate all 4 lots to one position, and I allow all 4 lots to run. And if they keep on going, I'll just keep on compounding. If I'm wrong, I never risk more than 1 or 2% per trade. So my losses are always minimal, 1 or 2%, but my returns are far bigger because I've allowed my winning trades to run, and not only that, I've compounded into them.
Okay. On the same topic, really, Tom saying, what kind of trailing stop do you like? Is it fixed or percentage based or dynamic?
Well, I've got one based on. I've got several ways of exiting. It's a really good question. I've got several ways of exiting. And this is where traders need to become good at, because everyone seems to understand entry points. You know, you can get a breakout, a pullback, Fibonacci level, bounce off a moving average. There's various ways of entering, but where a lot of people struggle is knowing how to exit and knowing how to compound. So I have several ways of exiting. My initial exit is always based on a fixed algorithm. My trailing stop loss is based on a fixed algorithm, but I then apply discretion depending on where price action is in relation to major levels of support and resistance. So I may tighten my stop losses manually based on support or resistance.
Okay, Joaquin and Betty are asking a similar question. Trending in the chart, is it your indicator or is it a standard indicator with charting software? Is it something in FXCM? Asks Joaquin.
Okay, yeah, good question.
Yeah.
Very good question. One thing that I always encourage people to do is invest in good software. Treat it as a business. Get away from using broker-supplied platforms. Get away from using free software. You know, view it as a business and look into tools that can help you develop an edge, find best opportunities, and make this as simple as possible. It's not easy, but make it as simple as possible. What I use is eSignal. Okay, guys, and by the way, I want to make this really, really clear. I'm not affiliated to any broker. I'm not affiliated to any software. This is all informational. This is all guidance. I'm giving advice on what I used that has allowed me to become a full-time trader and allowed me to achieve the goals that I wanted to achieve, which was to be able to walk away from photography and be a full-time trader. So make sure, yeah, you know, I'm not going to do it online, but if you guys want advice on which brokers to use, I'm happy to do that, to talk via email. And the software, yes, eSignal.com. Now the tools that you can see, for example, the pink line tools, that's a tool that will come standard within eSignal. So if I click on this button right here, you can see that you've got built-in studies, and there's various tools that come standard with eSignal. Now, what's useful about these tools is that a lot of them will update manually. So these pink lines, for example, they'll update manually, and you don't have to manually draw support and resistance. However, as dynamic traders, we have vast amounts of proprietary tools that have been developed by us that work within the eSignal platform. So these trend filters, they are ours. We've got an inbuilt money management system. We've got trading stop losses that will be displayed on the screen. We've got inbuilt scanners. So I can scan the US stock market within minutes and know which strategy to use in which market condition. So we've got hundreds of proprietary tools that we've developed that work within the eSignal platform that we actually give to members of our community. So you don't actually have to go out and develop these yourself. We actually give them to our members. There are certain costs involved, like all software, there's licensing involved, but once you cover the licensing, you have access to these tools.
Zaheer, thanks. Joaquin just saying, is it a monthly payment that you pay for eSignal, or is it just a one-off purchase?
No, eSignal is a data provider, market data provider, so it's charged monthly or annually. However, we get a massive discount for our members. So I believe there's 3 subscriptions. There's one that's around $50 US a month, $150 a month, and $300 a month. The package, which costs $150 a month, we get it for around $60 a month for our members. And again, this is not through affiliation. I don't profit from this. This is purely a benefit of years of relationship that we've had with eSignal. We're able to get our members a very healthy discount.
What's the website?
The website,
is it the Dynamic Trader? Yeah.
Okay, our websites. Yeah,
you're mentioning that people can get it discounted through becoming a member from.
Yeah, so if you look at the Dynamic Trader, this is our website here, thedynamictrader.com. Okay, so if you, by the way, we're having new websites. This has all been revamped. The new website should be going live in the next few days. So this is the current website. If you have a look on this, and if you then want to join onto the Dynamic Trader and get involved in the mentoring and the community and have access to the software, the next stage then is to get the discounted rate on eSignal.
Great. One last question, Zaheer, from Stuart. He says, what sort of win rate does this strategy have? Do you have any
Okay,
information?
yeah, it's a good question. Yeah, it's a good question. I would tell Stuart, is it Stuart?
Stuart, yes.
Yeah, okay, thank you, Stuart, for the question. I would say look away from win-lose. It's not about winning and losing. Trading is not about having many winners. Trading is about having large winners. So I'm often asked, what is my success rate? And I tell people, well, as an example, if I said to you, I've got a success rate of 20%, would that make me a bad trader? And most people will say yes, but what they don't understand is that my 20% are large compared to, let's say, my 50% losing rate. I'm not giving, these aren't exact figures according to my trade log. I'm just giving an example. All it takes, guys, is one trade to blow an account. It just takes one trade with one bad stop loss or over leveraged to blow a trading account. So get away from thinking in terms of win-lose. It's not about win-lose. It's about how much your winning trades are making you. So focus more on large winners as opposed to many winners. And to give an answer, a single trend, a good trend like Nvidia that I was in or that I'm in, or the pound Japanese yen, a single trend can return you 30% plus. If you have multiple trends in a year, which you technically do and you usually do across all the markets, this is how you consistently grow an account. You don't consistently grow an account by trading the euro dollar every day. You consistently grow an account by moving from one trend to another.
Well, Zaheer, thank you for that. David says, very interesting longer-term approach to trading. Refreshingly simple charts. Thank you.
You're very welcome. Shall I quickly direct people to where they can connect with me if they want?
Could you do that? Yeah, we've just got another minute or so. Yeah. So
perfect. Okay. So first of all, guys, please add me on Facebook. By the way, this is all. I don't have pictures of me having dinner, etc. This is all like professional in terms of what I do to connect with people. Okay. So you can search for me on Facebook. We've got a Facebook page if you'd like, and if you could like, all our charts go up there. Charts we're looking at, you can see this went up 2 hours ago. Lots of useful advice going up, videos, UK stocks, etc. If you're on LinkedIn, please search for me and add me on LinkedIn. And I've also got an About Me page, which is simply my domain name, ZaheerAnwari.com. Now, guys, if you want to have a month of training, I've actually got a month of training which I'm doing. It's £99 for a whole month. You get 2 strategies, a breakout strategy, a pullback strategy. You get community support, software, weekly webinars, watch lists in currencies and stocks. There's just a lot of information that goes into this. A trade log that you can keep a track of everything that you do. This is £99 plus VAT for a whole month. So if you're interested in this, guys, please check out the following website, tdtpro.trade. And finally, I've got the ebook, excuse me, not this one. I've got this ebook, which is the Almost Complete Guide to Trading, which covers pretty much everything that I have talked about today. So you can see trading bias, candlestick, support and resistance, pivot points, everything broken down into a T. And this will probably change everything that you guys understand about trading and technical analysis. Okay, so if you guys would like this ebook, then please email me on Zaheer@tdtpro.com. I've just put it in the chat box. I don't know if that goes out to everyone or just to you, Simon. I think it's just gone to you.
I'm just putting it on.
Okay, so if people drop me an email, I will get this over to them, plus information on the £99 training, which is all online. I'll get that all out to everyone. So
fantastic.
That's that. Thank you very much.
Zaheer, thank you very much indeed. Great to have you, as always. We'll keep in touch. I'll take the presenter role back from you now.
Brilliant.
And we'll all say thanks a lot. Thanks a lot.
Thank you, Simon. Thank you. Thank you, everyone. Thank you very much, guys. Bye-bye.
Bye-bye for now. Right, thank you to Zaheer Anwari. I think I've been pronouncing surname incorrectly for the past year and a half. So Zaheer Anwari, the dynamic trader. Us. Now we're just on 1 o'clock, just a couple of minutes after 1 o'clock, and I'm pleased to say we've got Steve waiting to join us. I've asked Steve to join us on a regular basis this week, just to come in for roughly 20 minutes to give us an appraisal of the live markets, of where we are in terms of the Forex markets, the stocks markets, the commodities, a quick look at the charts. So we'll go straight across to Steve now and bring him in, and we'll be able to unmute the microphone. There we are. Good afternoon, Steve. Are you there?
Hi, Simon. Yes, I'm here. Can you hear me? Hello, Simon. Hello. Interesting.
Okay, Steve's not there right now, so I'll just give him a minute to join us.
Simon, can you hear me? Simon, what's going on? Okay, I'm not quite sure what's happening here. Okay, Simon, can you hear me? Testing, testing.
Okay,
Hello.
I'm getting messages that Steve is there. Unfortunately, I can't hear.
Hello, Simon.
Hello, Steve. Yeah, can you hear me
Can
now?
you hear me now? I can hear you, yes. Can you hear me?
I can hear you. Sorry, I'm just
Right.
having. I think it's my end. My computer is.
You're in a senior moment.
A senior moment, exactly. How are you? Anyway, thank you for joining us.
Yeah, not a problem, mate. Not a problem. Yeah, no, all good here. All good.
Great. Well, shall we go straight over to you? It's probably the safest thing to do.
Yeah, probably.
There we are. I'll just explain to people. I'm just inviting you to give us an appraisal of the market.
See my screens now? Can you see my 8 screens as normal?
I can, yes. I'm looking at them now.
Right.
So what's happening today?
Well, I guess if you just let me kick off, I'll do a bit of a run through. It's quite interesting listening to the last presenter there. I very rarely listen to any educators, not that I ever did anyway, but it is quite interesting that people have different approaches. And I would say that that having this the point that he brought up that you might have a 20% win rate and you have these big winners. It's just always interesting, isn't it? Just be reminded that different people in the markets have very, very different approaches. It's almost the polar opposite to how I believe you should be a successful trader, but that's what makes the markets tick. So I guess what I'll go through today is really a bit of a rundown about how this month's going to perform. Things to look out for are certainly everything dollar-based as we're going to tick up towards the US election. Obviously, we've heard from Theresa May about the Article 50 is going to be triggered before March next year. So lots of kind of longer-term fundamental things that will let the markets exhibit a trend, but it's not necessarily, in my opinion, following a trend is the way to make money all the time. I don't care if it goes up, it goes down, if there's a trend. I make money by markets moving, and I can make a lot more money in a day by trading, buying highs, lows, buying into trends, selling into trends, than I can by sitting and watching something, exhibit a trend over a couple of months. So from being, the background I am as a prop trader, as a fund manager, etc., I just want to be involved in the markets when they're moving. It's not about being right in an opinion of a trend. It's about being right at the right time and taking the most of a move day in, day out. And that's how you become wealthy, and that's how you become a rich trader. It's by being involved in the markets all the time and taking lots of opportunities. It's not by following a trend, in my opinion. That's investing. That isn't trading. So very, very interesting. Obviously, I'm not here to tell people what's right or wrong. I'm just here to kind of put my side across and to show people the relationship of the technical side of trading, which is obviously the charts that people look at so much, and then the fundamental things that are coming up in the days, weeks, and months that are going to shape specific products, and you know, kind of what to look out for, really. So what I'll do is I'll do that today, and I'll do it all week. Maybe, you know, we have people that we can make, again, not some predictions. I'm not really kind of here to tell you what's going to happen in the future. It's more of an idea of what we should be looking at and why. So again, very interesting when we was looking at the previous presenter who said about individual stocks, something I have very little interest in trading, to be honest, because again, they are more, in my opinion, you know, for longer term investors. What he said about, you know, you're not just going to trade the euro dollar every day and make your money. Well, you are. That's what you do. That's what professional traders do. You know, it doesn't necessarily have to be the euro dollar, but it can be one of these 8 screens that you see in front of me. One of these 8 products will move enough in one day for me to make 5, 10, 15, 20,000 quid. And I trade a relatively small fund. So that's how much money is available every single day in the markets. 4 trillion is traded every day in the Forex markets alone. So this is the point. You know, if you do want to be a successful trader, you have to be involved in the markets a lot of the time, you know, during the day, during the right kind of periods of time. And that's how you make your money long term. It's not by having one big win. I've fired more traders that way than I care to mention. So again, it's always interesting to see how different people approach the markets. But when we're talking about trading, we're talking about spread betting, we're talking about intraday trading or investing, however we want to put it, it's all about being involved in the markets at the right time. So again, I'll probably focus on some things that, you know, that are exhibiting strong trends. So if you're looking at the stock markets, for example, the S&P here exhibiting a very strong bull market. Doesn't really matter what's said with regards to interest rates, what's said with regards to data. The stock markets keep getting bought up, and that's because, let's face it, there's nowhere else to put your money right now. You put your money in the bank, you get next to no interest, next to no return. If you, the reason why the stock market is being, you know, bought up and so buoyant is that people are buying into this idea that you're going to get some returns from dividends. You know, the stock markets are naturally being, you know, bought up by this remnant of QE that's still filtering through the markets. And for whatever reason, doesn't matter if we agree with it or not, you know, the stocks are certainly in, you know, a bullish mentality, and the correction will come. I think everybody is aware that, you know, we're in certain types of scenarios, economic-wise, that, you know, that could really relate to a bubble. And when bubbles burst, we all know the outcome. You know, things correct and retrace very, very quickly. So, you know, a market that's taken 5, 6 years, like the DAX has, for instance, to get to the, you know, the all-time highs, it could easily, you know, be smashed back down into more reasonable levels in, you know, a matter of days, you know, weeks. So again, you can see the chart that I've shown many, many times when I presented. It's about as simple as charts get. This is a monthly chart of the DAX, and you can see really when we start from 2011, every time the market tries to close a month towards the bottom, it's rejected and the market goes on to move higher. So big rejection, you know, kind of early 2014, all these rejections were every opportunity to start a new trend below 10,000 in the DAX. And remember, we've had loads of shocks over recent, you know, months. We've had the VW scandal that really should have sent the market crashing down and staying down, but it didn't. Then we've got the Deutsche Bank debacle. What's going to happen from Deutsche Bank with, you know, these fines, etc., etc. There's these mirror trading scandals going on, and, you know, Germany's not immune from all the problems that are happening in, you know, the global banking sector, the global economic sector, and, you know, Europe is being funded by Germany, and that it might be able to dole out plenty of debt, and it might be able to, you know, service this debt, but essentially, you know, there's only so long anything can continue that way. So we have plenty of opportunities to correct in the DAX, and that just hasn't happened because global stock markets, every time we've seen these low levels being hit, they've been bought back up because there's simply nowhere better for the 1% or people investable income to put their cash. So anytime we've tried to close below reasonable levels, you know, which I still think is below 10,000 in the DAX, we've seen people getting, you know, very, very bullish around 940, and again, you know, these lows that have been hit, you know, below 9,000. People, institutions, private investors are just lumping back in because the markets are exhibiting these bullish trends and moving up. Now that could be the FTSE, that can be the S&P, it could be the CAC, it could be the Swiss market. All stock markets look pretty much the same. When they reject any kind of sensible move downwards to get to these lower levels, they aggressively are bought back up longer term. So all you have to do is look at the weeks. I mean, I'm not showing you anything amazing here by showing you 2 trend lines, but essentially the market has found value outside of these lower levels and bought back up. So we're moving steadily in an upward trend until the market finally decides it's had enough. When we do see a correction, as I've said for quite some time now, we'll see a correction like we haven't really experienced before. And the timing of this is pretty much impossible to say. I mean, for me, it really will correlate with when interest rates get back to some sort of normal levels. Now, unfortunately, because we've messed around with interest rates, so much, we can't really get proper gauges anymore of what's right. We can't look at the CPI and PPIs, these kind of figures of inflation, and see if they're sensible or not, because we've kept interest rates so low. So we don't really know what's happening. We know that wages are pretty stagnant. We know things are going up in value and wages are not keeping up. But then we've seen a return of asset prices, mainly houses, go back to kind of pre-crash levels. So everyone is kind of thinking that they're all right, but when in real terms we're no better off, or we were substantially worse off than we were pre-crash for the average person. Obviously, there's lots of well, not lots, but there's a percentage of the population that have done very well at the financial crisis, but it isn't your man on the street. It's the richer element of society which have been able to borrow more money at lower levels and buy these assets, at rock bottom prices. So essentially, the stock market isn't going to have this major correction until we see some correlation with interest rates. And the interest rate's going to be twofold. It's going to mean that people move out of risky investments, which stock markets are. Stock markets are incredibly risky as investments go. When you're scaling into your balanced portfolio, you're looking at currency, you're looking at bonds, you're looking at commodities, and you don't stick all your money in the stock markets, because when it tanks, it tanks. And this is what people seem to have really forgot. So interest rates are going to be twofold. They're going to be twofold because when interest rates creep up, in the UK especially, people are servicing just too much debt. So that's going to come, and that's going to really affect spending. It's going to affect, lots of things. And also when interest rates get to a normalised level, and God, I mean, we could be talking 1% could be the new norm for a period of time, but then still getting 1% back of your money. All the clients I have that have 100 million plus will be moving back into cash, because they're not looking for these kind of growth. They want security. They want long-term security. So 1% is fine, and that's when the stock markets are really going to edge down. So we'll be looking for, I guess, an intraday opportunity. Then I'll be scouring the markets. Right now, maybe the pound is an interesting one. Over the weekend, Theresa May has come out and said that we're going to trigger Article 50 before March next year. So we can see that the pound has been certainly in a downward spiral. And what's there to catch it? Nothing. I mean, obviously we've said that we're going to trigger Article 50 before March, and I think we'll look back at that and it's actually as a good time in history, a good time where we can get our trade deals back in our favour. We can take some control over our legislation, our rules, our laws, not be adhering to Brussels and the bureaucracy and that kind of stuff. So it will be, but where's the pound going to be at that point? Well, it isn't going to be back to 130, I'm afraid. The pound is only going to get weaker as we move into the unknown. So we've got the lows that were made, back at 127.957. I don't see under any circumstances how that won't be tested at all. So I think really we get down to levels 125, 123, maybe down as low as 115 before the longer term buyers come back into the market. So again, if you're listening to Zaheer, he'd be selling the pound now against the dollar because he'd expect it over the coming months to go down, and that's great. That's following a long-term trend. It doesn't mean that the opportunities are only there for the sell side. There will be bounces, and when the pound bounces, it will be aggressive, because if you look at the state of the world, and I'm going back to the kind of central banks, the 1%ers, what currency is safe? If you're a central bank or a big corporation, or you're trying to diversify and buy solid long-term currency, well, it's not the yen, is it? It's not the renminbi. It's not the Aussie dollar, New Zealand dollar. There's very few really kind of stable currencies. Think about the euro. With Deutsche Bank, the UBS have said that the euro is going to get to parity at 1.0. Well, okay, the unknown is slanted towards the UK side when it exits Article 50. But historically, the UK has been very good at trade, been very good at negotiating. And, we used to rule the world. We used to have the empire. So I'm pretty sure we'll survive. Now, it might not be the same for Europe, Europe has this problem with contagion. It has the problem with losing a member state, which was a big hitter that put a lot into the system, that, you know, that gave a lot of credibility. And without the UK in that, and if the UK starts to do well, then that whole idea of contagion will come back, and who else might look to leave the European Union after that? So I tell you, for me, the pound, although it is in a downward trend, and there isn't much that's going to catch it in the short term, in the long term, and in the long term, I'm talking in trading these days, long term is a year, you know, 18 months. We could be sat here this time next year, and the pound's back up, you know, 140. Because at the end of the day, it doesn't matter how low it goes, it won't stay low for long. Because as we've seen with the stock markets, people will buy value that they perceive to be value, and keep things close, you know, to the, you know, to their investing heart, that have that intrinsic quality to them. And, you know, it doesn't matter how you view the UK. You know, we're a hard-working population that pays its dues and, you know, kind of morally tries to do the right thing. And, you know, although we might not produce so much these days, you know, our services, you know, are still, you know, very, very powerful. And we're still very good at the things that we do. And for me, I would say that it doesn't really matter how low in the short term the pound goes. There'll be obviously a lot of opportunities to buy the low points of the pound and buy it back up. So again, if you're looking for an intraday perspective, and you're looking trying to make some money, I'm not saying you buy every low in the pound, but you look for data. I mean, we've got some data coming out this afternoon. We've got the ISM manufacturing and ISM prices paid from the US. They come out at 3 o'clock. So think about that. I mean, again, the US is actually still a very big manufacturing country. So if their figures are down, then maybe that means less dollars coming into the US. Maybe that's a less demand. And we see from the low point of where the pound's trading now, the pound gets some short-term relief against the dollar. Because although it's been a heavy downtrend, any bad news from the US could mean, in the short term, the very, very short term, a light relief for these low points in the pound, and people buy the pound against the dollar. So that's the kind of stuff you're looking for every day, an opportunity. All you have to do is look at the economic calendar. I mean, it's just FX Street. You don't have to be, you know, paying hundreds of pounds, you know, for news sources. It's all there for you. Trading these days is very easy when it comes to data. You know, you don't have to pay your £2,000 a month for your Bloomberg terminal like I did as a trader. You know, these days you can get your news anywhere, and it's there for everyone to see. So you think to yourself, well, consensus for the ISM manufacturing 50.3. So if that's better than expected, pound continues to go down. If it's worse than expected, pound against the dollar could go up. Simple. Wait till 3 o'clock. There's your short-term opportunity, and you either trade the S&P, good news, bad news, or you trade the euro dollar. Oh, sorry, the euro dollar or the pound dollar cable, because it's the same thing. You know, the euro should strengthen on bad news for the US, so should the pound. So again, you go back to your charts and say, right, well, what we're looking at, very, very tight range at the top side for the euro. So if we see good US data, bang, euro comes down. It gets more pressure to sell the euro and buy the dollar. We're at the lows in the pound. So again, bad US data, the pound could go back up, get to 129, 120. Who knows? Again, it's all about understanding the relationship between what comes out from the wires and what's happening in the wider world, and then putting it into practice. So again, we're always looking for correlations. I mean, we've got the stock markets, again, a strong close on Friday. We're coming down a little bit now in the S&P, but nothing major. So again, gold, S&P goes down, you'd expect gold to go up because they're inversely correlated. Again, you've got all these different 8 products that really sum up for me. If you're looking to get an idea what the intraday markets are doing, you know, I focus on the currencies. So again, euro, dollar, dollar yen, pound dollar. Then we've got the stock markets, the Swiss market, the UK, Germany, and the US. And then gold stuck in the middle as a store of wealth, store of protection against inflation, protection of, you know, bad news. So again, what I'm looking for is if the stock market starts to come down, then you expect the dollar probably to go up, and then you probably expect you know, the stock markets then to come down. So again, you're always looking for these constant correlations and confirmation. And again, I understand that, you know, one of the best ways to make money in trading or investing is to follow the trend. But that takes time. So a trend will take time to form. It'll take time to be confirmed, and then it'll take time to get your money out. You know, if you're trading with a spread betting platform or you're trading intraday, you know, as long as you have the capital and the margin, you can make just as much money in a day. You know, if I'm trading, you know, a 300 grand account and I want to trade gold and I want to sell it at £500 a point here and buy it back when it breaks these lows, it only has to move 30 pips for me to make a good amount of money. Okay, you don't have to be sat on that trade for weeks, months, even years. And that is the whole point. When you're trading in the short term, you have to make your money work for you. So if you have £100,000 in your account, for instance, it doesn't mean that you're using that £100,000 or you're risking that £100,000. It just gives you the ability to trade the kind of size that will make you money. Now, I have worked with hundreds of traders over the years, probably thousands, and I've worked with people that had very small accounts and chipped away and made a modest amount of money every year. I've worked with people that have humongous accounts and have made colossal amounts of money in a day. You know, myself, you know, I've made, you know, huge amounts of money, you know, tens of thousands of pounds a minute. But I never got to the kind of stage where I was trading a big enough prop trader account where I can make millions of pounds a day. But I've managed to mentor people that did. And it's a different type of mindset. You know, again, I think the whole point about investing, trading, doing these things for yourself is you have to understand what's right for you. You know, some people can trade £1 a point and be happy with that. Some people can trade £10 a point, make the £500 a day, and they're happy with that. Other people need to trade £500 a point, or average into positions of thousands of pounds a point, and that's how they make their money. There's no right or wrong way of making money, to be honest. As long as you make money and you make more than you lose and you control your downside, then that's how winning's done. That's how trading's done. So for me, it's really understanding and respecting the overall trend, but knowing that you can buy or sell at any given moment in the markets. And as long as you get the right type of movement, okay, and that right timing with buying or selling whatever product it is, you can still make money. And for me, I sit here every single day mentoring traders with all different types of trading style. And it's not for me to tell them if they're right or wrong. You know, if you're making money, then it's right. When you're losing money, obviously something's gone wrong, so we readdress and look at why that money was lost. But at the end of the day, you know, it's not for me, Steve Ruffley, to say, you know, what is the right way to trade, to invest, or whatever. I'm just telling you that there are different ways in doing it. And naturally, we find the way that we want to trade. It becomes a self-fulfilling prophecy. It's very much like some of my favorite, you know, kind of like world quotes. You get the life you deserve, or the life you want. And that is true. And you get the trading style you deserve, the trading style you want, because your body, your mind forces you into that. And you just find a way that you're comfortable with. And again, taking a loss is all part of trading. It's just knowing how to take a loss, when to take a loss. Because again, you know, the last presenter said that, you know, one trade, you know, can wipe you out, and it's right. But the whole philosophy of trading is one trade can make you, but shouldn't break you. So all you're trying to do is be involved in the markets for as little amount of time as you can, because the less amount of time you're involved in the markets, the less amount of risk you have. So if you're holding something for months, you have all sorts of things that could affect your position. You know, changes to Brexit, Trump being made president, all these things you have to wait and factor in to your trading because you don't know the outcome. But if you're holding a trade for 3 minutes and the market moves 20 pips in your direction and you get your money out, as long as you've got enough money in, you make money. Okay, now this is really where it comes down to. If you want to be right, be an investor. If you want to make money, be a trader. So very interesting. I always forget that there are a lot of people out there, you know, that still make money and do very well by doing things in different ways. At the end of the day, what I'm trying to kind of put across is, from my experience, I can help you be any trader you want to be. I'm not here to tell you what's right or wrong. What I'm here to do is been there, done it, got the t-shirt, wrote the book, wrote the software, managed the fund, hired you by, you know, fired you. I've done it. It doesn't really make any difference to me. There's nothing you can tell me that I've not done myself or experienced. And that's where my kind of power as a mentor, as a whatever you want to call me, as somebody that can be, you can pick up the phone and speak to Steve, and you know I'm going to give you a no-nonsense answer, and I'm going to tell you what is best under the circumstances for your style of trading. That's how I help people. But I'm here to be realistic. If you're trading with a £500 account, you will not be able to make a living from it. Okay? My clients tend to have anywhere between 10 and 20, the kind of smaller type traders, 1,000 that is, in their account, to my, you know, higher, more aggressive traders that have 6 figures in their account. So if you want to come along with me and you want to, you know, to make money and me to help you make money, you've got to understand the rules of the game, and that is, you know, you have to have a decent amount of money to to position yourself in the right way to be a short-term trader and to be a short-term scalper slash trend, whatever you want to call it. I mean, the whole thing is, I can sit here and say you're a swing trader, you're a scalper, you're a whatever. It doesn't make any difference to me. All that changes is the element of time. Okay, so really none of us are any type of trader anymore. You're either an intraday trader, where you're looking to adopt any style of trading, which is essentially going with the trend or buying low, selling high, okay? Or you're an investor, which means you hold overnight positions. If you're an intraday trader, it doesn't matter what style of trading you think you adopt. You're essentially just a scalper, okay? So you're looking for short-term movement, and it's just how you execute those trades. So I'd say 3 o'clock is really your next focus point for the ISM and see what that data's going to do to the markets. Rippling through the markets, we've always got this worry of, what's going to happen in America. I mean, we're only kind of 6 weeks away from finding out if we're going to have Donald Trump or Hillary Clinton. I have no personal preference. To be honest, I think America, very much like I said, you get the life you want. America's going to get the president they deserve. And that could be very frightening for the rest of the world. So that's going to be interesting. Obviously, there'll be plenty of talk about the Brexit, the scenarios, lots of rumbling from different countries. But essentially, we've only got 2 real months of trading left, and the main focus is going to be from the US. What's going to happen with who's going to be president? And think about the more general facts. I don't want to kind of go over the politics too much because it's too boring, to be honest. At the end of the day, Trump is seen to be bad. That's why no Fortune 500 company has backed his presidential race. Clinton, I don't know. I have no opinion on Clinton whatsoever, to be honest. She served very well as a Secretary of State, and she's a proper politician. Is she what America needs? Is she what the world needs? I don't know. I honestly don't know. And honestly, without sounding crass or without sounding heartless, I honestly don't care. I'm not American. I don't live there. I don't intend to live there. I'm sure it'll have, global ripples and ramifications, but what can we do? What can we do? We've got to just see what the American people want and see what happens. So really for me, the market's now tantalizingly close to the highs, and we've seen, and as I've said, that every time we have these big sell-offs, the market bounces back, because what hasn't changed is that low interest rate. Is that that promise that there's always more money. Everything's always too big to fail. And if Trump gets in, that could be the final straw that breaks the camel's back, and that could be where we see people taking the money out of a risky investment and putting it back into cash. So for me, not a great deal of movement in the markets today, so we're waiting for that 2:30 open, the cash open of the markets, then that 3 o'clock data, and that could start to send the tone for the week. So again, we've seen a very big sideways movement in the euro dollar. So we don't get to see, many patterns in the euro dollar like this. So I would say we're either going to have a false breakout to the upside, because I still think it's going to come down, but that again is having a long-term opinion. What I'd say is when the Bollinger Bands get like this, you see a breakout. So what I would see is, obviously, we've seen a spike up. So again, depending on the US data, that might be the trigger. But if not, what I would expect to see is the market breaks these upper levels here. Then we close back down here over the next few days, and then get back into this, this Friday spike. Because at the end of the day, if you want to look at the trend, I mean, if you're looking for a long-term trend, like Zaheer said, well, it's down, isn't it? It's that the euro only has more problems, in my opinion. So longer term, it's down. So intraday, you're taking that trend and going, right, well, it, because long term it's down, but I want to sell it high. So you don't start selling it here, because that means all the big traders, all the big boys are going to come in, push it up a couple of hundred ticks intraday very quickly, get all the weak short-term traders out, smash it back down, and then it'll go down. So this is the whole point of understanding how intraday markets move. They'll generally do the opposite thing that you think, and it's designed to make you think you're wrong. It's designed to make you think that you don't know what the markets are doing, and it's an age-old thing. It's the guy with the biggest, the biggest wallet wins. And when you're talking about intraday traders, if you've learnt from anybody on the internet, then you're running a 1 or 2% stop of your capital on each individual trade, being a good little boy or girl. And the markets move 3, 4, 5% in a short period of time and stop all the smaller traders out, and then the big boys make the money. I mean, that happens every single day in trading. So what we're trying to do is get in the mindset. This is where I help people get in the mindset of understanding not just yourself, because that is a massive part. A lot of people don't understand themselves when they're trading. And then understanding not your enemy, but other people that are involved in the markets, that everything happens for a reason. So you have to build these tolerances in. Now, you can read my book, you can read my blogs, I've been around forever, literally, I've done thousands of webinars, but that is the kind of, it's not the generic stuff, but that's meant for a wider audience. What I can do is drill down into an individual, and I can do that by a 10-minute conversation. All I've done my entire life is speak to traders, so there's nothing you can tell me that I can't help you with. I can't, bounce off. And sometimes people just need somebody who's been in the markets. They don't actually need mentoring. They don't actually need my advice or my help. They just want to talk to somebody who's not trying to flog them something, or who's not trying to, flog them some software, some system. And that's what I do. I've made my money from trading. So I do this kind of stuff to keep myself sharp. By speaking to other traders every day, I keep myself reminded of how markets move. So I don't really have an offering, but I guess if you want something, I'm running this kind of mentoring style complete thing. I don't know what it's meant to be. I don't know. I need to go and speak to my design team, my PR team to kind of put it out there. But what it is, yeah, I'll give you some software that I run my hedge fund on. You can have that for free. I don't want your money. And then I'll give you some time if you put some money into an account and you're a proper trader, because I like speaking to people who are passionate about the markets. And you can sit all day, talk to me on Skype if you want. You can get a discount on my book, see what I'm all about, Google me. And if you like it, that's it. It's all free. All you got to do is come to InterTrader, where I've been the chief market strategist for 7 years, and open an account with InterTrader and trade through who I trade my money with. That's all I ask. Because if you're successful, I take a cut of the spread and we make money. If we don't, nothing lost. So I always come into these sessions never selling anything, because that's not what I'm all about. We get a lot of people that make a lot of money from the trading education side, and I don't. I made what did I make? $2,500 from my book. Not because I didn't sell a lot of copies, I did, but the deal you do when you do a book deal is rubbish. You don't make that much money. So I do these things to prove that I know what I'm talking about, and that you have all the kind of access points to me that you can. And if you want to be helped, or I don't know, just want to be around somebody in trading who is actually in it for the trading rather than the kind of the name, or to kind of flog some books or flog some software, that's fine. I mean, as I say, I give my services and time away for free, because that's the only way you can build credibility, I would say, in the years that I've done this stuff. So again, just interesting, interesting stuff. Has anyone got any questions, any thoughts?
Okay, yeah, Steve, thanks for that. Okay, just a couple of questions on the Sarajit saying, isn't the downturn of the euro due to the ECB policy rather than any perceived political problems?
I mean, this is the whole point about the markets. They're open to interpretation. At the end of the day, the ECB has kept, of all the kind of Western civilizations, the lowest interest rates. And started off with negative deposit rates. I mean, what did we expect was going to happen with people like Deutsche Bank, for instance? Banks make money because they take other people's money on deposit. They go out and invest and do things with it better than other banks. That's how they do it. If you keep your interest rates, or you charge people to put money in the bank, they don't put money in the bank. So your ability to make money, it goes down. At the end of the day, with the euro, I mean, the policies are the policies. The policies of Mario Draghi are more to keep him saving face, and the European Central Bank keeping face on the world stage. It's not about improving people's lives, and people are sick of that. So that is why we're seeing this kind of unrest in the Eurozone, and especially this very bitter stance people are taking against, this migration, these desperate people, because they're not feeling they're getting a good enough crack of the whip. So why should they let millions of people in, to kind of take their jobs or take their money and be supported? So the euro, you can make any argument for the policies, you can make any argument for anything. At the end of the day, it's having an opinion. We all have them. My opinion of the Eurozone is that it's not about prosperity. It's not about keeping people, creating jobs. It's not about the right kind of policies. It's all about keeping the European Central Bank, in favour with global lenders. That's what it's all about. So for me, that's only going to drive the euro lower, because the pound and the dollar are just better alternatives. Even with Trump at the helm, I would still be buying dollars, under Trump, than I would be buying euros under Mario Draghi, and that's just the way it is. I mean, again, it's difference of opinions, maybe, but it is what it is.
Okay. Do you have a target for cable by May 19, so 3-year target for cable?
Yeah, no. Why
No.
would I? No.
That's a long
Well,
way out. It is a long way out.
what I have is what I've told you, that there will be a point where that naturally it hits a low point, and the global banks, the central banks, everybody in the world just goes, that's too low for the pound, and people buy it, and that's the low, and it carries on back up. And I can see that being around potentially 115. I can't see it getting any lower than 115. I would probably say really 122 is as low as I would like to see the pound go, or that I think it can go, because there are just too many factors of uncertainty in the rest of the world. The pound is still a pretty sure bet for me. So I do think we're going to go down in the short term, because there's nothing to catch it until Article 50 is triggered, and we do get some clarity on what these trade deals are going to be, and we can talk legitimately. But let's face it, guys, politicians, who can trust politicians? We can't hold any formal trade deals, but you don't think there's representatives travelling here, there, and everywhere between now and March? Of course there are. Politicians can't be trusted for anything. They're dirty, slimy little people. So of course they're out there making backroom deals and that kind of stuff. So these things will happen a lot quicker than people think, because that's how politics works. So once it's triggered, we know what the score is. People go, actually, that's a good deal with China. That's a good deal with Canada. Bang, let's buy some pounds because they're going to be all right. So however low the pound gets in that uncertain time, it will be bought back up. So I don't think we get below really 122. If we do, we take a quick drop down to 115. But then that's as low as it'll get for me. So I don't know. What more can I say? I can't tell you that it's going to happen in 3 years' time. That's just nonsense. I can tell you that in the short-term targets, realistically, it's psychological levels we're looking at now. So the 120s, the 115. There are no real technical levels to get back to. So it's all psychological round numbers that the market will push to, and the media will present to us. So around 120, yeah, 122. That's where I see the pound getting before March, and then after that, to be honest, I reckon we're back at 140 in the space of a year.
Okay. One final question, Steve, if you can. It's money management. Joaquim says, with an account of 15,000, realistically, how much can someone make per day, and how much can be risked with that amount?
Okay, well that's a very good question. Now, £15,000, you can realistically, with anywhere between £10,000 and £30,000, you can make £500 a day. That is there. The risk side of it is very difficult, because I have to understand what type of trade you are. Anyone can make £500 a day in the markets, because that is that is easily done. If you're staking £10-15 a point, which you easily can do on on a £15,000 account. See the movements in the market intraday to make that kind of money. But it obviously then is mirrored with the downside. Now, what you have to kind of understand is that if you're willing to make £500, then you can only really be willing to lose £500. But this isn't the reality of trading, I'm afraid. This is not the reality. Sometimes you might have to risk £2,000 to make that £500. And that's the whole point about what people don't understand in intraday trading. Sometimes you have to take more risk than is traditionally allowed, in air quotes, for that particular trade to then make the money. Now, this is why I work with people individually, because everybody's different. Some people need a finite stop, an amount of money, or a finite stop, an amount of ticks. Other people don't. The most successful traders I've mentored have a flexibility, and that is having anywhere between 1% stop and 10% stop, and then still having a target to be made every day. But it's more important, it's all about having weekly winners. So winning by the end of the week. So realistically, on a £15,000 account, you can aim to make £500. But in that £500 a day, you have to understand that there could be a £1,000 down day or a £1,500 down day. So you've got to kind of really look at it not daily, but kind of weekly. So if you can make £500 a day, yeah, that's £2.5 a week. But then you might lose £1,500 of that. So you're only making £1,000 a week. But that's £4,000 a month, £48,000 a year if you look at it in rough terms. So again, it's understanding the short term, putting it into the medium term, and for the long term. That's really where I come into my own and help people, because it's not something there's a generic rule for. You have to understand there's many different elements that go into being able to make money from week to week, month to month, year to year. So hopefully that answers the question.
Thank you, Steve. Yeah, just reiterate again. You mentioned you take people on as a mentor,
Hmm.
and how long will you spend with the trader? How long is this, a weekly, monthly? What?
Again, there's no point in me putting exact figures down because it's different from different to people. Sometimes people need a 15-minute conversation and on the way. I had a particular client, I spoke to him for half an hour and he went on a run of 29 winning days. And then he lost 30 grand in a day and we had to have another good conversation, a good chat. But then, he ticked back over the days. I will give anybody that wants to talk to me and put some money in an account and show me that they're serious, I'll give them, a good hour to chat to, like this over Skype, and then we'll figure out what support is needed. Sometimes it's a 5-minute conversation a day. Some people are happy just to chat over the chat window. It's impossible for me to say, but if you're someone with £500 in the account and you want to be a millionaire, then you're not the kind of person that can help. If you're somebody with between £5 and £100,000, you want to be a serious trader, you want to make some money, you're passionate about it, you got some ideas, they're the kind of people I can help. I can help realistic people. I can't help dreamers. I can't help the kind of quick fix, this is the latest greatest thing type person. I'm not here for that. I'm too long in the tooth. I'm too no nonsense for that. There are real things you have to show me that I can then tell you that I can help you and I can make you into a successful, profitable trader, or I make good traders great. I make great traders exceptional. That's what I do. That's a skill that I have. And I'm not trying to blow my own trumpet. I wouldn't have been around this long if I didn't do these things. So it depends. Each case is individual. You have to come to me. I will speak to you. I will give you, the benefit of my experience, and I'll be honest with you. And that's it. If you want to just sit and have a chat with me, I'm 250 quid an hour, so that ain't going to work. So if you're going to put some money into an account, you're going to tell me some ideas, and you're going to, show me that you can grow as a trader, and then, I've proved I can help people tremendously from that perspective. But it's unfortunately people don't like to listen to a lot of things that I have to say because the truth isn't nice, and there's lots of people I've told just to stop trading because they're going to lose the money, and people don't like to hear that. But that's just my opinion, and again, it's based upon 15 years of being a trader and 10 years plus of helping all manner of traders, from people just starting out nothing to people who have gone on to run their own hedge funds, etc., etc. So again, I can only give you the benefit of my experience, nothing more. There's no magic fix, no magic cure.
No, we know that. Yes, that's why we're all here, of course, to learn all the different flavors of trading and investing. Steve, thank you for joining us. I know we run right over the 20 minutes. We just wanted to have you for, but grateful for that. Good look at the markets, what's happening, and perhaps you can come back tomorrow as well for a quick update and see what's happening.
Yeah, I'll
no
keep
more
it to 20 minutes next time.
Yeah, not at all. No, it's great. The more the better. It's your time that we're thinking about. So many thanks indeed for that. I'll take the presenter role back from you, and thank you again. We'll speak to you tomorrow.
No problem, Simon. See you tomorrow.
Thank you.
Thank you.
There we go. And thank you to Steve Ruffley, into TraderDirect.com, MT4Switch.com, and of course TraderMaker and iView charts. He has a lot of touch points where you can get in touch with Steve. Of course, me being one of them. So if you do want to follow up for the mentoring, just drop me an email or go to one of Steve's websites. So thank you for that, Steve Ruffley. We're now just a few minutes away, well, more than a few minutes, 15 minutes away. So we have a 15-minute break. Joaquin, I can see you asking. So if you can use that time, we'll be welcoming David Paul from VectorVest, who will be joining us just 15 minutes from now. Worry-free investing. After David, we welcome Lars, the mysterious Lars, who is a full-time trader with an account held at DarwinX, who has posted portfolio growth of 200% plus over the last 18 months. He's coming on to explain how he does this, what sort of strategies he uses, what sort of Forex currencies he trades to post these returns. So tune in for that. A first for us, a first for me. After Lars at 5 p.m, Charlie Burton from EasyTrader.com. We haven't heard from Charlie for several months, so it'd be good to have a catch up with him, find out how the trading is going over at EasyTrader.com. And finally, tonight at 7 o'clock, Corvin Codirla, FX Masterclass, how the hedge funds trade Forex and how you can improve your Forex trading by teaching you some of the methods he learned as a hedge fund manager himself. So lots of stuff to come. We'll go on a quick break for about 10 minutes and we'll be back just before 2 p.m. To start at 2. Just as a final reminder, some of you still asking questions about the recordings. A lot of you just joined in the last hour, and yes, the answer is yes, we do record these sessions. So if you've missed this morning's presentations, you'll be able to receive a copy of the recordings, or at least a link to the recording, and go and view that. One way it does differ from the round-the-clock trader is that we're doing 5 days of events, and the software we use, GoToWebinar, is set up to run this. It views it as one webinar meeting 5 times. So first for me, so I don't have 100% knowledge of how and when the recording will be made available by the GoToWebinar software. I'm hoping it will be on a daily basis, rather than having to wait all the way to the end of the 5 days. We are recording each of the sessions with a sort of a screen recorder as well as a backup. So we will try and get these recordings out to you as soon as we can, either on GoToWebinar or YouTube or through London School of Trading, where we have our clips all recorded as well. So doing our best. Will there be a cost to access the recording, Stuart? Not for this one. If you're a registered attendee of the webinar itself, you'll get free access to that. There is a membership, a monthly $6 membership for London School of Trading, which we run, which actually has the archive of all the webinars that we've been producing. So you've got almost 2 years worth of webinar footage and classes going back. I think it mounts up to 160 or 70 hours of education there. So London School of Trading, if you'd like to go ahead and join up there, you'll get access to all that. I'll put that in the chat box as well, just before we get started and go over to David. But certainly for this event, you will have free access. Okay, so just making David. Oh, we're making you the presenter already.
Good afternoon, Simon.
Great. Good afternoon, David. Sorry, I don't want to surprise you with the presenter rule there, but I see you took it very well and you're all set up, which is great. How are you?
I'm grand, Simon. Yes, I'm just grand. Thanks very much. Lovely day here in London, but chilly side, but lovely and bright. So beautiful.
It is indeed. Autumn's on the way. So we've got a slightly new presentation, I believe. Worry-free investing.
Well, I've got quite a few things up my sleeve today, so I'll do my best to try and get through it all without having to rush it too much. I'm going to have a look at the VectorVest system itself, and I'm going to have a look at how to find some high probability moves that should move in the next day or two, and then we'll look at worry-free investing, which is where I put most of my funds. Okay,
yeah, great. Shall I hand over to you and let you get started so we don't waste any more time then? I'll just say David Paul, Managing Director of VectorVest, over to you.
Okay, thanks, Simon. Thanks very much. Thanks for having us. Good afternoon, everyone. It's a great pleasure and honor to be here. I'm David Paul. I've been trading in markets for quite a long time. I put on my first trade in October 1982, and I traded while working for De Beers, the diamond people, until April 1988. In April 1988, I cut the corporate umbilical cord for good, and I've been pretty much trading on my own ever since. Along the way, I did some seminars, and that's where Simon and I met. For the last few years, I've in fact been running both VectorVest South Africa and VectorVest UK. My son makes most of the running in VectorVest South Africa these days, so I'm in London most of the time. So I think I'm probably true. It's probably true that VectorVest is probably the only education and software company in the realm that is authorized by the FCA, and to that end I have to put up the disclaimer which says that I'm not allowed to give one-on-one financial advice. Before I could do that, I would have to sit down with you and do a very long and detailed and somewhat boring fact find to actually ascertain your stomach for risk. So that said, we can move on. So what we're going to talk about this afternoon, and it's something that I can actually run into 3 days, and those of you that know me will know that it takes me nearly an hour to wind up the elastic band, so I'll do my best to get through it. We're going to talk about the VectorVest system itself. We're going to talk about timing the market. There is a good time to be in the market where it's relatively easy to make money on the long side, and there are times that it doesn't matter what shares you're in, it's virtually impossible to make money on the long side, and those brave souls of course can use that period to short sell in the market, to sell something you haven't got. I'm then going to look very quickly at our proprietary UniSearch tool to find some short-term opportunity, and then we're going to change gear completely and have a look at the worry-free investing that we're using with VectorVest very successfully in both the US and in the last week or two, last month or two in the UK. So let's move. What goes right through the full presentation this afternoon, ladies and gentlemen, is the VectorVest edge, and whether that edge is applied to spread betting over a few days with the product, or the worry-free investing, which is much longer term, looking for dividends, etc. Three things, in fact, weave through the whole thing, and at VectorVest we combine the fundamental position of a share with the technical position of a share, with the technical position of the overall market. And VectorVest's unique edge is putting together fundamentals and technicals together to simply make better decisions, better thought through decisions. In essence, ladies and gentlemen, we want to find shares that are undervalued, that are in fact growing their earnings, growing their profits aggressively but safely, that are rising, and we want to buy them into a general market that's rising. And when all three, 1, 2, and 3 of those points are all saying yes, and you can tick all 3 boxes, then the future can be determined with a certainty unusual in this line of work. So that said, the VectorVest product is a stock market trading product. It doesn't trade the euro dollar, it doesn't trade gold, because to my best knowledge, the euro-dollar does not supply fundamentals. In other words, it doesn't spew out annual reports and interim reports. And those annual reports and interim reports are the numbers and hard cold facts that we use in the program to ascertain the fundamental position. I personally trade the euro-dollar, and I have a position from Friday afternoon long the euro-dollar at the moment, but I trade that technically alone. And similarly, I have a position in the pound as well, which I trade technically alone. But my hit rate there is not nearly as high as it is in the stock market, where I can put all three things together. So the basis of VectorVest, folks, is what is the share really worth? How safe is the earning stream, and some idea about the trend. And as I'm going to show you quite quickly now, VectorVest puts a number to value, puts a number to the safety of the earnings, and it puts a number to the trend. And within Unisearch, in 10 minutes time, 15 minutes time, I'm going to show you how we can actually find those shares very quickly and very easily without a great deal of fuss. The first and the most important cornerstone of VectorVest is value. And every evening we place a value on every share in the database. We also look at relative value. Now, relative value is a measure of the earnings potential over a window of 3 years into the future. So here's what we do. We project earnings for every share in the stock market for the next 3 years. We assume that those earnings will be fully discounted into the price at some time over the next 3 years and work out what the price will be. We then take the projected price and subtract the price today to calculate the upside, and we divide that upside by what a AAA rated corporate bond will pay in that 3 years. And the resultant is relative value. If your share has got a relative value of 1.4, let's say, then that says that we believe that this share will outperform the risk-free rate as measured by a AAA rated corporate bond by 40%. So value represents the value of the share today. Relative value represents its upside potential over the next 3 years in relation to the risk-free rate. I firmly believe that relative value is the most important number on VectorVest, and in the little search in Unisearch that I'm going to talk about in a few minutes, I give it pride of place. The next number, first of all, a very simple little search which just looks at value. And I've done this over the last 18 months, slightly more now, since the first working day of 2015 till Friday. And I've looked at the top 10 stocks and that are undervalued. And those stocks have outperformed the market 3x. So there's a great deal of edge in buying shares that are trading below the VectorVest calculated valuation. So that on its own produces a big edge in markets. The second VectorVest number is relative safety, and it does what the slide says. It works out the consistency and the predictability of the financial performance. So we buy all of the numbers in digital form from Thomson Reuters. So the algorithm looks at the balance sheet, the income statement, the cash flow statement of all the FTSE companies and the AIM companies over the last 5 years, and gobbles all that information up and in fact spits out an indicator of risk. Again, on a scale between 0 and 2, if the relative safety is above 1.3, that's rated as excellent on the program. If the relative safety is less than 1, then this is a share where there's been ups and downs. If you're a very conservative investor, you would certainly be looking for high relative safety. If you are a momentum investor and you're managing risk proactively with stop-loss orders and you feel emotionally capable to do that, then the relative safety doesn't matter that much. Relative timing measures the trend, and again on the scale between 0 and 2, above 1 the share is rising, below 1 the share is falling. And then what Bart Toledo did, who runs VectorVest and has put this all together over the last 26 years, he put together value and relative safety and relative timing into the one single indicator. Now, as I've just explained, relative value and relative safety are a fundamental measure of the company, whereas relative timing is a technical measure of the company. And for the very first time in my career, I noted that somebody had actually put together the fundamentals and the technicals into the one single number. Now, as a default, ladies and gentlemen, all of the shares on the London market and any market where VectorVest operates are in fact sorted by VST. We can sort them by whatever we wish, and we're going to do that in a few minutes' time, but the default sort is VST. If relative timing is a short-term measure of the trend, then we have another measure called the comfort index, which measures the long-term trend of the share. It's a really special proprietary measurement in that it looks at the strength of the trend, it looks at the volatility of the trend, and it looks at the fundamentals of the company. Again, putting together technicals and fundamentals. If the share is trending strongly with little volatility and the fundamentals are getting better, that attracts high scores from 1, 2, and 3. And I think you would agree that if you've got a share that's trending strongly with little volatility and the fundamentals of the company are improving, that should offer you some comfort, and thus the name of the indicator. It's a secret weapon, and you can be profitable just with that on its own. We put a stop to every share in the market every single day. It's an adjusted 65-day moving average. It's adjusted for two things. It's adjusted for the average true range of the share, and it's adjusted for the fundamentals. If the fundamentals are really good, we widen the stop loss a little bit. If the fundamentals are drawing in other words, relative value is falling, relative safety is falling, then we tighten the stop loss up. And every day, we calculate a buy, sell, or a hold recommendation for every share in the marketplace. It can be used as a timing methodology, but its main use, in my view, is to work out the breadth of the advance. And every day we calculate the number of shares on a buy recommendation divided by the number of shares on a sell recommendation to calculate the buy-sell ratio, which is our proprietary measure of the breadth of the advance. And when I move into market timing in a few minutes, we're going to use the buy-sell ratio and the momentum of the buy-sell ratio to help work out the breadth of the advance. So let me go into the program and just show you that very briefly. This is the program. This is the home page of the program, and if I click on viewers, I in fact get a spreadsheet of all of the shares on the London market. Now there's 2,159 that we're following on the LSA and on AIM. I've just loaded the top 50 as sorted by VST. That's the default sort: value, safety, and trend. This little company is at the top, Sophion. Cracking little company, I may add. That's the code. This means that it's listed on AIM. As you can see, JD Sports is on the London stock market. CAS is on the London stock market. On CAS, there's a little X beside it, and that means that there's options written on that particular share, as is the case with RSA and South32. First of all, let's look at JD Sports, because I'm a shareholder in JD Sports, have been since £5, I'm glad to report. It's trading at £14.77. We believe the share is worth £21.52. So we can see at a glance, and in a moment using Unisearch, we can search for this, but we can see at a glance that this share is undervalued, and as a default, we favour undervalued shares. So this value number is the first proprietary measure on VectorVest. It's unique to the VectorVest program, that valuation. Share was up 2p on Friday, which is hardly a proprietary number, nevertheless important. The second proprietary number is relative value. And the relative value of JD Sports is 1.55. Now, guys, that is saying that we believe that JD Sports will outperform the risk-free rate by 55% in a window of 3 years. Now, as you all know, stock markets rarely move linearly. They normally do nothing and then fly up, and that's probably what's going to happen to JD Sports. Nevertheless, that's an exceptionally good number. Anything above 1.3 is excellent, and when it gets above 1.5, I have my own rating. It's called bloody marvelous. It drives the share price. Now, JD Sports has a relative safety of 1.4. On the scale between 0 and 2, anything above 1.3 is excellent. This is a company making money, making lots and lots of money, and all those ghastly financial ratios are getting better. Okay? Now, if you are a conservative investor, that would be the place to be. It's undervalued, growing earnings aggressively and safely. Whereas Sophion, trading at 322, it's flown over the last month or two. We still believe it's worth 483. The relative safety is 1.56, which is the high, but the relative safety only 0.97. So not nearly as proven a company as JD Sports. My son is a fund manager, and he loves these little companies because this little share, these small shares can move exceptionally fast, and this share has moved a long way, very quickly already. So Sophion has got the highest VST in the pack at 1.54. It's on a buy recommendation, and there's the stop losses for both shares. Similarly, Victoria. Victoria has just had a 5-for-1 split. I had a really good, before it split, I had a really good ride in Victoria maybe 18 months ago from £2 to £12. And although in JD Sports I've gone from 5 to 15, which is not bad, but 6 to 12 was really good. As you can see, still undervalued. Victoria is the largest manufacturer of carpets in the UK and in Australia. Still significantly undervalued, and the RV is 1.58, but the relative safety 0.86. Okay, so over the last window of 5 years, those numbers, there has been problems. There's a new man at the helm here, and this is really moving very nicely indeed. I have a position in Highland Gold. In fact, I do a blog, and I talked about it, I think last Wednesday or Thursday. Traded at 157, we believe it's worth 221. Relative value, really good. Relative safety, below the average of the market. And but nevertheless, I have a position on it. So that's on the right-hand side. We have dividends, and right at the right-hand corner, we have the CI. As you can see, the CI of Sophion and JD Sports through the roof. And I can actually, by clicking here, I can find the shares that are trending the strongest in the whole market. There's the shares that Blue Prism Group, Boohoo, Highland Gold Mining, Fever Tree, Keywords, Miller's Industries. These are the companies of the whole market that are in fact got the strongest trends, and I can do that with one click, guys. So the default salt and everything in VectorVest, this thread that runs through it, is putting together fundamentals and technicals. So that said, Sam, are there any questions from anybody about that, about the basics of VectorVest?
Not on the particular basics, but a question, I suppose, from P. Wall. It says, what about the VectorVest software as a charting package, as a standalone charting package? He's currently using eSignal and is wanting to try to compare.
Well, I can right-click and pull up a chart, and it is an end-of-day charting package. There is this little share Sophion, and there's just so much more on VectorVest than in a pure technical analysis package like eSignal, for example. For example, here, what I've is that I've got the price, and down below I've plotted earnings per share, and I can immediately see earnings per share moving up the page. There's our value. The thick green line is our valuation, and in July this year, this step input, VectorVest revalued the share very, very strongly, and that preceded this big move up the page, and it's came down here, made a little double bottom. Those lows are 62% of the last range, as one would expect, and I think that it's just a matter of time before this blasts up the page here, okay? And certainly, as they say in the classics, my quid is in. It just does so much more for you by integrating the technical position and the fundamental position. If you've got a share where the earnings are flying up the page like this, where the share is undervalued and the technical position looks good, then putting both things together increase the probability of you making a good decision. Simple as that. And I've proved that in my own trading over and over and over again. For the first, well, I've been using VectorVest now for 6 years, and I've been trading for 30 plus. So for the first 25 years, I traded technically alone, and that's because when I started, I tried to do the fundamentals, but I didn't have the right tools. I'm a mechanical engineer, and I know formal financial trading at all. The interim reports and the annual reports would pile up at the corner of the office, and I finally gave up. I just finally gave up. So as you can see, I love my harmonic patterns, and when I get a Gartley pattern, those of you that know what a Gartley pattern is, I run up the page and down AB equals CD down to here where it went. It's just like taking sweets from children. So I've got a Gartley pattern in a share that's undervalued where the earnings are growing strongly. This pattern. Gartley called it a Gartley. Richard Wyckoff called it a spring, or a market comes down, takes out the low, and moves up the page again. That's what Wyckoff would have called a Wyckoff spring. And if you come to my blogs or my webcasts on a Monday afternoon, I go through all of this in a great deal of detail. So I hope that helps that young man read the charting.
Thanks, David. Now Wayne's asking about JD Sports. You've got a value figure, but what about a profit target? In other words, when would you look to be getting out of JD?
Well, it'll be fully valued. Let's go back to the front page. It'll be fully valued, sir, at 21.52. So if it's shot up to 21.52, but let me pull up the target for. There's JD, and it just kept on going. As you can see, it's significantly undervalued. Earnings per share flying up the page. There's the Brexit sell-off. There's that little, see where it broke out there? That's my last add to the position, and I'm running this up the page. I think that if you wanted a target, the easiest way to do targets is with a little bit of fib. Again, I explain all of this. The first target would be that 1.618, which is slightly under £16. If you're a swing trader, that would be a place to look to take some profits. I myself think that after this big pullback, that the share is going to go here, and that is the 2.618. I reckon it's bound for 1890. Okay. That's where I reckon it's bound for. All right, 1890, and I've held on to this. I'll show you where we got into this, where I recommended everybody get into it. Just at that break at £5 there. It broke up through a 52-week high just there, and I've been adding to that position on the way up. In fact, I've been naughty, Simon, because I've added to the position, and I've in fact got far too much of the little bit of money that the ex-wife left me tied up in the one share. So I need to rebalance that quite soon. But rebalancing is a wonderful problem to have, isn't it?
Well, as long as it's tied up in a chart like that, it's not really a great problem, is it?
Well, no, well, nevertheless, the quants would say that rebalancing once a year, and certainly the official line from VectorVest is you should rebalance once a year, so you got never any more than 10% of your loot tied up in one share. And with JD Sports, it's considerably more. But as I say, that's a cracking little problem to have. I have another problem in South Africa. I bought a share at R1 some years back, and it's sitting at 158 Rand now. It just kept on going, a little IT company. So that's nice when you get that. It really is. So I need to move on now, and I want now to go to Unisearch. And I put together a little search, and I've got it here, but this is a search for those of you that want to find opportunity now. And time of search, and I've used this, my son uses it. We go down here to VectorVest fields, and the first thing that I want to search for is value divided by price. Now we have a full team of this overall. We have a full team in America at the end of a phone that show you how to do this. So I've got value, and I like to find shares that are trading at least 20% below their VectorVest valuation. Right. And the next thing is that I like to look at price. High, new high, and I like to see the price make, let's say, a 50-day high. Again, with this thing threads through VectorVest, folks. So at the moment, in this little search, I'm looking for shares that are significantly undervalued that are making a new 50-day high. Again, I want to put fundamentals and technicals together. Now, this is an aggressive search because at the moment there's no relative safety in there, so I'm not looking for relative safety. And I want to change the sort, and I found that sorting by relative value works wonders. And this is the earnings potential. This is an aggressive. Let me see where I can find RV. And we can sort by there, RV. All right. Okay. And now this is going to look at the whole market. In a second, I'll put in the FTSE 350 for those people who are spread bettors. So what I'm doing now is that I'm looking for shares that are undervalued, that are pressing up. 50 days is a 50-day high is cool. More aggressive traders could use a 20-day high. Now, those of you that have read the story of the turtles will know that that's all they used, was a break of a 20-day high, and then they found that the 20-day high got problematic, and I think they made it 55. So if I run this now, we get these. Okay, and these companies have all made a 50-day high. Now, I do this every single day, and I find shares with great fundamentals that are breaking up easily. And some of them stay on the list for a long time, so let's just chart them. Now, you can't do this with your easy signal, I assure you. Let's chart the selected ones. Sometimes the sun, oh, here we go. Now, this share has just made a 50-day high. That 20-day high would have got us in earlier. It's broken up above the highest point of the last 50 days. It's significantly undervalued. It's gone from a loss to a profit, and that's going. Okay, that is going. Next one, CAS. Now, CAS has been on this search since here, folks, just there. We have a big shareholder in CAS who comes to our Oxford user group. I can nearly see him smiling from here. And clearly, as it broke up through here again, it has now produced another 50-day high. And as it broke up through these highs, another 50-day high. So I've now found a share that's undervalued, growing earnings strongly, moving up the page. There's money to be made here. if you're a short-term player. Similarly, Highland Gold. Now, I got into Highland Gold. Highland Gold's just made a 50-day high, but you see the little blue line there? That was a 20-day high. I got in at the 20-day high just here at 126, I think, from memory. Somewhere around there I got in, and it's moving up the page. It's now broken a 50-day high, and it's, I think, heading towards £2. So there's Just Retirement, just broken up there. This is not great. It's undervalued, moving up the page. Again, aggressive traders who bought a 20-day high that's undervalued would have been in about 110. It's now 134, and we can find this opportunity very easily. Sport, Tech, Leisure. Look at this. Moving up, this is not great. Undervalued, moving up the page. That looks as if it wants to go up 50% to me. Okay, so with a very, very simple search, ladies and gentlemen, you can find shares that are going to move and move strongly. So I can put in another line here, let's say stocks, filter by, watch list, equals, and let's say you're a spread better and you can only spread bet in FTSE 350 companies. I can put that in. Now, run that search, finds 2 companies only in the FTSE 350 that are undervalued, and that's CAS and Just Retirement, and those would be good. CAS has been there for quite a long time. Just Retirement has been there for quite a long time, and those would have been cracking little spread bets over the last week or two. So if you want to find candidates for short-term trading, then these little searches work absolute wonders, especially when you combine the undervalued with a high earnings potential, okay, making a new high over 50 days, or you could easily change that to a, let's say, a 25-day or 20-day high, and run it again, and we find one more, Kennedy Wilson Real Estate, another one we could have a look at. And now I think I've charted those before, so I'll chart these all, and we can now look at the graph now. Every day you get candidates. This looks good, eh? Earnings per share rising. Okay, as you can see, there is a trend, and we can see it's made a rising bottom, and it's now broken up through this 20-day high. All right. Those of you that want to draw trend lines can draw trend lines as well, and you can put in all of the other indicators, for example, add parameter, all the standard MACDs and all that sort of stuff. I don't look at any of that stuff. You end up with a chart that looks like a bloody Christmas tree. Keep it simple, all right? Markets making 20-day high, 50-day high, but certainly this share has been making a 20-day high now for the last 3 or 4 days, and that looks as if this can go quite a long way up here, okay? That's how to find some shares that should move. Now, and I have far too much open here. So if you want to find candidates for spread betting or speculation without leverage, then you can find those very quickly and very easily indeed. So let's look now at the third part of VectorVest. We want to find shares that are undervalued, that are aggressively growing their earnings, that are rising, and that little search does that. It ignores relative safety, and that's because if you are a short-term trader, then invariably you're managing risk with stop-loss orders. So we want to find shares with good fundamentals that are rising, that's that 20-day high, that 50-day high, and we want to buy them primarily when the London market is rising. And VectorVest's mantra is buying rising shares in rising markets and selling falling shares in falling markets. We've been timing the market for one hell of a long time, and we've perfected objective systems that identify market trends. We have long-term systems for investors and short-term systems for traders. They are totally subjective and rule-based, no scratching. They look at the price of the VectorVest composite. Now, what is the VectorVest composite? The VectorVest composite is an equally weighted index of all of the shares that we're following in London, both on the main market and on AIM. Bartoledo firmly believes that an equally weighted index reflects the sentiment of the market much, much better than a market cap weighted index. So we look at the price of the VectorVest composite. We look at the breadth of the market as defined by the buy-sell ratio. And we look at the momentum, or in VectorVest terminology, the relative timing of the VectorVest composite. And we look at those three things. The short-term systems are around a 5-day rate of change of price, momentum, and breadth, whereas the longer-term systems, or what we call the underlying trend, is based around a 21-day rate of change of price, momentum, and breadth. For those of you that are not technicians, all of this is color-coded, and so that you don't have to think. It's all on the mobile app, so you can keep it under control on the go. Now, to minimize chart watching for those people that are on the move, we define the trend with two words: up and up. Now, the first word refers to the short-term trend, which VectorVest call the primary wave, and the second word refers to the long-term trend. And in fact, I haven't updated this. The trend on the market is actually down, up at the moment. The short-term trend is down, the long-term trend is up. I missed that. So this is reported on the front page of VectorVest every trading day. The primary wave would be used by those very short-term players, and the underlying trend used for position traders. So that is the situation at the VectorVest homepage. Now, for short-term traders, the primary wave or the short-term trend is color-coded in this little traffic light, and at the minute it's neutral. VectorVest does not advocate buying shares at this time. Okay. You maybe can see that green. This is the long-term trend of the market, and that, ladies and gentlemen, has been up since the third week of February this year. The short-term trend has been up and down, as you would imagine. Here's the VectorVest composite, and at the moment the short-term trend is down, and as you can see, sitting at support. And the long-term trend, which is automatically marked by this little green triangle, has been up since the end of the third week in February. In the second trading day of this year, the long-term trend turned down, and it fell hard, as you may remember, into the middle of February, to the 14th of February, as I recollect. Now, in the window below the composite, we have our market timing indicator, and the market timing indicator is that 21-day rate of change of the price and the 21-day rate of change of the buy-sell ratio, all rolled into the one indicator, mathematically massaged between 0 and 2. When the MTI goes up through 1 and the market has traded up for 2 weeks in a row, the computer automatically puts these green triangles onto the chart. Similarly, when the MTI is less than 1 and the market is turned down for 2 weeks in a row, we actually get one of these red triangles on the chart. And these are called confirm calls. They are the most long-term market timing system that we have in VectorVest. And we have, in fact, 5 market timing systems that move from very aggressive to conservative. And this is the most conservative one. The MTI has got some wonderful leading characteristics in that when it gets down below 0.6, that's invariably a great time to be buying shares. And when it gets up to about 1.55, that's invariably a good time to, in fact, be getting out of shares. So the young man that asked about targets, you could certainly look at the overall market for targets as well. In the middle of February, the price fell, but the MTI rose, and that's a divergence. That was a very bullish signal down here. The thing that worries me now, ladies and gentlemen, is that the VectorVest composite is making a double top, and with the strength in the market this morning, it may be it'll have pushed up to that resistance again, but the MTI hasn't been able to follow, and that's quite a bearish signal. If we were to get one of these little red triangles that's preceded by this divergence, then that would be quite serious. Okay, and that I've been advising people to watch out for over the last couple of weeks. Okay, so for our worry-free investing that I'm moving on to now, we in fact use the confirmed call system for market timing. If you're a spread better, well, you would in fact be using this to get you in. And at the moment, the short-term trend is down, the longer-term trend is up. With any luck, maybe that'll change today. So let's move a little bit. And I've already done that. Worry-free investing. So if you want to be a speculator in the market looking for short-term moves, then that little search of shares that are undervalued, sorted by RV, earnings potential, that are breaking above a 20-day high for aggressive people and 50-day high for not so aggressive people, I assure you that if you keep that under control once or twice a week, you're going to find lots and lots and lots of opportunity where your hit rate's going to be about 80%. By putting the fundamentals and the technicals together, it pushes the hit rate up enormously. So if you're involved in investing or trading and your hit rate is not what you would like it to be, and that has emotional problems, i.e. if you're wrong 3 or 4 times in a row, well, you can easily flush your emotional capital. There's 2 types of capital. One's your cash, and there's your emotional capital. A string of bad ones, I assure you, you can feel pretty rotten. At least I do. In worry-free investing, we look primarily at relative safety. Whereas in the aggressive speculation that I talked about a few moments ago, using that little search, we actually don't look at relative safety at all. So I've broken down what relative safety is. VectorVest looks at earnings consistency. They look at the company size. It looks at volatility. It looks at how long the company's been around. It looks at dividend history. A company that pays even a small dividend, that's got a history of growing that dividend strongly and hasn't missed a dividend payment, the quants tell us is a much safer financial instrument. And it also looks at all those ratios, of which the primary one, in my view, is the debt-to-equity ratio. So it looks at, in fact, 17 inputs to work out relative safety. Here's what we do. It's a very simple process. We rate all of the shares on the market by relative safety. So rather than rating shares by VST, we in fact just rate by relative safety. When we get a confirmed up, we buy the top 10 shares that have the highest relative safety. We don't have to wait until we get a new confirmed up. If you decide to start this today, we are in a confirmed up. So you could actually do it today. I would certainly be happier if you were buying into an environment where the MTI, in fact, had just given a signal. You keep a stop loss in place for each share at the VectorVest recommended stop loss. Markets breathe in and they breathe out, ladies and gentlemen. So invariably, a confirmed up, although we've had one for the whole course of 2016 now, sooner or later there's going to be a confirmed down. That's just the way it is. When you get a confirmed down, you simply don't buy any more. And you watch your stop losses carefully. Let's say during the sell-off, we get stopped out of 3 positions. We've got 7 left. So what's happened? What happens is that the amount of cash in our account just rises. when we get the next confirmed up, we run the search again, and we replace the 3 that we've been stopped out of by the 3 highest RS stocks that we don't already own. And that's the process. We just keep that going. Now, the objective is capital appreciation. The objective is dividends. And the third objective is income from selling options. Now, primarily covered calls, which is the most conservative options selling strategy. And 2 or 3 times a year, you'll find that the MTI gets up to about 1.5, 1.6. And invariably, the market's not going to go any higher. And that's a very, very safe time of the year to be selling covered calls, because there's a low probability that those shares are going to be called away from you. I don't want to get into options talk now, but nevertheless, if you do a search, ladies and gentlemen, on writing covered calls, there's an ocean of stuff on the internet about it, and certainly in the US, grannies are writing covered calls. It's considered a very, very conservative strategy. So that's the objective. We have a very good options trader out at our Oxford user group, and he reckons that we can easily, if you've got a portfolio that's producing a dividend of 4%, that you can relatively easily produce another 10% income from that portfolio by writing covered calls just 2 or 3 times a year, especially when the MTI is right up around 1.5, 1.6. Very little probability of those being called away from you. So we've tested this in the US, and we tested it over 20 years. There was 177 trades placed, and the test finished on the 7th of June this year. 167 in and out, and 10 currently open. So that's 20 years. 20 times 12 is 240 with 177 trades. So it's hardly aggressive trading. You're placing a trade every 6 weeks or so. There was 544 dividend checks collected, and that amounted to $51,000 dividend income. Now, I haven't added the dividend income, but that is the results. And over the last 20 years, as you can see, it went flat for a long time. We turned $100,000 into $683,000. That's not counting the dividend income, and it's not counting any income from writing covered calls. There's the financial crisis, and there's the market's been flat since April 2015, as you all well know. So that is the worry-free USA track record. Now, I've done this in the UK as well. Exactly the same test. I've done it since 2009, so that's what, 6 years, 7 years. Very simple. We're using the VectorVest stop loss, and we're by the highest RS shares when the VectorVest composite calls are confirmed up. When we get a confirmed down, we stop buying, and we watch our stop losses carefully, and we raise our cash position as a few of those stocks invariably get stopped out. When we get the next confirmed up, we run the test again, and we replace with the highest RS shares that we don't currently own. And that's what happened in the UK. £50,000 in this case turned into 151,000, and that's a compound rate of return with no dividends added in of 19% a year. Okay. And that's using the VectorVest stop loss. Now, when I started in the stock market, my mentor of those years, who's long since dead, he used to use, and he coached me into using a 25% trailing stop loss. And by replacing the VectorVest stop loss with a 25% trailing stop loss, we do a little bit better. We actually increase the £50,000 into £172,500. Again, absolutely no dividends added into that. If you add the dividends into that, then it makes a considerable difference. First of all, and then folks, you can try this for yourself. I'm quite happy to give everybody access to VectorVest UK and VectorVest USA for 5 weeks for a £5. VectorVest is then £44 a month on a month-by-month basis for both markets. If I cannot make you money, you can stop at any time. And as I say, we're fully FCA authorized. There'll be no quibbling. VectorVest can be used very aggressively, and I tried to show you how you can actually use VectorVest to find opportunity tomorrow. And I think I found a couple of shares that look really good for opportunity today or tomorrow. And you can use VectorVest as a long-term position trading in a very mechanical way with very, very, very little effort on your part. If you're prepared to educate yourself a little bit in how to write covered calls, then you can quite easily get your portfolio to a point by writing covered calls when our MTI is extended, where you can in fact keep your portfolio and push your income up from 4% to well over 10%. I've in fact given the link, Simon, I think that link is correct, vectorvest.co.uk. Now, what I've also thrown into this is that VectorVest have got a 5-week quick start course, and that quick start course is normally sold separately, but I'm more than happy to add that into the mix. You're also going to get 5 weeks of my webcasts on a Monday afternoon, full access to the VectorVest University, and an 0800 number where you can phone, and there'll be somebody at the end of the line from 12 o'clock midday to 12 o'clock at night to answer your questions. Any questions out there, Simon, that I can answer?
David, yeah. One question we're sitting from Joaquin. How long do you spend a day doing these trades that you're talking about? I suppose, what is your daily routine using VectorVest?
Well, first of all, in the worry-free trading, I think that if you kept that under control in a few minutes a day, that's all it takes. We were talking about making a transaction every few months. Okay, in the more speculative side of it, then I run my search, and for example, it's given out 3 shares within the FTSE 350 today. There's always new ones every day as they push their nose up, and that takes me half an hour in the morning, no more than that. So worry-free trading, I think, can be done at the weekend. There's very, very little to do. This more speculative stuff, then about 30 minutes a day, I would think.
Okay.
In fact, I do better when I'm busier, because when you're busy, you haven't got time to fret. You put in a stop loss in the system, and you're not tempted to actually take profits too quickly because you haven't got the time to take profits too quickly. So it doesn't take that long.
The money's made by the men who can sit. Is that what you used to say?
Well, yeah, the money's made by the sitting, not by the thinking. Those men that can be right and sit are uncommon. That's a line, eh?
I have a confession, David. I'm only now just finishing Reminiscences of a Stock Operator after hearing you recommend it year after year.
It's a cracking read, isn't it?
Worth everything. In fact, it's free to download. I downloaded it onto the Kindle, but what a great read.
Yes,
if anybody out there hasn't read it yet.
Well, quite honestly, it should have been made into a movie. It would have made a much better and much more positive movie than The Wolf of Wall Street. And clearly I would have cast DiCaprio in the role. that Wolf of Wall Street I found very depressing, I'm afraid.
But it's interesting how all these things remain true more than 100 years later.
Well, not quite so. In terms of my some of my very aggressive trading, I think the patterns that I use are all over 100 years old. Yes, they were first put down in paper 100 years ago. All of those Bollinger Bands and moving averages, no, that's all rubbish. As far as
that's amazing.
Everybody says the market falls to a 200-day moving average, but they don't realize that it's the average is moving to the market. It's not the market moving to the average. Okay, very few people understand that. So,
very good. Bern is on the line. He says, "Do you know the date of the Belfast users meeting, please?" I suppose that's another good point to mention, is that you do these regional meetings.
I'm not sure when the next one is, but Bernard, I'm going to the one in Belfast on November the 15th. Yeah, November the 15th in Belfast. I'm at the one in Dublin in the morning at lunchtime at the Royal Dublin Showgrounds, and then I'm getting the Enterprise. The train between Belfast and Dublin and Belfast is called the Enterprise, and I'll be getting the Enterprise to Belfast for the evening. The evening, the Belfast user group is at the Balmoral Golf Club. So that's on the 15th. The next one's on the 15th of November that I'm going to. We have user groups around the country, and we have a really good one in London run by Susan Thornborough, who knows the product inside out. And I'll be going to the user group in Guildford next week, and the one in Bristol next week, and then on the Thursday, 20th of October, to the one in Oxford. We have a seminar in London on the 18th of October, and we're at the Investor Show on Friday the 14th. And Simon, I'm at your talk on November the 5th.
You are. I was just about to add, in case you'd forgotten, you're going to be there in the afternoon on the 5th of November. So remember the 5th.
I'm in fact in Cape Town on the Thursday. So I have to fly out of Cape Town on the Friday night and get into London Saturday morning. A good hour in the gym, and I'll be right as rain.
Right as rain. Well, we'll look forward to that. That'll be the Grand Connaught Rooms. That's Round the Clock Trader Live event. Okay. So anybody that hasn't seen that yet, we'll be sending you details of that. Well, David, thank you very much.
What I tried to do, Simon, today was to put together aggressive investing for those guys that want to use VectorVest as a speculative tool, and then as a high probability position trading mechanical system. I firmly believe that even if you are a trader, you should be using both. That you should be trading aggressively with a percentage of your funds, and with another and using that to add to your long-term portfolio, which is going to bring in income.
Indeed, indeed. Mm-hmm. Well, we're just about a minute from 3, so I'm going to have to say thank you very much again. You're back on this week as well.
I'm here back on Thursday, and on Thursday I'll do a little bit more on the speculative trading.
Fantastic, wonderful. Thank you very much indeed. So, David Paul, thanks again for joining us. I'm going to take the presenter role back.
Cheers, everyone. Thank you, Simon. It's a pleasure.
Bye-bye for now.
Bye.
There we go. Thank you, David Paul from VectorVest, for joining us for that presentation. Joaquin saying, can you send us an email with all the links and dates, please? If you're referring to the VectorVest dates, I would direct you directly to David, if you can, for that. You just go to the VectorVest website, vectorvest.co.uk. Oh, David, I don't know if you're still there. If you can remind me what email address should be used. Yes, there's something about the investor seminar as well. There is a London investor show on the 14th of October in London, surprisingly enough, and we are following that up with our own Round the Clock Trader Live event in London on the 5th of November at the Grand Connaught Rooms. Back to today's webinar. Welcome to those of you who are joining us for the afternoon session. This is London Investment Week Live. We've got a whole week of webinars from trading, short-term trading, forex trading, through to slightly longer-term share portfolio building and commodities. We've come from hearing David Paul talking about building a worry-free investment portfolio, and we are going now over to hear from someone who is brand new to the event, Lars, Trader Lars from Klondike FX. And we don't know too much. Lars and I have never actually spoke together. He is a trader, full-time trader, and his account is made available to you to view at DarwinX, the brokers, and he will be available for people to put money with him to trade. So we've invited Lars, and he's kindly accepted to come along and speak to us about how he actually manages to put these returns in the way that he does, and what he trades and how he trades. It's just a general style. So welcome everybody to Lars. We'll bring him in and unmute the microphone and say hello. Lars, it's Simon Campbell here. You should be able to hear me now.
Hi Simon, I hear you. Can you hear me too?
I can hear you. Thank you very much indeed. Yes, everybody should be hearing you. Just telling everybody just a little bit about what I know. Of course, I don't know too much other than thankfully Juan Colon at DarwinX was kind enough to put us in touch, because you're one of the strongest performing traders over there, and we thought it would be interesting because we have been running these webinars for a couple of years now, and very much with a focus on shorter term trading. A lot of forex traders here in the room, and we thought it would be interesting if you could sort of outline some of the strategies and the trading that you do.
Yeah, sure. Well, my name is Lars, and I am currently 36 years old. I have studied business administration with emphasis on computer sciences. And after I have finished the university, I have worked for a long time as a self-employed programmer. And more interestingly, I have also been an online poker professional. I'm now in the trading area for about 8 years. And this whole thing started off as a part-time passion and has now been my full-time occupation for the last 4 years.
Full-time, fantastic. Would you like to share the screen? What I'll do is I'll hit the button, make presenter, and that's going to send you across a dialog box. And if you just confirm, there we are. Easy, fantastic. Okay. And you have our logo as well, which is great. Okay.
Of course.
Wonderful. Okay, so Klondike FX Forex Solution, London Investment Week. Fantastic. Should I hand over to you? Would you like to just to start your presentation, or how would you like to?
Yeah, sure. If everybody is ready to start, I just
I've got the questions here, so I'll keep an eye on the questions, and maybe we can interrupt every now and again if we've got particular questions.
Right. I was just about to say, if there are any urgent questions during this presentation, just let Simon know, and I'm sure he will kindly interrupt me. Other than that, we will also do a Q&A afterwards, I think. So we should be fine in that regard.
Okay, fantastic. Okay, Lars, over to you. Thank you.
Great, thanks. Well, first of all, some words about me and Klondike FX to everyone who's never heard of us, which is probably all of you. So what we present and how we will make money. Klondike FX is a development and consultancy provider. We are specialized on solutions for the foreign exchange market, known as Forex by everyone. And our first and main source of income is the actual proprietary trading. We are trading our in-house developed algorithms on private and some family members' accounts, as well as on our investors' accounts over at darwinex.com. Currently, we have just about 600,000 US dollars under management, which is of course tiny in relation to other more known money managements. So if you like, you could consider us as some kind of a boutique trading outfit or the like. Yeah, that being our one source of income, and the other part is we are offering consultancy and development services to customers. These services include, for example, the trading service setup and optimization. We do testing of algorithms on various backtest data, and we are trying to find some weaknesses in those algorithms, and we try to spot areas of possible over-optimizations. What we also do is optimization of code, meaning, for example, we can increase the performance for time-critical applications, or we just improve the usability of code. We also have done a little example over at our blog at klondikefx.com, where you can find an example of an enhanced order abstraction class, which is coded in MQL. For those of you that are interested in coding and would like to see some code example. Last thing we do is we develop and realize trading algorithms. For example, some traders have pretty clear ideas of what method they would like to trade, but they don't know how to put it into code. Now, what we do is we transform those ideas into backtestable code. Right? Good. So that was just a very short introduction for those of you that don't know us and what we do. So now on to me and how I became a trader, and more importantly, what poker actually has to do with it. I'm sure for some of you, the link between poker and trading is probably pretty obvious, but others might ask themselves how those two topics go together at all. Yeah, I mentioned earlier that I've been a self-employed programmer after finishing university, and during that time I also discovered my love to poker. At first I was just playing for fun and as a hobby with friends and buddies, but after only playing offline at home for some months, I heard about online poker in a TV commercial, and I immediately wanted to check it out, because clearly if you can beat your friends in home games, you can also crush online poker and become insanely rich, right? Yeah, well, of course not, because I very quickly lost my first deposit. I think it was on the first day even, and I now had to seriously rethink if playing online for real money was indeed a good plan. Knowing what I know now, this failure was hugely because I had no idea of money management and variance whatsoever, which are, of course, key concepts to any halfway serious poker player. And here's also the first link between poker and trading, because the main reason why so many novice traders immediately fail is exactly because they also have no clue about how to manage their risks. They usually over-leverage their trades, and therefore they bust their accounts very quickly. Good. To make a long story rather short, after a lot of research and very hard work, I've finally been able to climb the limits, starting from a buy-in of $5 to the high-stakes games with a $5,000 buy-in. Yeah, I've played some years as a full-time poker pro as my sole occupation, and I was experiencing some intellectual boredom, so to say. Additionally to that, the poker market was also getting tougher every day. There were fewer inexperienced players at the table, and playing against other professional players was only giving me a very small edge, and this results in huge swings in variance. Those were the main reasons why I was looking for other opportunities, and during my time as a poker player, I've also learned something about trading and forex trading in particular. This topic has always fascinated me, and the good thing when you are a professional poker player is that you actually have a lot of free time to learn new stuff. So for me, given all the similarities I try to present to you in the next slide between poker and trading, trading was the logical thing to do, right? Okay, so now we try to see similarities between poker and trading. First of all, you will need a pretty similar psychological skill set to succeed in either of those. For one, you need the emotional stability and the ability to detach yourself from the monetary consequences of your decisions. Because you have to make rational decisions detached from your emotional state of mind. For example, if you realize your state of mind is somehow and for some reason whatsoever unstable, then please step away from the poker table or your trading station immediately, because decisions made in such a state of mind can seriously cost you money. In poker, this state of mind is called tilt, and it can be caused by either a bad beat or any kind of other influence, actually. Most of the time, you don't even know the various reasons that can cause tilt beforehand, and so the important thing is actually not to realize why you're tilting, but when you're tilting. And in my opinion, the very same goes for trading as well. Even if it's not called tilt, the motives behind it are pretty much the same. Furthermore, we have some psychological biases. So just as a little example, take the so-called hindsight bias. I'm sure many of you have heard of it before. You can summarize it just in a very simple way. If you have a situation that went terribly wrong and you scream to yourself, "I knew it before," that's a typical example of hindsight bias. I won't go into too much detail about psychological biases here, but I would recommend to you just to use Google or Wikipedia. You will find some very interesting reads on the topic on both sides. Yeah, those biases can unconsciously make you take irrational decisions and should therefore absolutely be avoided, right? Good. The next similarity between poker and trading is the money and the risk management. I mentioned the importance of money and risk management before. This is of utmost importance for both traders and poker players as well. Because without good risk management, you are pretty much guaranteed to be a loser. In poker and in trading, you will experience luck and variance. That makes it important not to overestimate your short-term results, as they probably will be largely skewed by variance. The big influence of variance makes it very hard to tell if you are just having a good run or if you have indeed an edge. The same goes for bad runs as well, of course. If you know some serious poker players, you probably also know that they are pretty pedantic about analyzing their play and finding errors or possibilities to improve their own game. A huge part of your time as a poker pro consists of going through old hand histories and replaying them, doing some math, exploring alternatives, routes of play, and so on. In my opinion, this is something that serious traders should do as well, and many traders I know are also doing this on a regular basis. Good. We have both poker and trading being very competitive fields, and they are both driven by money. You need a lot of patience and a lot of dedication to reach the required skill level to make money consistently. When I have still been a poker player, I was playing up to 14 tables simultaneously. That's a pretty huge number, but the calculation behind it is pretty simple. The more hands you're playing, the more money you can make. There is, of course, a point where you reach some kind of threshold where the information you have to process is so overwhelming that you are making wrong decisions that in the end will cost you more money than you are making by playing more hands. So finding that kind of balance is pretty important. And this is pretty similar to a trader as well, who also has an advantage if he can process more information, or if he can process information just more quickly than others, as he might find better trading entries, or he can just place more trades at the same time. Yeah, we have the last point on the list, which is the cashback you can get. In poker, this is called rake back, and you get a certain percentage back of the rake that you pay to the poker side. For those of you that don't know the term rake, you can compare it to commissions you pay to your broker for taking a trade. To put it simply, in poker, you are paying the poker side for playing a hand of poker, and this payment you make is called rake. Now, if you're playing a lot, that rake back can be serious money. Similarly, you can receive reduced commissions by using an introducing broker with your Forex brokers as well. So having this extra money can sometimes make a slightly losing or break-even trader becoming a profitable trader. So please don't underestimate the importance of those small edges, right? Good. That we have now talked about all the similarities, it has to be said that there, of course, are also a couple of serious differences between poker and trading. First of all, in poker, you know exactly who you are playing against. Being a poker professional, you have played thousands of hands with most players at the table, and you therefore know their tendencies, as they probably know yours as well. As a trader, however, your opponents are more abstract. You don't know them, and you can't see them, and you know nothing about their tendencies. Now, if you are not careful and you choose a bad broker, even the broker itself can be your opponent, which would be a nightmare, of course, because if the broker wants you to lose, he has every means to do so. Just imagine your opponent in poker would know your whole cards and could also decide what cards he's going to deal on future streets. Good luck winning with some money with those circumstances. Another difference is if you are applying sound risk management in poker and in Forex trading, you will need a higher capital base in Forex to gain similar returns in Forex trading in comparison to poker. This has been a major hurdle for many poker players I know that were trying their luck in trading. They had to invest a lot more money than they eventually thought they would need to invest. As I have done both, playing poker and being a trader, achieving consistent returns in trading is a great deal harder than being a professional poker player. This might, of course, have changed as poker has become a lot tougher in the last years, and I have been quite out of touch with the games for some time now. However, the problem domain in trading is definitely a lot more complex and requires a lot of discretion. Good. That was some very theoretical stuff and probably a little boring as well. So any questions so far to that part before I come to the actual trading part, which starts with my strategy called Winnetou?
Lars, no questions at the moment, but wow, playing 14 hands of poker at the same time. That must have taken quite a lot of concentration.
That's quite a challenge, I can tell you.
And how has it become harder? You mentioned that online poker has become harder over recent years.
Yeah.
Why is that?
That is mainly because the educational part is becoming more accessible. You don't have really stupid new players who don't know what they are doing, and you mainly play against other professionals as well, which makes it very difficult to gain consistent returns because you have a huge variance and you have huge swings, and that make it tough to play nowadays.
Interesting. Okay, which is where the financial trading probably already is.
Right. Absolutely.
Yeah. Interesting.
But the advantage you have in financial trading, you are actually allowed to let your algorithms trade for you, whereas in poker this is strictly forbidden, and the poker sites do everything in their means to prevent you from using any automated tools there.
Really? Wow. Okay. We haven't heard much about the online poker on this, but it's interesting to draw these comparisons because, of course, everybody does look at the comparisons. Interesting. Well, shall we carry on? Look at this is Winnetou. This is your strategy.
Right. Yeah. Sure. Good. If you have no questions so far, then I'll continue with Winnetou. Winnetou is just the code name of our first publicly available strategy. Just in case you wonder about the meaning of the name, Winnetou is a fictional Native American hero of several novels written by Karl May. As the trading strategy is mainly based on scalping, and I had been a huge fan of those videos as a child, I thought that would be an appropriate name. Well, maybe it's not. Good. We have the trading strategy which is itself completely automated and or algorithmic driven without any manual intervention. The underlying trading is based on the principle of trend following in a way that it is scalping retracements in major trends on the euro, US dollar, and cable. Those two are the most liquid pairs, and this strategy needs excellent spreads and trading conditions because it has a pretty low pip expectancy per trade, as you can see. The expectancy per trade is only about 2 pips. So if you have spread higher than that, additional to the commissions, you have a losing strategy. So unfortunately, this also makes for a rather bad strategy in terms of scalability. So this style of trading won't be working with millions of assets under management probably. However, with an AUM of around 600,000 US dollars, we have not experienced any deterioration of execution quality. So now we don't know yet when this strategy will start performing worse due to scalability issues. Yeah, I have prepared this slide showing the equity curve of our live trading, this strategy from mid-2012 up until now. It's not a straight line, and it had its periods of drawdown and stagnation as well, so it can be hard to trade at times for sure. However, the drawdown in this particular risk setup was around 20% only. So this is quite good in my opinion. Yeah, here you can see a quick overview over the returns in the past years, showing that there has been no losing years since the start. And as I said earlier, the drawdown was only around 20% at that time. Yeah, that is already what I have prepared for this particular strategy. I would continue with theoretical strategy development unless you have any questions regarding Winnetou as a strategy, which I would be more than happy to answer.
There's no questions on that at the moment. Maybe people
Okay.
might be typing in, but if we just roll along, I'll certainly come back if a question comes through.
Sure. Okay. Well then, on to strategy development in general. Now, if you are interested in developing your own algorithmic strategies, how could you start? First of all, you need the appropriate toolkit. There are so many products on the market that I can't even name them all, so I will just list those tools that I really like or that I already have used. First in the list is the so-called F4 framework. This software is based on C++, and if you are a paying member of that site, you will also get the full source code for free. Their community is pretty active and the performance of the framework is excellent. Next one is the so-called Zorro Trader. This one is rather unknown, and you can build your strategies in this software kit based on a variant of Light C, which is a pretty easy to understand and to learn. And you will also find many coding examples on their website. You can use this product for free as long as you don't earn more than 30,000 US dollars per year, in which case I think it's okay to pay them a small fee because you made enough money, right? The performance of Zorro Trader is also excellent. Then, of course, you have the notorious MetaTrader 4, which I think every one of you has heard of before. This tool is also free, and it is bundled with almost every Forex broker on the planet. The documentation is very good, and you will also find a lot of code examples online. You have to say that the performance is mediocre, though. All in all, I would still say MetaTrader remains the perfect tool for the typical starter, right? Now, having your backtesting engine in place, you now need also some historical data. There are a couple of providers where you can get historical price data, Dukascopy and TrueFX being even free. I will leave it up to you to check out their offerings in detail. You have the links here. And yeah, I would recommend using Dukascopy or TrueFX because, as I said, it's totally free and downloadable for everyone. If I had to recommend a combination to a novice algorithmic trader, I would probably say the best choice is to use MetaTrader 4 because of its excellent documentation and lots of free code examples. You have to consider, though, that it's a very old software and it is only single-threaded. So it's terribly slow in comparison to some other tools in this listing. You have also the ability to download historical data from within MetaTrader itself, but you have to say that the quality is pretty bad, not to say terrible. So if you are serious about backtesting, I would recommend to use an additional product called Tick Data Suite. The version 2 of this software is also able to download the free historical data from Dukascopy and Integral and makes it available in MetaTrader. It is really easy to use and I highly can recommend it. Yes, having our tools in place. Now comes the hard part. We need to find a strategy that has an edge and that can make us good profits. I personally have been using a deductive approach in my strategy development, meaning we go from a very general meta strategy to a sophisticated live trading strategy. For example, yep.
Sorry, just before we move into this next section,
Sure.
a couple of questions. Dan's asking, what about the Thinkorswim charting platform? Can that be used for backtesting?
I have not used Thinkorswim charting platform before. I think Thinkorswim is more equities broker, or am I wrong on that?
I think it's equity. I think it's a US based broker. I know that.
Yeah, I'm sorry I can't help you on that because I've never used it.
Okay, what about MT4? What does TDS stand for?
TDS stands for Tick Data Suite. That's the software you can use to freely download tick data and integrate it into MT4. I highly recommend it.
Okay, well, here we are. Another question now from George. Can you explain how to backtest a mechanical system in MT4 with written trading rules instead of experts? Is that instead of EA?
No, I can't. I have only used experts before. I'm not sure how you can use discretionary trading rules instead of experts in MetaTrader 4.
Okay, yeah.
Unless I understood the question somehow.
That's okay, George. We'll maybe come back to that later. Thank you. Let's carry on looking at the strategy development.
Sure, great. Good. Where have we been? Yeah. I personally use a deductive approach. So for Winnetou, that would mean I made the assumption that to follow a trend in general should have a positive expectation. Given that, we now have to verify this theory by testing it against historical data. To be able to do so, we need to develop a very simple implementation. For example, we tell our algorithm to sell retracements in major downtrends and to buy retracements in major uptrends. This very simple strategy is called meta strategy, and after we have created this meta strategy, we run a very simple backtest. And ideally, we see that this meta strategy itself already is generating profits in our backtest. So now we can go forward and try to refine it and improve its return using a couple of various methods. For example, we could add additional entry filters. We could be implementing dynamic exits based on indicator data or price candle formations, in addition to our fixed take profit and stop loss values. We could also adjust our stop loss on take profit to market volatility, widening it if we have a highly volatile market, or tightening it if the volatility is low. We can also use signals from multiple time frames additional to our default trading entries, and so on, so on. The possibilities are endless. Afterwards, we try to use a backtesting engine to optimize the parameters of our strategy against our historical data. This is where your backtesting engine really has to do the work, because it uses relatively complex genetic algorithms or even simple brute force algorithms to find the best combinations of your strategy parameters. One thing I personally like to do is to be watching some kind of relive of how your created strategy would trade during the backtest. This can give you some valuable insights as well. On this slide, I have prepared a quick overview of how a backtest of a simple meta strategy would look in comparison to a backtest over the refined strategy. Here you can see the meta-strategy backtest of our winner-2 strategy in very simple form, without any additional filters, without dynamic exits, without volatility adjusted stops, and so on. Just the theory. And here you see the refined and optimized strategy, which is increasing the profit almost by double and reducing the drawdown by 35%. These two backtests are based on real recorded market tick data, which I have collected in our own software. You can see the difference is pretty huge. Yeah, I would like to quickly cover one major issue that comes up with backtesting. I guess most of you have heard of the term over-optimization. This just means that your newly developed strategy is describing some random noise inside your backtest data and is therefore not able to provide predictive power during live trading. The cause is usually an overly complex model with too many degrees of freedom. We absolutely have to avoid overfitting. And to do so, we will introduce 3 simple rules. Rule number 1 is you have to be able to describe your model in a common sense description. For example, in winner2, that would be look for a major trend, wait for a retracement, and then enter in direction of the prevalent trend. Using this approach avoids that you are only data mining for your strategy generation. To give you a bad example of how to get a trading strategy, that would be if you just throw some indicators on your historical data and you optimize those indicators as long as you find a combination that is generating you profits in your backtest. This procedure would be an excellent candidate of an over-optimized strategy, and it would be pretty likely to lose money during live trading. So the second rule is the so-called Einstein's razor, meaning your model should be constructed as simple as possible while it still has to be valid. For our trading strategy, that would mean we have to reduce the degrees of freedom. So we use fewer optimizable parameters, and this will result in a strategy that is less prone to overfitting. The last rule is we have to keep our strategy robust. You can, for example, check for robustness and test your strategy on different historical data feeds. I have listed the different providers some slides back, and as well as on different pairs. Also, you should test it on data that was not part of your optimization process. This would then be called an out-of-sample test. If your strategy is able to generate profit under those difficult circumstances, you are pretty likely to have a very robust strategy. Now finally, on robustness, you need to keep your model symmetric. This just means that you should not use different rules for long and for short entries. Okay, this was pretty theoretical as well, and I'm sure there are some questions on that part, which I would be more than happy to answer.
Lars, yes, there's a couple of questions. Do you normally forward test, i.e. retest the optimized strategy with a different data set?
Yes, I do. I don't forward test per se, but I do some out of sample tests that I told you in the robustness part of this, and I use different historical data from different providers as well to see if the strategy only performs under one provider or if it has similar returns under more providers.
Okay. And Stuart's asking, how far does the backtest go? The chart suggests it goes back to October 2012. Is that the case?
No, that's not the case. I have a backtest going back to 2001. I've not presented it here. This, I think I can just go back to where we started this year. This backtest is just as a sample of how a meta strategy would look in comparison to an optimized strategy. This is not the complete backtest I have done on Winnetou. This would be a lot bigger.
Okay. What about using ATR multiples for stop loss? Do you use?
Yeah, you can do that. That's just one variant of additional filters or additional optimizations to your meta strategy.
Okay. Why symmetric entries? Some cognitive biases predict long entry bias in most charts.
I've made the experience that if you're using unsymmetric entries, you might optimize for a market period where you have a long bias. So if you use symmetric entries, you are also prepared for a market phase where you have a short bias, right? So I like to be prepared for both market phases. If you're constantly re-optimizing your strategy, you can of course use unsymmetric entries as well, but you better know what you're doing if you try to do so. In this case, I prefer to use the more robust way of using symmetric entries.
Okay. Lars, you might have already explained this before, but could you maybe just, for Elizabeth that missed it, could you explain what you mean by a symmetric model?
Yeah, sure. Let's just take a very simple example of a stupid strategy that always enters long if the distance to the MA is, let's say, 20 pips. So if it enters long at 20 pips distance to the MA, it should also enter short at 20 pips distance of the MA in the other direction. That's what I mean with symmetric. So you need to have the same entry rules for both long and short entries, in my opinion. Not sure if this was clear, or should I expand on that?
George, if you could clarify if that's okay for you. What about tick data? Can it be used for volume analysis? Asks Dan.
No, unfortunately not, because Forex is no centralized exchange. You have Forex as an over-the-counter, and volume information is pretty inaccurate and, in my experience, can't be used.
Okay, yeah, okay, thanks, says George. You explained the symmetric model well there. So, just one thought, Tom is saying, I wonder if you might go through a concrete example. Do you have any examples?
For what, yes? For what?
Yeah, Tom, if you could, what strategy is this? The Winnetou strategy. Tom, if you could just clarify there. Okay, it is not valid statistic with ticks as a sample of volume, says Saranjit.
You mean the number of ticks in a certain time frame as equivalent to volume? Well, you can try that, but I wouldn't recommend it, because even if your backtest data is pretty good, it does not mean the amount of ticks is precise as well. So you could be fooled in that area. You would really need to record your own ticks, and until you have a large enough sample to use that, I wouldn't recommend using it.
Okay. George is commenting that tick volume is enough for TradeGuider. TradeGuider is a software that I'm aware of. So tick volume is enough for TradeGuider on FX, says George. Okay. Tom's come back, says looking for a concrete example on a strategy with figures. Rate of return.
No, sorry, I have not prepared something like that.
Okay, yeah. Any sort of details on win-loss, losing streaks, etc. So anyway, that's fine. Okay, so we'll take a break from questions then and allow you to go back, Lars, if you can. This is very interesting stuff. I mean, clearly this is where the trading's done for you is the setting up of all these algorithms, and this might be seem quite complex for a lot of people who might be with us today, who are in the habit of going on, looking at the chart and placing an order to go long or short.
I'm sure it's a lot of stuff, and I tried to do my best to compress this in a fast and simple way, but maybe it's sometimes a little too sloppy. So please interrupt.
Because this is where it's all done for you. This is you setting up an algorithm basically, and then you let that run to trade. Yeah.
Right. So,
okay, so shall we carry on?
Yeah, sure. Good. So now that we have done everything in our power to generate a profitable trading strategy, we'll put it to a test during live trading. However, we absolutely need to know that we can't expect the live trading results to mirror our backtesting results, because live trading itself is a totally different kind of animal, and it might very well be that no matter how good our strategy performed during backtests and no matter how robust it is, it just does not perform well in the real market. But if we found a strategy that is profitable, it very likely will have a lower average expectation per trade. It will very likely have longer stagnation periods, and the drawdown will be higher as well. So our strategy Winner2 has been profitable for over 4 years of live trading, and we can conclude with a very high likelihood that it is indeed a profitable strategy. Nevertheless, you need to consider that its longest stagnation period during live trading was 14 months in comparison to only 4 months during backtesting. The maximum experienced drawdown was twice as high as well. So knowing all of the above, please be confident and patient in your own developed strategy. We have talked about variance before, and it might very well be that you are just being unlucky and started live trading during a drawdown period. Now, if you are stopping your trading too early, it might be that you abandon an overall profitable strategy, what would be a shame. Yeah, don't waste money is just some general advice considering live trading. If you choose to be an algorithmic trader, please choose a reliable trading server. There are a couple of good hosting companies out there that have good dedicated servers or VPS offerings available. Please don't run your trading system on your home PC. From my personal experience, having a good latency to your broker is important as well. However, having a powerful machine is at least as important, because an overly crowded server won't do you any good, even if it has a superb latency to your broker. Also, please do choose a trustful broker. Watch out for a solid regulation and watch out for the total trading costs, which include spread and commission as well as slippage. If you are trading with a broker that, for example, has an excellent spread and the lowest possible commissions, you won't gain much if this broker is making up for that with excessive slippage on entry or closing of your orders. Or if you might have chosen a broker with a poor regulation and he suddenly decides to run away with your money or won't pay you your profits. So please be careful with who you trade. And even if you do trust your broker, look over his shoulder. Track the slippage and track the execution figures. And watch out if those figures get worse over time. Finally, please spread your money across multiple brokers to further diversify your risk, right? Good. We're coming to an end to the theoretical part. I would just like to quickly summarize what I love and hate about being a trader. First, trading in general and being an algorithmic trader in particular gives you a lot of freedom. I personally can do what I love and I can explore a new field using my very own automated solutions while having almost no fixed schedules. If you are on top a successful trader, you will also be nicely rewarded financially. However, it can be very frustrating at times because your actual monetary success is not connected to the amount of work you're putting in. Now, if trading is your only source of income, then the drawdown phases can be very hard to bear, especially as you never really know when and if your drawdown will end. Because there's still the possibility your strategy is no longer working due to some change in market behavior, for example. Yeah, personal advice to all of you traders out there, please try to minimize your risk exposure. You can do this by first spreading your capital among different brokers, as said before, and even as important, spread your capital among different non-correlating strategies. Because having a portfolio of different strategies will do both for you. For one, you can smooth your equity curve, and secondly, you can reduce your drawdown periods as well. Yeah, well, that's the end I have prepared so far. Thanks a lot for listening. If you want to get in contact, I very much ask you to please do so. You can reach out to us on Twitter or email, or you can just visit our homepage and leave a comment there. Thank you. Now time for the Q&A, I would say.
Lars, yeah, thank you very much indeed. I will repost these links out in the message box. But yes, no, lots of questions continually coming in. So you've
sure.
You've sparked a lot of interest here, which is great. Just continuing on from the last one, Saranjit making the comment again that brokers reduce spreads in proportion to volume. Can that be used reliably?
I'm not sure if I understood what you mean. You mean you get reduced spread? You mean top of book or something, or?
Saranjit, maybe you can expand on that. Can it be used reliably? We'll come back to that, Saranjit, if you can tap in, maybe just to clarify what it means exactly. What VPS would you recommend? Asks Dan.
Well, there are of course the known BixFX that I can recommend. However, you don't need to use one of those specialized Forex VPS providers because they are really expensive. If you're looking around a little bit, you have also Vulture that is also offering cheap VPS solutions, and that has some VPS locations in London and in New Jersey as well, which should give you very good latency to most Forex brokers out there.
Okay. Sarajit's come back and he says, my broker has variable spread, which he says depends on volume. Can I use that in my favor to get an insight into volume?
I don't think so. I would not know how to conclude anything out of that.
Okay.
I have variable spread as well, but I think it's too hard to tell if the spread how the spread exactly correlates to the volume traded.
Okay. Farid has come back and says, very interesting. He says, where can we find more information about different strategies for beginners who are interested in algo trading?
If you want to get into coding, I would recommend to just use the MQL4.com website, where you find lots of code examples. But please don't expect those free available strategies to produce any meaningful profit. Take them with a grain of salt, because if you really have a profitable strategy, you probably won't share it for free with the public, right? So use it as a learning platform and try to construct your own strategies out of ideas you gather there and ideas you have found yourself looking at the market. It's a long and it's a hard process, but it's worth it.
Okay, now you mentioned the VPS to Dan. He says, how do you spell that?
Walter, I'm not sure if I can send a message. It's VULTR.com.
V for Victor.
V for Victor, U for Unicorn, L for Lars, T for Theodore, and R for Risk.
Welter.com. Okay, and how long do you forward test again? Asks Tom.
Once I develop my strategy, I usually trade it with reduced risk for about 6 months, and I see if the parameters of live trading correspond with my backtest, at least in some degree, and afterwards I slightly increase risk until I have totally trust in my developed strategy, and I am absolutely certain that it is indeed profitable and it's not just a random noise I discovered in backtest data.
Okay, got one more question here from Stuart. He says, when do you draw the line for a backtest? In your example, the stagnation is 4 months, but live it is 14 months. I think most traders would abandon the backtested strategy in, say, 8 months, double the period of stagnation in the backtest.
Right, you could have done that. That's a difficult question, and I can't answer it because there's no absolutely correct answer in that case.
Mm-hmm.
If you're unlucky and you start with a 14-month stagnation period, I probably would have abandoned this strategy right from the start. Yeah, but because I've had 2 years of profits, I ran it a little longer, and I've watched the trades, and I saw that many trades were just bad luck, taking my stop loss by a pip or something, and this is the discretion I talked about. This makes forex trading so difficult because you really need to watch closely, and you make up your mind, and it's not all put in stone, right?
That's very true. It's very true. Well, Lars, I think that was a very thought-provoking and entertaining presentation. Thank you very much for putting together. I know you prepared that especially for us today. You're not like many of our speakers. We have a lot of people on it who do webinars, of course, as part of their own education businesses. But I know you did this specifically for us, so I'm very grateful to you taking the time to do that. 45 minutes to present, it can take some 3, 4, 5 times that to actually put the slides together.
Yeah, I did it.
I can imagine. We're very grateful, and here we are. Alan says, thanks, very interesting. Thank you, says Farid. Excellent webinar, says Farid. Fantastic. So you can see from the feedback that it's been very well received and appreciated by
That makes me
everybody.
really happy.
So thank you. I've copied down the details, Klondike FX at Klondike FX, and your email address and your website. So there's places there for people to go and get in touch.
Yeah, if there are any more questions I couldn't answer now, please send me an email or drop me something over Twitter, and I do my very best to answer all questions. Right.
That would be terrific. Well, Lars, thank you very much indeed, and hopefully you'll agree to come back again at some point, and maybe give us another webinar on one of our other events. We'll definitely keep in touch.
Sure. More than happy to do so.
Wonderful. Thanks very much again for joining us.
Yeah,
really
thanks for having me. Have a great webinar still, and goodbye.
Thank you very much. Take care. Bye-bye. Okay. How I Trade by Lars at Klondike FX. There we are. It was very interesting to see how the algo traders set up all the programming, and that's how it all works. Can you send us a recording? Asked George. Yes, we will. We have been recording this, so as I say, it won't be available immediately, but as soon as I can, I will try and get that out to you. Fantastic. Well, we are almost, well, we're more than halfway through our day one of the London Investment Week Live event. We've had good presentations so far. We have two more still to come. 5 p.m. Charlie Burton, Easy Trader, and then at 7 p.m. Corvin Codirla from FX Masterclass. So we can take a break now, and we will reconvene in just under an hour at about 10 to 5, 4:50 in time for a 5 o'clock start. Alan, I've no idea why you're not getting a reply when you register. I will look into that. I'm glad you are registering. Perhaps we can use another email address, and maybe it's something to do with these spam filters. Time for a cuppa, says Wayne. Absolutely, that's a great idea. So we will take that break, and we will be back. We'll leave the system will be running, but we'll just be on mute, and we'll be back in just under an hour to continue with Charlie Burton at Easy Trader. Thank you. Hello, everybody that's in the webinar. We are currently on a break, and we are starting again at 5 p.m. this afternoon with Charlie Burton at Easy Trader. So just to clarify, a few of you asking why no one is speaking, and that's the reason. We're on a short break, so we'll be back with you very shortly in just about 40 minutes time with Charlie Burton.
And a 10-day moving average on here. I've got a 20-day moving average. I've got a 50-day moving average. The green one is a 100. The yellow's a 200, and up here the red one is the 500-day moving averages. So I use just a range of moving averages there. I've also got some other black bands that I use. They're not Bollinger Bands, just something else I use. But again, they just sort of track price, and I use them for helping me out with identifying entries and sometimes exits as well on trades. Down the bottom, I've just got a standard MACD, 12, 26, and 9, standard setting. That's about it, really. So don't need too much more on that. So what I do with my personal style of trading is I always try to describe it as me reading the markets. So I'm not someone who likes to trade mechanically with blinkers on and just trading a given pattern mechanically, because I feel that that is a little bit singular in its approach, and that as market cycles change, then you could be trading a great pattern which could be doing really well for you, and then the market cycles change, and then that pattern just falls out of bed, so to speak. So what I tend to do myself is I use patterns and I use strategies with rules, but I apply them into the right market context. So when I'm looking at a market, first of all, I like to do my overall analysis. So usually a top-down approach, starting off with like a monthly chart, weekly chart, daily chart. Get an overall approach looking at where the trend lines are, support, resistance, highs, lows, and then start to build a picture so that then I can then say, okay, where would I start looking to take a trade, and what sort of trade would that be? And then I've got a number of strategies I can pull out of the bag. So I'll say, okay, well, this market is making higher highs, higher lows, so it might be a given type of pullback trade. Or if it's looking to break out, I could be looking at a certain kind of breakout trade as well. So I just pick out hopefully the right strategy at the right time. That's how I trade. I don't just mechanically trade my strategies, because too often you can be applying a strategy into the wrong market, so to speak. So anyway, what I'm going to do is I'm going to start off here with the dollar yen. I think the dollar yen and the euro dollar are both quite interesting charts at the moment. So I do want to do a top-down approach for you on these two markets, and then we'll move on to some others. And by all means, ask questions along the way. So just using a simple concept of top-down, I'm going to start off with the dollar yen, and then I'm going to do a top-down approach on the euro dollar as well. As far as the markets are concerned, my primary markets of trading are euro dollar, cable, dollar yen, dollar CAD, and the Aussie dollar. I could trade the New Zealand dollar as well, but I just don't. Spread's a bit wider on it, but it's fine to trade. I tend to trade those 5 markets as my daily sort of markets that I'm scanning and monitoring, and I tend to find that having a focused approach of just watching a selected few pairs every day tends to get me more in line with what those pairs are doing. Now that's for my sort of semi-intraday trading. As far as swing trading is concerned, then obviously you can just look at a wider range of pairs, and I do look at a wider range of pairs, but I still tend to trade those core 5 almost first and foremost, But if I do see setups on a wider range, maybe going out to 15 pairs, then I will consider taking those trades as well. So I will look at outside of those majors, and I'll look at major cross pairs as well. But there's certain patterns I look for, and I'm seeing some patterns, and I've been seeing some patterns here on the dollar yen, so I wanted to go through those with you first of all. What is the time frame, Andy? This is on a daily chart at the moment. I haven't changed it just yet. So let's get started with a top-down approach. So what I'm going to do is I'm going to start off by just looking at a monthly chart. Now, some of you will use moving averages to an extent, and some of you won't. I appreciate that, especially with currency traders. A lot of currency traders like using things like Fibonacci's and the likes. I used to use Fibonacci's years ago. There's nothing wrong with Fibonacci at all. But what I found was, in my personal trading, there was a time when I was using my moving averages and Fibonacci's and then pivots and things as well. And then you realize that a lot of the time these levels are all coming in at the same area. And all you're doing is cluttering up your charts and creating more analysis that you don't actually need. So for me, when I had to eliminate an indicator, I eliminated fibs just because I'd been using moving averages since the late 1990s, and that's how I started trading, and I still trade with them to this day. So it's a personal choice, I think, with trading. There's no real right or wrong. But anyway, coming out to this monthly chart, all I've got is these moving averages on. And what we can see already is that the dollar yen had this wonderful run. Hopefully you can see my cursor. But it had this wonderful run from 2012, let's call it, 2011, 2012, all the way up to the highs in 2015. Then over the past year, it has pulled back. This is the dollar against the yen. It has pulled back, which looks quite reasonable and quite within normal context. And sometimes when I see a big move like this, I might still put a Fibonacci on and say, okay, let's have a look and see roughly. If I'm going to just put this on roughly, where are we? We are at around about a 50% retracement there, as far as fibs are concerned. So roughly the area that we're in anyway. But I quite like seeing nice big pullbacks after a nice run, and I always say to people, well, if this was an hourly chart we were looking at right now, if this was an hourly chart, what would you be expecting next? Well, for a lot of traders, they would be saying, well, it's done a decent pullback without really much of a bounce or rally yet. A lot of traders would be expecting a bounce to come in. So the fact that it's a monthly chart just means that it's a higher time scale, and that we have to be a bit more patient for that said bounce. And so the way that I'm looking at this very easily is that we've got a 50 period, my black moving average here. The 50 has crossed the 200, so we've got what we call a golden cross. Most of you will be familiar with a golden cross moving average. And so that's crossing to the upside. The 50 period moving average is facing upwards still as well, even though price is below it. So these are subtle things that I'll look for that that will suggest to me that even though for the last few months the dollar yen has been holding down here, we still have that potential for an up move. And so at this stage, just looking at price action and moving averages and support. I know we're into support zones as well, both from the fibs, like I said, but also from technical support, more importantly, from prior lows and the likes. Then I know that we're in the vicinity for a potential bounce. Now, it always has to be potential because we're traders and nothing's 100%. But what I have to do is to drill down. So I have to go work as a top-down approach and go from the monthly down to the weekly and so on and so forth. So if I come down to the weekly charts, and bear in mind, I'm doing this analysis pretty much on the fly because I was in bed till midday today, getting over the jet lag, and then this afternoon I've just been in my trading room all afternoon with the traders looking at intraday charts. So I haven't really had any chance to do this. I'm just doing this analysis as we go. So when I come to the weekly chart here, it gives me a slightly different view. I can see that actually through a long period, obviously on the weekly chart it's obviously a downwards trend, but just because something's in a downwards trend doesn't mean to say that when we come to the monthly chart, well, yes, it's in a short-term downwards trend against the prior upwards trend. This still qualifies to me as a pullback. So if it's a pullback on a monthly, I want to look for signs on the weeklies and daily charts that we might actually be seeing some sort of up. I'm not seeing a huge amount there. The only thing I've noticed is that we've had a couple of what I call air kisses of moving averages back here. This is the 20-period moving average, the blue line. We've come up close to it, came up close to it again, come up close to it again. So we've air kissed it a few times, but never actually hit it. And I can see that's up at 103.16, as it's saying at the moment. And we're currently at 101.5, so about 150 pips higher than where we currently are. Okay, this is all just a general background analysis at the moment. Then we can come down to the daily charts, and this is when it starts to get a little bit more interesting, in that you start to formulate a plan. And when I come down to the daily charts, I'm just going to zoom out a little bit and just have a look at this. Oh, it's see, this is an interesting chart, because if I bring up a screen draw function, I don't know how good this will be, but let's see. As we can see, back up here, when price first broke down below the 50-period moving average, back up here in the far left corner of the screen, it came up and it retested to 50. And I like these. I like these tests of moving averages. I use them as support and resistance. Then it came up again over here, and again over here, and again over here, and over here. And so what we've got is successive tests of this 50-period moving average, and I really like seeing this sort of stuff, because the more tests that we have, at some point I see it that the market will probably want to break out and break through. I liken it to, I always use the analogy of you've got a pond, and this is not going to, I know this is not going to keep the it won't stay on there, but the diagram. But if you've got a pond and you're skimming a stone across the surface of the pond, usually it will bounce several times, won't it, before actually it loses inertia and then plummets through the surface of the pond. So it bounce, reacts from that support of the surface of the pond, but gradually it will start to slow down that pebble, so that eventually it will then just plop through the surface. And I use that same analogy and that same mindset towards trading the markets when I see multiple tests of a given level. So what we've got is a pebble on a pond in reverse here, because this is a resistance zone, this 50-period moving average, so I've not got that on very well, but you can see the black line there. That's a resistance zone. And so we've got pebble on a pond. We've had multiple tests of it, and at some point, because price isn't breaking away from it that much, at some point it's got that potential to break through. Okay, so at the moment we're back up against that 50-period moving average, and if I now increase my zoom a little bit so we can see a little bit better again now, I'm going to put on a couple of trend lines, because we've got a nice trend line across the highs here, and then I've also got a trend line across the lows down here. So we can see we're in a wedge type pattern down here right now. And so it really is a case of which way is it going to go. And so I don't have to worry about which way it is going to go and try and predict that. All I'm concerned about is if it goes, and then trying to identify a trade opportunity on the back of that. So first of all, if we wind this back to that monthly chart, I've got the monthly chart where we've done a nice retracement. We've come into a support zone like I've covered off from prior lows. We've got the monthly 50 still facing up. It's just crossing the 200 as a golden cross, and price is on the wrong side of them. So I quite like all of that. There's some other factors going on about my bands, which we're sort of coming into the bands as well. So I now then come down, ultimately back down to the daily chart, and I say, okay, well, on the monthly chart, it looks like a pullback within the context of the prior run. Then I come back down to the daily charts, and I can see we've got trend lines in place, and so the potential is there for a breakout of the trend line. Right, okay. So I can then say, right, if I get a strong breakout of that trend line, then I want to be looking for buying opportunities. Quite simple. A strong breakout of that trend line, I'm looking for buying opportunities. And so that then feeds all the way back up to my analysis, and it makes my job when I get good analysis like that, with the pebble on the pond that's in place as well, it makes my job easier to then justify getting onto a trade if it does break out in that direction. Now, like I've said, nothing's 100%. What happens if it doesn't and it starts to break down? Well, I think if it does break this lower trend line down here, then we've certainly got the potential to then obviously come lower and come down to, I was looking at it just yesterday, we've got this monthly 100 down here, which hasn't been tested. So I'd be looking down into, what's that, nearly 97 as a potential to the downside, because I have to always have caveats. I have to always have a plan B. But at the moment, my plan A is the potential for this breakout of the trend line. And if it does break out, then I do see that potential. And where's that potential going to run to? Then again, I come back out to my monthly chart. I've got my upper band here, which is currently showing at 106 area. And so 106 would be my ultimate target, which if we come back to the daily chart, it's up here, which will come in line with these prior highs over here, really. So it's not a nice zone, this 106 zone, this prior low, this high here, and this cluster of highs over here. Not the exact high, because that's up at 107 or so, just the cluster. And so that would be more than enough meat on the bone for me to run it to sort of 106. So there's a top-down approach on the dollar yen, and with the potential with what's going on with that. Like I said, though, the plan B is that if it breaks down, if it doesn't go for the breakout and get a solid break, then and it starts coming down for the lower trend line and we break to the downside, then I know that we've got that potential to come down to sub 97. So that's where I'm at with the dollar yen. I think it's a fascinating currency pair at the moment. It's been winding itself up here in this wedge pattern, and at some point we're going to get a break. Now, as a final caveat, a final point to note is what happens. How do I actually go about buying once it breaks out? Well, I'll look for things like a strong breakout candle. So I'd like to see a strong break of the line. So a bar which doesn't have to be a huge bar, but just a decent strong bar where price closes at or near the highs. That would be a nice sign. So in the top, let's say 20% of the bar was what I'd be looking for. And then once I've seen a nice strong bar like that, then I'm just looking for little dips on the likes of the 4-hour chart. So I would then be winding it down to, let's say, a 4-hour chart and looking for pullbacks on a 4-hour chart to get my entry. And that's how I go about it. So it always becomes a top-down approach for me. It's always about multiple time frame analysis, and I feel that if I can get that multiple time frame analysis coming in, then I always have that better chance. And if I've got good odds and good chance of success, then I always find I trade it better as well. I always talk about traders taking trades, and then once they're in a trade, they might panic a little bit, or start looking at taking profits off a little bit too soon sometimes, and they can't stick with the plan, so to speak. But if you've conducted a whole heap of analysis on a trade, then you have a much more positive view of the outcome, and you don't then get into the trade and then start worrying about taking profits and things like that, or moving your stops too soon and getting stopped out, because you have the confidence in the trade, and you have the confidence that even if that individual trade doesn't work out, well, if you carry on taking trades like that with good analysis, then your risk to reward ultimately will be really strong, and ultimately you'll be making money. And so you don't have to worry about the outcome as much on any individual trade, because if you just stick to that type of trading where you have high confidence, then you're much more likely to not dabble with the trade, not tinker with it, run it to target, and make more money ultimately on the back of it. Okay, sorry, I've just seen some of the questions coming through. What would be your entry point? Andy, I think I've just sort of covered this, because I can't actually say what the entry point would be at this stage, because it depends on the price action as and when, and if it breaks out, like I've just said. So I can give you an idea. So let's assume that we had a nice breakout bar, and then we got a pullback, one might be looking for that pullback to be into something like a 4-hour 20 moving average. So here's the 4-hour charts here. So we break out on the strong daily bar, then I'll be looking for a bit of a pullback into something like the 20-period moving average on the 4-hour chart, or even the 50-period moving average on the hourly chart. As my excuses to get long, I'm looking for small pullbacks to establish a trade. So that would be how I would actually go in. This would be for a swing trade, yes, that's right. Yeah. Out of interest, what are the black bands, David? I can't actually tell you exactly what they are. Sorry, they're a personal thing. I don't mind telling you what the moving averages are, but they're more of a personal thing. But because the reason I can't tell you is it's our customers pay us to train them in our techniques and our strategies, and using those bands are one of our strategies, and so it wouldn't be right for me to just share it for free on a webinar. So but anyway, I don't need to go into too much detail on those. All I need to say is I do use them. Obviously they're used a lot, like I said, for my entries and exits, or some exits. Okay, so I wouldn't put an order in, Gareth. No, not really, not this one. You could do, and that's absolutely fine, because you could say, do you know what? If it breaks out, I'll put an order up here, and I'll just put a buy, a buy stop order in. But as you also know, sometimes you get these false breakouts, don't you? So price might be breaking out intraday and then sells back off by the end of the day, and then your buy stop order has been triggered. Only for the candle to actually give it up, maybe give something like a shooting star, or it doesn't matter what the names of the candles are, but it's been rejected, and then potentially it rolls back over. So I don't like, in this situation, I like to see a strong close before I take any action. So I wouldn't put an order in. Once you've got the strong price bar, though, you could then put an order in for a pullback. Yes. That's what I would do. If I don't get in live, then I sometimes will just put orders in. For example, I've just been traveling in the States on this holiday, and I do trade when I'm away. I trade off my phone, and I'll put the occasional swing trades on. And so quite often I will put orders in. But if I'm around, and because most of the time when I'm here, I'm trading. I'm a full-time trader, so I have the luxury of being able to be about and see where these levels are live, and sometimes be able to execute them live. But yes, certainly putting an order against the key moving average or some sort of pullback zone, we don't know what it's going to look like yet, but if we go back to the 4-hour chart, so let's say we break right away up, it could be you put an order in on a pullback to the trend line, because quite often, as you know, when trend lines get broken, price might come back for a retest of that. So you could put an order there. So it depends on the individual. But for me personally, I'll be using moving averages to get long. That's what I tend to do. Sorry, when I go quiet, it's because I'm reading a question. Will you be waiting for the wedge to be broken out either way before you enter the market? Correct. Yes, that's right. Jackim, it's I'd be waiting for either way. Sometimes I don't, if you see a price pattern, but the way my moving averages are at the moment, we've still got the 20-period moving average still facing down at the moment, and the 10's just coming up potentially to meet it. So we're still not there yet. So it's going to need confirmation and need that breakout. So yes, it would need that. David, yeah, good question. David's asking, am I trading longer time frames these days? From previous webinars, I've been focusing on shorter time frames. It depends on what I'm doing, really, David. I am a day trader, but I'm also a swing trader as well. I would say that over the years, I am doing, although I do day trading, you see me at the shows, I'm doing a live trade-off again in February at the London Forex show against an automated system. So, I do still live day trade. But what I've done is I've introduced more swing trading into my trading in total. And the reason I've done that is, you know, we all get older, and time becomes more precious. And as much as I enjoy day trading, I also find that, oh, okay, I can put other types of trades on using hourly, 4-hourly, daily charts, and I don't have to be there monitoring a 5-minute chart like you do when you're intraday trading like that. So when I'm trading in our trading room with our traders, then I'll be doing that. But outside of that, then I am doing more swings, yes. So I still do both, but I've just introduced more swings on top because it just allows me to think. I have, oh, you know, years ago you would have to like get out of bed at, you know, well, 7 a.m. let's say for me, make sure I was in front of my screens all ready by sort of 7:30, and you know, I'm much more relaxed now. I remember when we got to the end of the financial crisis and all that volatility that we had from sort of late 08, early 08, 08, 09, 10, and I can't remember if it was the end of 2010 or the end of 2011. But I remember we got to that December, and then it was almost like someone turned the tap of volatility off in the currency markets. Not to a massive extent, but they just calmed down. I think it was in December of 10 or 11, off the top of my head. And it was almost like I let out a sigh of relief because you were just so busy every day. You don't realize just how busy you've been and how maybe sometimes exhausted you've been. I mean, that was a, you know, unprecedented level of volatility, and I wanted to take advantage of that like so many of us did. But you get to the end of it and it was quite a nice rest. And so since that volatility's died down in the last sort of 4 to 5 years, I've not been as aggressive in all of the intraday trading, and so because I haven't needed to be, and so you just pick off a couple of intraday trades here and there, but not doing 10, 15 a day anymore. It's more like, you know, 1, 2, or 3. So it's a more relaxed pace. And then if I'm doing the swings as well, if I've got to go into London to do an interview or something, anything, or you know, work-wise, it doesn't matter so much now. Whereas a few years ago, I'd be thinking, oh God, I've got to go into London for the day today. I'm going to miss out on day trades. Whereas now, because I'm doing more swings, it doesn't matter so much. It doesn't matter that, oh, I might miss some big moves on the intradays today because I've got these swings in the background working away for me anyway. Hopefully that answers your question there, David. David, you're saying you're much older than me. Yeah, I think it's yeah. I don't want to go labour the point much more, but yeah, I love day trading. It's a passion of mine. There's nowhere where you get that instant feedback like day trading. You know, day trading usually within getting into a trade, within a couple of hours, you've got feedback. You've either been successful in that trade or unsuccessful. You've got that feedback quite quickly. Sometimes with swing trades, it can take weeks before you actually know whether you're going to be profitable or not. So it's a completely different mindset required sometimes. But the flip side to it is that you haven't got to be there in front of your screens quite as much. And so, especially over the summer months, I tend to be doing more swings and higher time frame trades over the summer months because I want to be outdoors a bit more. In the winter months, you know, I'm more like a hermit, so I will be doing more day trading during the winter when it's dark, and because I'm not out and about as much. So anyway, that hopefully answers that question. So that's where we are with the dollar yen. What I want to do now is, I thought I might only have half an hour of content for you, but it's amazing once you start speaking how much more content you have. So I'm sure Simon's okay at the moment with this, but I just want to switch across to the euro dollar actually, because the euro dollar and the dollar yen do move in quite often. They're quite often they're negatively correlated. Not by any means close to 100%, but they are negatively correlated. Quite often when the yen's going up, the euro's going down, and so on and so forth. So I do want to have a look at this euro dollar but it's not the same pattern as the dollar yen in reverse. But we have got some interesting stuff going on with this euro dollar, and I feel that I want to just cover this off with you as well. Where are we? Right, monthly charts. Okay. So with the euro, since we broke down into early 2015, if I can zoom out a little bit, we came down and we hit this trend line, which really started back in 2001 on the euro. And it's been supported into 2015 and then again into late 2015 on the monthly charts. So we can see that it held. But again, and we've got a trend line across the highs here, all the way back to 2000, from the highs of 2008. We've got this trend line. So we've got this euro dollar again winding itself up on the monthly chart with between two major trend lines. So I'm well aware of that, and I know there's plenty of commentators out there who are talking about the euro going lower again, and it could well do that. But at the same time, I'm having to keep my options open to the euro because I know that markets like to go back and test trend lines, don't they? They like to go and test trend lines. They like any other area of prior highs, prior lows. We haven't, for argument's sake. We've got these lows here from 2008, 2010, and then again in 2012. All around the same area. Since breaking down, we haven't really come back up to retest those yet. So from a technical perspective, I can see the potential for this euro to carry on winding its way within this whole these two trend lines. And so although I have to fundamentally keep at the back of my mind that the euro could want to break down because there's issues in the eurozone fundamentally, but I'll let the market talk to me. And if it starts to break down, then I can start looking at that. At the moment, if we go to a daily chart, let's just get this zoom right first of all. If we go to a daily chart, since June, actually, well, yeah, even since June, we've been making higher lows, and we haven't been making. We started making higher highs right away into August, and now we've not continued to make higher highs. So, and it's getting very sloppy and scrappy on the daily charts. I concede to that, but at the moment we've not really made a lower low just yet. And so what I'm seeing, if I come out to maybe the weekly chart, it might make it a little bit easier. Okay. What I've put is a trend line, this red line here, I've put a trend line across the tops here of all these times that the euro dollar has been hitting this same level all around about 114 or so. I've got some old trend lines here, I've got a trend channel as you can see here, and sometimes I like to leave these trend lines on and trend channels because markets like to go back and test them. But anyway, so we've got this horizontal trend line. I call it around about 114 or so. I'm not too precise with them. I'm not too fussy when I'm looking at overall analysis there. And obviously we've got this lower trend line down here. Now, this is the one that goes back to 2001. So yet again, we've got a market which is going sideways, as we can see on the weekly charts here. It's overall going sideways. But which way is it going to go? If it starts to break down and break to lower lows, then on the daily charts, then we've got a good chance of it coming back down to test this trend line down here, which is down in the 106s, 106.80 it says at the moment. Let's call it 107. So there's plenty of scope to the downside if the euro wanted to break there. Likewise, though, if the euro started to break up, then and we get back up to this resistance zone again, it's been hit so many times, it's a bit like that pebble on the pond again, that I just look at it and think, okay, if we break this time, that could have a bit of a breakout and come into the upper teens. Okay, so that's how I'm looking at the euro dollar at the moment as well. So although we can look at a daily chart and say it's choppy and it's, there's not too much going on, by doing the bigger picture view, and there's more to it, but I'm conscious of time now. But the euro is another market that is quite interesting. I'm just having a quick look here and see if we've got a trend line in play there. Not really. I'm trying to make that work. I don't think so. So we've got a market here again, which is could well break in either way, in whether it breaks to the upside, breaks above this 500-day moving average here, and then heads up towards that 114 zone, and then I'll be looking to see if it breaks out and then heads up into the upper teens, because of when we come back out to the monthly chart, when we come back out to that monthly chart, we've still got this big triangle pattern potentially in play, and at least for the euro to come back up and retest these old lows from up here, which are all in the upper teens, or even into around about 120 or so. So there is the potential there, but likewise, I quite like this both ways. So we've got that as a potential to the upside, and to the downside, if we start to break these last higher lows, which are around in the 111s, so let's call it 111, I think it was 111.30 or something like that, roughly from what I remember. If we start breaking down there, then I do think we've got that potential to then really start to kick off to the downside on the euro. But I think both the euro dollar and the dollar yen are both very interesting charts at the moment, and without doubt I will be trading these on a swing basis over the coming weeks. Do I think the euro will take a hit now that the yen's part of the IMF? Who knows? I don't try to fundamentally explain a market move, because so often fundamentally a market will do its own thing. It might eventually come in line with the fundamentals, but not always immediately. And I remember I was, for example, I'll give you an example. I was back in, where's that? 2000, oh, okay, a bit lower. Yeah, so when the euro was making its lows down here, and it was a bit after that, I was being interviewed on Tips TV, and the interviewer was saying, well, Charlie, what's your view on the euro? Surely the euro at this point is now going to roll over to make new lows, to come down to parity. Fundamentally, you know, it's flawed against the dollar, etc., etc., etc. And fundamentally, the argument is valid. But technically, at the time, I was seeing a market where the sentiment towards that market at that time was majorly skewed to the bearish side. And when you've got a market, as a lot of you know, where market sentiment is skewed to one side or another, then quite often the market will then go and do the opposite. Because if everyone's short on the euro at that point, if the majority of people are short, so let's say, then there's no one left to sell. And so it only takes a little bit of buying or short covering to then create a bounce and a rally, and that's what we saw in the euro, and it very quickly went up to 117 over the coming few months. So fundamentally, I can always acknowledge, because fundamentals ultimately do catch up with price, but I don't always trade off of fundamentals. Sometimes they become more prominent, but other times I'll take a backward step. So at the moment with the euro, quite happy either way. I'll just play the technicals. I can see the technical argument for the euro to move in either direction. I can see the fundamental argument for the downside, less so for the upside, I must admit, but I've been around long enough and I'm ugly enough to know that I shouldn't just base my views on fundamentals, because I've seen plenty of occasions where, both in the stock markets and in the currencies and commodities, where you have a fundamental view and the market will go and do completely the opposite first of all, put in a big rally, and then it might roll back over, but it would have taken out a load of traders in the first place. Anyway, so not too much of a view on that one, on that question. So I said I'd cover off a few markets, but we've already gone 50 minutes here and we've just covered off two, which has been quite nice, because we've done a full sort of top-down approach on two different markets there. What I also wanted to do was to do a general Q&A session on the back of this, but we might only have about 5 minutes left. So if anyone's got any general trader questions, it could be about what we've just talked about this evening, or any aspect of trading, then by all means fire away. And whilst some of you might be typing, I guess I'll have to keep the airwaves a little bit away from going to silence. So I'll just see if there's any questions coming through. There may not be, and if there's not, there's not. But I thought we'd add it on and say, look, as I didn't have a official presentation to do tonight, I said I'll just run through some markets. And there's no point in me running through markets just on an intraday basis, because obviously by tomorrow, when the main trading is done, looking at an hourly chart now or 15-minute chart now, it's not going to be adding too much value to what's going to be happening in tomorrow's markets. So it's much more applicable to do swing analysis today.
Hi Charlie, I think you've answered a lot of questions as we've gone through tonight, which has been fantastic.
Yep, I didn't know if we might get any through, but I'm not seeing any just yet. So if there's not, then we can always. I guess we've gone a lot longer than we thought.
One's Joaquin about the euro and the IMF. I think you talked about that already.
Yep. Okay. We've got. Oh, they're coming through now. Okay. So Paul's asking, do you take any swing trade if there is no trend on the monthly chart? Oh, good question, Paul. It's less a point of trend. It's more a point for me of what I'm seeing on the monthly chart. So it doesn't always have to be a major trend on the monthly, but it's like, for example, a major divergence in play on a monthly chart, Paul. So in which case I'll be aware of that and then factor that into my trading off of maybe daily charts. So I like it if I've got everything lined up to the monthlies and I've got a whole piece of analysis I can do. If I don't have that, but I have a strong pattern on, let's say, the daily charts, then I will just trade a swing trade on just purely on daily time frames, even if I'm not really got anything showing. It's not really giving me much on the monthlies. It's the monthly price action has not been doing much, but I've got a strong pattern on the dailies. Then yeah, I'll still trade them. But my preference is to get the top-down approach and have a whole story there. So from monthlies, weeklies, and down to dailies. My preferred markets, Gareth, are on the currencies, euro dollar, the cable, so pound dollar, dollar yen, dollar CAD, and Aussie dollar. Those are my preferred 5, but I will trade other markets as well. So like I said at the beginning, I'll trade other cross pairs, euro yen, euro CAD even, euro Aussie. There will be other majors. I tend to stay away from the Swissy. I don't trade Swiss. I know lots of people do, but I don't. And that stood me in good stead a couple of years ago, or a year and a half ago, when the Swiss National Bank removed their peg, and a lot of people who were trading Euro Swiss at the time got caught. But those are my key markets. I do trade down the S&P as well on a swing basis, and I do trade gold as well on a swing basis. So there are other markets that I'll trade as well. Do you look at candlestick patterns, and which ones, Paul? Yeah, okay. As part and parcel of the analysis, sorry, Simon, am I okay to carry on for the next few minutes here?
Absolutely, Charlie. Yeah, we don't have anybody starting at 6. The next speaker's at 7. Not suggesting you go on for another hour.
No, I need to get wrapped up as well. So yeah, we'll go another 5. I just wasn't expecting to go for this long, as I've exceeded my own expectations. Yes, so as part of my overall analysis, Gareth, I'll take into consideration candlestick patterns, so I am aware of them, but I don't look at a market and say, oh look, there's a bull harami, or there's a dark cloud cover pattern, and I've got to react to that. So I don't necessarily react directly to a candlestick pattern, but if I'm trading a certain market and I'm looking for an entry, and I just it just seems to happen that there's been a number of price patterns, then that's a bonus. So, for example, or candlestick pattern, should I say? For example, quite often, if a market's come down to a support zone and then it starts to, day after day, there's been, or if it's an hourly chart, hour after hour, I see lots of indecision candles like spinning tops, dojis, that sorts of thing. And I've got divergences in the background, and it's into major support as well. That gives me a good picture. So, but a candlestick by itself, not always, but sometimes. Let me give you an example of a candlestick. Okay, so here's a really good example. If you remember back to this was December of 2015, and I remember this trade well because the euro dollar had been coming down, but I could feel the pent-up sentiment towards the downside, and yet we had divergences coming in, and it was against support. So I knew that we had this potential for the euro to come up. And then this was a day that if some of you remember, Draghi was speaking on this day, and it sent the euro so much higher. Well, I mean, it's a huge bullish engulfing candle. But how do you actually trade that? I can't trade once I've seen that and just buy, but I wait for a pullback. So I managed to get in on a pullback back here. So yes, things like that, I knew that we had a nice strong candle here, wait for the pullback and then buy the pullback. So it's that sort of thing. So yes, I do use them, but it's always in the context of whatever else I'm seeing. So I'm just having a read there. When do you do your analysis? Well, for me, Gareth, because I'm pretty much here most of the day. So I get up in the morning, I'll go to the gym at some point in the morning, but my analysis is being done almost constantly because I'm here in front of 6 screens every day. So I don't have to sit down and say, right, I'm now going to analyze such and such market, because I'm looking through them as a sideshow, really, of what I'm doing anyway. So I don't say, oh yeah, look at them at a certain time, because I'm here pretty much every day. Not necessarily glued to my screens all day, but I'm here, this is my office, and so this is where I work from, and so this is where I'm keeping an eye on what the markets are doing. So, but if I was to have to give advice to anyone for doing an analysis, then yes, I would advise doing an analysis in the evenings or any other time that you're not actually trading. So because doing analysis whilst the markets are moving, you're more likely to get distracted, and you're better off doing analysis when the markets are quite quiet and not really up to much. So again, you could do some analysis at the weekends as well. And quite often I'll work on a Sunday afternoon, usually writing a piece for Simon and a few other bits and pieces I do. And so it's quite nice doing analysis on a Sunday. It sort of sets me up for the week. I quite like doing that as well. What do I day trade, Tony? Well, the same markets. It's those core markets that I've already mentioned. So the euro dollar, cable, Aussie dollar, dollar yen, dollar CAD. So those are the main markets. And then of those 5, if I had to say, well, which ones am I trading the most? Well, it does vary, but the top 3 are dollar yen, euro dollar, and cable. And then Aussie dollar and dollar CAD come below those. So those would be my top 3 out of that. But again, it's a personal style, it's a personal thing. There's other traders who like watching 10 markets on an intraday basis. There's nothing wrong with that. I just always liked to focus, and I like to focus on a few markets. If I was scanning 20 markets, I'm sure I'd find lots of opportunities, but it's a lot more work doing that. I'm quite happy to be laid back and then just wait for certain types of trades to come along, and I'm quite happy to sit around and not having to be in the market constantly. I'll usually be in a trade, well, like I say, in this current environment, once or twice a day on an intraday basis. But I'm quite happy if the day doesn't allow it to not trade at all. I haven't traded at all today, but then again, that's partly down to the fact I've just come back off of holiday, and I like to just get my eye in on the intraday markets before actually starting to trade them. Okay, well, I think, Simon, we'll leave it at that, because that's been best part of an hour now, and I've got another webinar to do for my own traders at 7 tonight, a swing trading webinar, fun enough. So I'll leave you to it. Hopefully, I've filled that hour well enough for you, just on the fly like that.
You have. That's been fantastic. Just out of interest, and you've got another webinar. If people want to come and join that webinar that you're doing this evening, how could they do that?
They can't actually sign it. It's for a subset of our customers who are swing traders, and it's purely for a certain group, and they pay for that. So I can't open that up, unfortunately.
Okay, it's a premium event. That's fine.
Event, yeah.
I will put the code in for people that do want to come and join your trading room, though, because I know that from time to time there were 2 free days in the trading room.
Yes, so, we do. I think we've got some coming up in October, because usually when we go to Lisa's event, we've got the London Investor Show coming up, and I am doing a presentation there on that show on my top 10 tips for trading and various elements within that, and some trading stories and all that within that presentation. But on the back of those shows, because there's usually quite a few people we meet, we say, oh look, have 2 free days in our trading room. So those dates will be coming up in the latter part of October. So yes, if anyone's interested in just seeing what we do on an intraday basis, watching us trade and all of that, and analysing the markets in real time, then by all means, yes, they can get your link if you've got one.
Fantastic. Well, the link's there in the box, easytrader.com/round the clock. So you can go there and sign up for one of the next 2-day sessions in the live trading room. So, Charlie, I'll let you go. Thank you very much indeed. It's a great favour you did me, and I can see by the amount of questions and the engagement we've had, it's been well received by everybody here as well. So, our thanks to you for coming and joining us, and look forward to hearing from you again soon.
Thanks, Simon. I'll see you all soon. Take care for now.
Wonderful. Bye-bye for now. Yeah, so yes, everybody saying thank you to Charlie Burton at Easy Trader for sharing really quite a sort of an inside look at how he does it. Just that's it. That's what he does, and this is what he does, and it's been working for him for many, many years. So it's always a nice, transparent way to see how he doesn't overcomplicate it too much, which is what I love about Charlie's style. So we are going on another short break now until we have our final speaker for today, Corvin, who will be coming and doing his successful speculation presentation. Corvin Codirla, our former hedge fund manager, now mentor FX coach. He will be starting at 7 p.m. So again, we've got just under an hour's break before we return from 7 till 8 to round off this first day one of the London Investment Week live event. So going over to a break now, and we'll be back shortly. can see it now, yes. I wonder if we can ask people at home as well if they can just confirm to us that they're looking at the FX with the yellow tick and they can hear Corvin speaking as well as myself. Great. Thanks, Paul. Thanks, Robert. That's wonderful. Okay, so successful speculation, how to really make money. Corvin, we've got about 45 minutes as the usual time. Would you like me to bring the questions in as they come, or would you prefer to wait until the end?
Let's wait until the end and have a Q&A session then.
Have a Q&A session afterwards. Okay, fantastic. Well, I'll hand over to you and say Kevin Codirla from fxmastercourse.com. Thank you for joining us, and I'll hand the microphone over to you.
Thank you very much, Simon, for having me on board. So, the purpose of today's presentation is to really dig into what speculation means and to actually make you go away feeling that you've got some access and some knowledge of what professionals out there actually do and how they think. And ultimately, that really boils down to understanding what the factors are that professional traders look at. And by the end of this presentation, I'll have given you 3 exercises that I urge you to do, on the back of which you'll be able to go away and more or less implement some very first steps towards very successful long-term growth of your wealth. So there are 2 components really that drive trading success, and these are the ones that we're going to cover. Ultimately, with these 2 components, they break down into risk management and edge. You have to go out and combine them in a fashion that will produce the kind of growth that you're looking for. And just to be very clear, I'm not the kind of guy that advocates get-rich-quick schemes. So I'm talking about the time horizon that is 1 to 5 years in the future. And we're also talking about annual returns here that focus around the between 50 and 100% returns, which, given that it is your own personal investment and you can leverage, is something that is very doable. And of course, we're going to be focusing on the FX markets primarily because that's my background. That's what I've been doing for the last 15 years. And a lot of the strategies that can be applied to other asset classes, at least conceptually, move over and transfer to the FX markets as well. And as I said, I'm going to give you 3 exercises that I really urge you to go away and do yourself. So let me recap. The message is, if you have the right edge and the right risk control, you can make money. And of course, when people say edge, they tend to conjure up in their mind some magical, mythical box that produces perfect prediction, 97% hit rate, etc. That's garbage. That doesn't exist. And as I'll show you, to find an edge is very, very straightforward, and people have been doing it all over the place for a long time. The question is to identify it and utilize it, and also jump over the hurdle of worrying or considering each trade by itself. One of the big challenges that traders face is they want every trade to be right. That just doesn't work. You have to look at the long-term aggregate growth of your equity curve in total. And then you have risk. And risk management, a lot of people tend to think about it in terms of stop losses, in terms of controlling your downside. And what they tend to forget is that trading isn't just about controlling your downside, because otherwise you wouldn't do it. It's about making money. So the real question is here, how can risk management help you to really grow your capital? So before we get into the meat of things, I wanted to give you some background about myself, and probably not a lot of people have come across me. So I've been on the city since 2001, worked at lots of various big hedge funds as well as in investment banks, developing trading strategies right from the very start. And my path was very similar to private investors as well. You have information overload, you chase systems, you look at the sexiest new ideas, from wavelets to neural networks to Kalman filters. You try to constantly come up with signals that predict the markets and make money all the time. You also make rookie mistakes, you over leverage, you run losses. And ultimately, after 7, 8, 9 years of going around in circles, I came to the conclusion that actually trading is something that can be sustainably implemented, and I set up my own fund. I was very fortunate to be backed by several banks, and that was in 2011. And last year we also got an award from Barclay Hedge, the big hedge fund database guys out in the States, top 10 in terms of currency returns. And then in the bottom left-hand corner, you can see the returns from the beginning of 2011 till the end of 2015, at which point I decided to exit the venture and do my own stuff and focus primarily on trading my own capital. So let's go back to the question as to what makes pros successful and how you can emulate them. You know, we started out with the questions right at the beginning of the presentations in terms of have you ever wondered what it takes to make money on a consistent basis, just like the guys that you read about in the newspapers? And the answer is, as I said, yes. It really boils down to discipline, and we're going to go through an exercise in terms of how you can strengthen that. But ultimately, it comes down to the two factors I discussed. Controlling risk, and of course that's known as cutting losses, and you have Buffett's very famous quote, rule number 1, never lose money, and rule number 2, never forget rule number 1. And number 2 is edge. And let me recall what I said before, edge is a very misused word. A lot of the times when investors came to me to invest money with us, they asked what is the edge, and of course, a very flippant answer would be, you know, I've bought the S&P 1982 and sat on it, and nobody's actually going to want to invest money with you and pay the 2 and 20 fees on the back of your money hedge fund management. Why? Because they're looking for something sexy. They need to justify the fees they're paying. As a private investor, you are not handicapped by that kind of expectation. You can truly go out and do the most basic things to accumulate capital. So let me recap, because that's over and over the message that needs to sink into your head. It's about risk control and edge. So let's cut to the chase. Let's look at risk. So when everybody talks about risk, what do they mean? They're talking about cutting losses. And of course, that's in terms of stop losses, letting your winners run, being quick to cut your losses, etc. And the reason they talk about this is because they've got at the front of their mind preservation of capital. But as we said at the very start, trading isn't just about preserving your capital, because nobody's truly happy at the end of the year to be flat on their P&L. They actually want to make money. And that's where the real secret to risk control comes in terms of cutting your losses. It's not just about not losing money, it's about making it. And the way you do that is by utilizing leverage. And leverage is a very scary word for a lot of people, especially within the FX community, when brokers offer you something like 200 times, 500 times leverage. That's a misused notion. That's just the margin. That's just the deposit they require for you to control a position. The true leverage, you control. For instance, if you were to deposit $10,000 into a brokerage account and just decide to trade 1/10 of a standard lot, that's a leverage of 1-to-1, even though the broker might just require $20 of you to control that position. But ultimately, it is leverage that allows you to make the money, and the leverage only comes out of the risk control. So I want to really elucidate that with a very straightforward system that's worked over the last 6 years, as you can see on this chart, even longer, going backwards to 2001. And we're focusing here on the euro-dollar currency, and we're looking here to start out with the red line. So the system works how? Every morning, it's called the London breakout strategy, and most people probably have come across it in one way or another. Between 5 and 8 o'clock in the morning, you look at the range that euro-dollar has set. And then you set a buy stop and a sell stop on those sides of the ranges, and you let the position execute any which way it wants to during the day and hold it until the end of day when you close it out. So for instance, if you have a day where in the first 3 hours of London Open, a currency decides to swing 150 points either side, setting that range, obviously should you go long, your stop loss is 150 points away, which can be quite a long way away should it decide to revert. So ultimately, the red line shows you a system that doesn't have any fixed stops and more or less lets the stops be set by the range set by the market in the morning. Of course, everybody will say that's not necessarily the most viable thing. We would like to have fixed stops, and that's where the blue line comes in. Here you set a 50 pip maximum stop away from entry. So let's say that euro-dollar has set a range of 112.50 and 112. Let's say 11300 and 11200, and it breaks above 11300, then you set your stop at 11250, so 50 points away from entry. So by cutting down your losses, you can see that the blue line performs much more smoothly over time. However, going back to the point I made before, it doesn't actually make you more money. So that's really where the penny should drop. Risk control isn't about making more money, it's about smoothing out your P&L. So then, how does that help you? What is it that you do now with it? Well, the point comes about in terms of how the two P&L lines zigzag around. As you can see, the blue line is much, much smoother than the red line. So how can you exploit that? The answer is in terms of equalizing risk. If the blue line doesn't swing about as much, it means that there's not as much risk on that system with a fixed 50 pip stop compared to the one that's red. So effectively, you could take bigger position sizes. So let's see how that manifests itself. If we were to equalize everything so that we experience the same P&L swings as the S&P, you get this chart. As you can see, the blue line from before, because we've leveraged it up, performs much, much better than the red line where we don't have a fixed stop. And I've plotted on the green line just to exemplify how the S&P 500 would have behaved with the same kind of swings, P&L swings, since the beginning of 2010. So that's the whole point. By controlling your downside, you can leverage. And of course, the way you leverage is a question in and of itself, and ultimately you get to Kelly betting, but we'll see that towards the end of the lecture. Now, this entire concept is really summarized in a quote by George Soros, who said, "It takes courage to be a pig. It takes courage to ride a profit with huge leverage," which is exactly what he and Stanley Druckenmiller did back in '92 when they broke the Bank of England by taking massive short positions on pound, given the economic situation at that moment in time. Of course, ironically, in June with Brexit, Soros himself didn't believe that Brexit would happen, and he was long sterling and lost money on the back of that. But the whole point, again, is once you understand your downside, you can leverage the hell out of it to make a lot of money. So edge, ultimately, it's not just about controlling the downside, it's about getting paid for something. And that's ultimately what in trading edge means. You need to understand what the market is willing to pay you for. In hedge fund parlance, that's called getting paid for beta. It means that you're holding something risky and the market is compensating you for that risk by a certain amount. So I'll give you certain examples. For instance, in equities, you've got a bull market and you've got long-term upward cyclicality in equity markets. Of course, you've got downswings as well, but the whole point is that you're buying shares in companies, tangible bricks and mortar, and with long-term macro policy, governments want the economy to grow, and ultimately companies are the private sector of the economy. By participating, by buying that, you can participate in growth, and of course there are various subsectors. You can look at growth companies and value companies, etc., etc. In commodities, it tends to be much more driven by supply and demand, and that's why you have these massive explosive trends. So you get paid for holding big, long trends when other people want to get out of the market. And so the big question, of course, is from my perspective, being an FX trader, is what about Forex? What is it that you track there? Well, within the Forex market, there are three pillars that really drive the movement of FX. First one's interest rates. And you can clearly see that in the last couple of years on the back of dollar strength, with speculation as to when Yellen or the Fed would have to start to hike interest rates, because ultimately, what is FX? FX is the exchange of two amounts of cash into two different deposit accounts. If, for instance, you're in England and you see all of a sudden you got a letter from Lloyd's telling you that your savings rate is going down even further, and you look at New Zealand, where their interest rates on an annualized basis is something like 2.7, you think, you know what, I'll put all my money in New Zealand because I'm going to earn a higher rate of return. And that's known as the carry trade. The other one is value. So imagine this, if you're a tourist and you bring back an item out of New York City that looks exactly identical to something you found in London, well, those two objects should be swappable one for the other, and they therefore set an implicit exchange rate. As an example, you buy a bottle of Evian water in New York City for $1.20, which you could buy here in London for £1. So the sterling dollar exchange rate should really be $1.20 to the pound. And if in the market you see that the exchange rate is at 1.30, for instance, you know that the market is overvaluing the pound. You can sell it. And the other one over much shorter time frames are flows. Flows dictated by actuarial necessities. For instance, it's known that every 3 months the Japanese have to rebalance their books and repatriate money, and therefore yen plays up every quarter. Or you've got the fact that England has to pay the EU a certain amount of money towards the month's end, and so euro sterling will have certain fluctuations. You've got M&A acquisitions, and you've got other flows due to rebalancing of portfolios by central banks. And there's no need to really know the underlying story, because the short-term trends tend to follow through, and that's known as momentum. So those three factors combined allow you to create an index, an FX index. So if you think about the markets, there are other indices out there, such as the equity index, the S&P 500, that tracks 500 equities combined together. And over the long run, going back to the argument we made in terms of long-term macro growth, we expect equities to go up, and indeed they do. So what happens in the FX markets if you combine these three factors? This is what happens. You can easily take the data, rebalance this portfolio based on these three factors once a month, and go back for as long as the data takes you, in this case since 1996, and you can see that it grows steadily and goes to the upside. And especially during 2008, when you had the big financial crisis, when equities dumped by 50% or more, this index performed. So the great thing about having an index is it addresses the most basic issue that an FX trader has. What do I compare myself against? You see, for equities, it's pretty easy. You compare yourself against the S&P, the DAX, the CAC, depending on where you come from. However, within the FX markets, you don't have that. And that's the whole point about understanding this methodology, creating something that you can benchmark yourself against and become better at coping with drawdowns, at having a long-term perspective, and even trading the index per se if you're so inclined without having to worry about short-term fluctuations. So we have an index that grows. Well, what happens when we combine with a concept of risk and leveraging? So let's leverage it like a peg. Let's actually leverage that index 8 times. Now, the reason I chose 8 times was not so much because of Kelly betting in this particular circumstance, but to make the risk comparable to the S&P 500, which has experienced several 50% drawdowns, most recently in 2008. So the question, therefore, is, how does this benchmark look when you leverage it 8 times to make the risk comparable to an equity? Well, the answer is actually quite astounding. You get 41% annualized, which is tremendous return, whereas the S&P only made 7% a year over that time period. And this is more or less what it looks like. Yes, leverage gives you massive up and down swings, but if you're the kind of guy that tells me I'm happy to hold an equity, then this shouldn't exactly astound you. And more importantly, over this period, you will have turned $1 into 900 or 800, and it'll keep on growing and going up. So, just to summarize again, it's about risk control and edge. I'd like to introduce some exercises that you can take away and do at home immediately so that you gain an actual concept of what this means. So the exercise number 1 is in terms of risk control and discipline. So risk control is about following rules, and the biggest issue that a lot of people have when they start to trade is that they formulate a system that's internally consistent, makes logical sense, but they just don't stick to the rules. So I'm going to call this the random coin flip exercise. What you do is you take a coin, you flip it, and if it's heads, you go long. If it's tails, you go short. So this is very much an intraday strategy, really focusing on doing as many trades as possible to test yourself doing those trades. And in both cases, long or short, you put a 20 pip stop on the trade. If the trade is showing a loss after 5 minutes, close it out. I don't care if it's only a loss of 0.1 pips and it looks like it's going to go into profit in the next 30 seconds. At 5 minutes, close it out. If after 5 minutes it shows a gain, let it run with a trailing stop of 50 pips. And if you're lucky enough that this trade makes money by the end of the week, close it out then. The whole point is to keep an accurate log and to stick to those rules without exception. Now, a lot of people ask here, does this thing make money? And the answer is no, it's not supposed to make money. It's supposed to teach you about discipline. Because once you start to do this, you come across some very interesting emotional reactions. When you see people going to Starbucks and they're quite happy to spend on a latte or a macchiato and a muffin, on the other hand, if they trade this exercise with nano lots and lose $2 because the trade went against them, or they slipped up, didn't stick to the rules, you're going to see them incredibly angry. And that's the whole point about emotions entering your discipline. Doing this exercise will confront you with those emotions. And you can see some of the feedback from the students that I've had who've done this exercise. As I said, spending $6 on a muffin and a coffee, most people don't bat an eyelid, but even losing $2 on a trade drives them up the wall. And it's only once you overcome that particular reaction to the markets that you become sanguine and you can step back and you can look at the results in an objective fashion cold-bloodedly. That's only when you start to make progress, because then you start to think clear. I urge you to go and do this exercise, and as you see, it's really about getting to know yourself and understanding how you react during times of stress. And by doing 50 trades in a row in quick succession, I guarantee you, you're going to make a tremendous jump ahead compared to most other people who just talk about risk discipline. The second exercise I want you to do is when involving the fundamentals of currencies. And it'll sit you as said ahead of 90% of most currency traders, because it'll confront you with what fundamentals are and how markets react to fundamentals, and it's the backbone of actually a very profitable system. What I want you to do is to pull up your favorite currency chart. In this particular case, I pulled up Euro-Dollar, and to actually mark out when the central bank meetings are for that particular currency. So here I did only half the exercise. I marked out in blue the Euro, the ECB meetings. Now, why would I want to do that? So we said interest rates and the carry trade form a backbone for currencies. So who sets interest rates? Central banks do. And once they have a shift in policy, the markets tends to react, have an inflection point, and move the other way. So once you start to go through your currency pairs and you see how central banks, once you overlay the boxes on the dates, on those charts, affect currency markets, you're going to get a much better perspective as to how you should interpret it. Whole point here is to never try to anticipate, but to follow through with the market. So the question therefore is, once you've marked out on your chart where these things occur, how do you trade them? Well, it's actually very straightforward. Look at the day on which the announcement was, and that forms a high and a low. And just like the London breakout strategy, set a buy stop to the top and a sell stop to the bottom. And once it breaks for the next day, hold it until the end of the day in which you close out the position. How does the system perform? This is the performance of the system going back to 2009, marking out all the central bank meetings for the ECB on the Euro-Dollar. And actually, I urge you to do this not just for Euro-Dollar, but for dollar, yen, and for the other major currencies, and to combine the P&Ls and see how they form in conjunction together. It forms a very tremendous system because it's based on the notion that the market oftentimes gets wrong-footed or positions itself the wrong way, and that way you capture policy shifts that weren't anticipated. And especially now during this kind of time of anticipation as to what the central banks will do around the world, the system is tremendously profitable, and it'll very much confront you with the fundamentals of what it means to trade currencies. The third and final exercise is really about how to trade it like a hedge fund. And it takes everything we've come across up to now in terms of risk and edge to combine it to create a very potent portfolio. And when people say to trade it like a hedge fund, well, the truth of the matter is most hedge funds are multi-strategy funds, means they cover a lot of assets, equities, bonds, and commodities. And so the first reaction is, oh my God, how exactly do I trade this stuff? You know, there are hundreds, if not thousands, of equities, bonds, tend to be usually over-the-counter, and commodities. I need a futures account. Well, that's not quite true. See, we live in the great 21st century where we have ETFs, exchange-traded funds, that more or less encapsulate a lot of these markets and are trackable just like indices are. So let's have a look. For equities, go and look at the SPY, which is the S&P tracker fund out in the States. For bonds, look at the ticker AGG, which is the iShares Barclays U.S. Aggregate Bond Index, looking at all fixed income products in the U.S. with a 10-year maturity over 1 year. And commodities, look at the tracker of the GSCI, the Goldman Sachs Commodity Index, which of course is the benchmark for those particular assets, commodities. Now, each one of them has a particular edge. So equities, as we said, goes up, so go long S&P. Bonds go up, so go long bonds. There are slight things that you can do to tweak that, but we're going to keep it really simple. On commodities, well, commodities don't always go up. They go up and down. You know, no commodity will ever go down to zero, but no commodity will for a very long time cost $1 million. But as we said right at the very start, it's the trend in commodities. So in this particular case, just buy the GSG tracker if it's been rising for the last 3 months. Otherwise, go short. And that's more or less some of the simplest strategies that the very big trend followers actually employ out there. And just to make that clear, I've plotted out the GSCI index by trading it, looking back over the 3 months. That's the orange line, compared to a lot of the CTAs, the big funds like Aspect or Winton, and their performance since 2007. You can see that there's very close tracking. Of course, the orange line only looks at commodities, whereas these index, trend followers will also trade equities, currencies, etc., which of course the GSCI does not contain. So if you combine them in certain proportions to each other, really known as risk parity, in this particular case, 1 unit of the GSCI, 7 units of bonds, and 2 units of S&P. And be very clear here, a lot of people will tell you I should hold 60% equities and 40% bonds. That's absolutely actually nonsense. You should hold probably 80% in bonds and the rest in risky assets, such as 15% in equities and the rest in commodities. and then leverage that up. And once you have that mix, and you can of course create that leverage with a lot of CFD traders, and of course with IEG, which provides you even bigger leverage. Once you do that combination, you get this kind of return on 1 times leverage. Per year, 6%, with a maximum drawdown 4.5%. And the Sharpe ratio, which is a slightly more technical risk-reward measure, of 1.4. Now, this is actually quite tremendous because this is only rebalanced once a month, and this is the performance we've had since 2007. And it's very much in tune with the idea of a magic portfolio, similar to, for instance, Joel Greenblatt's fantastic book on value investing, the little book that beats the market. But now, once we have this edge, how do we utilize it? Well, it's about leverage. So let's leverage this up to make it again comparable to the S&P. And if we do that, in this particular case, 10 times leverage, which is something that you can certainly achieve with something like IG Index, this is what you get. It's an annualized return of 60% with a maximum drawdown of 40%, and compare that to the S&P 500 itself. So again, create an edge by diversifying across assets and using risk parity, which is something that has been known for decades to work, leverage it up appropriately, and milk it for what it's worth. Now, in summary, what we've covered here is really the idea of how do you find factors in the market and combine them to use the right leverage to extract. And as I said, of course, I'm a specialist in FX, and I introduced you to the ideas very briefly that drive the FX markets: value, carry, and momentum. And of course, there's also mean reversion and some other slight wrinkles such as trading macro. So to get you to implement the methods we outlined today in today's presentation, especially with regards to the FX markets, Simon's allowed me to make an offer on the back of a course that I recently, just very recently, launched to my students and to my audience. And it's really based around the idea of generating long-term profits. Again, I don't advocate get-rich-quick schemes. I don't believe you can make 50 or 100% a week or a month. That's nonsense. But if you take a long-term perspective, that's exactly where you can go. And the way the course is structured is very much in terms of the overview that you've received today in this presentation. We're going to go through the foundations of what it means to actually trade, cover things such as Sharpe ratios, look at profitability and performance, and to really get down to the basics of how I, as a trader, do I know if I'm very good. I mean, I've got situations where students come up to me and say, look, I just had a 10% drawdown last month. This is a catastrophe. I'm losing. And I asked them, well, how did you perform over the last 6 months in the past? And they said, you know, I made 80% return. And I say to them, well, you're losing 10% because you took lots of risk. You should expect that. You need to have some sort of benchmark against which to measure yourself. And this benchmark ultimately is the FX benchmark, which, as we saw, performs very well in terms of the factors it tracks and the way it combines various macro ideas to come up with a portfolio that produces long-term growth. And ultimately, it comes down to leverage. And leverage is a very tricky thing. It goes down to how do you exactly implement Kelly betting. Kelly betting is not just about fixed odds betting as you encounter in horse races. It's slightly more subtle in the foreign exchange markets or in the markets per se. Now, this FX Master Course Academy at this moment in time is available for 4 monthly payments of $167 or a one-off payment of $597. And of course, there's a 30-day money-back guarantee. And if you sign up within the next hour, you'll also get 2 free half-hourly consultations with me to help you with any questions you have regarding your trading venture. And here you can see the link that gets you directly to the landing page where a lot more detail is exhibited. And ultimately, the people that have come over to me, interestingly enough, have been people who have worked in the city, themselves are investment bankers, students from financial universities, or people who do business, especially within import-export, who want to understand better what the FX markets are. And all of them have taken it away, implemented a lot of this knowledge, and some of them are now actually trying to raise money from friends and family to trade some of these ideas, having seen how well it works for them. Now, I'm going to leave you with this today. Now we're open for Q&A, but just to drive the point back home, risk does not mean not losing money. It means using the right leverage to make a lot of money. An edge is something that is not a secret magic indicator you have to plaster on your screen. It's something that the market pays you for taking on the risk. And once you come to understand these two principles, you can create wealth for yourself via trading. And one of the big interesting things about the FX markets is compared to other markets, you don't need an initial big capital outlay to be able to start to play this game and look towards long-term growth. So Simon, I'm going to hand over back to you now for Q&A.
Corvin?
Yep.
I'm here. Can you just give me a second? Corvin, I'm sorry.
No, that's okay. And we've
Hi
had
there.
half an hour. It's already getting pretty late.
I'm sorry, but the telephone had just gone. Now I'm going to put that link into the chat box for Dan's asking if he can have the link. So I will type it in.
And Simon, did any questions come through while you were?
Dan saying, does the link on the screen end? Oh, I see, Dan. Sorry, I didn't see the question. Is that a number 1 at the end after the program, or is it a?
It's an L. L for landing.
It's an L. Let me type that in. Just to be.
I think one of the most fascinating things about setting up this education program was getting a lot of people joining who ultimately start to develop their own ideas in terms of implementation. And there is slightly a very selfish aspect to setting up a community like that. Is when you trade money in your own fund, most of the time all you do is stare at the screen, and the only people you get to see is potential investors who have no interest in discussing anything other than their own issues in life. And by building a community like that, you actually tend to come across a lot of very passionate people about the markets and people who are willing to take that journey of long-term growth. And just to repeat, I've never been very much a believer of get rich quick, and ultimately that's the underlying philosophy of what I do and what the community does. The other one I wanted to stress is if I do really stress that people take away these 3 exercises and actually implement them for themselves.
Okay,
and you tend to find that.
Nobody have any questions for Corvin? No, I think no questions. Okay. Well, unless there's any other questions that we can follow up via email, I think we'll. Okay, well, I think we'll probably have to say thank you very much indeed. Many thanks, says Fran. Okay. So you covered everything.
Okay.
No questions. So if there is anything that comes in, I can email them on to you. But in the meantime, I think we'll say thanks very much, Corvin. Thank you for coming on there. I'm sorry I wasn't there just at the end. Stupidly took a phone call.
Everybody's tired. It's almost 8 o'clock.
Okay. Well, let's leave it there, and we'll see you. I think we've got another slot booked for later on in the week, so perhaps some people are going to be joining us again there. If they have any questions, they can follow it up at that session as well. Okay. Well, thanks very much indeed. I'll take the roll back. Okay. Many thanks indeed.
Thank you.